So welcome to the course. You can see the toppings here, so I'm not gonna bore you too much with this intro. I try to put every single thing that I ever thought about or that I ever kind of considered when I was trading. It's been a 9-year journey for me. Then a 9 year of profitable journey. Before that, obviously, wasn't as profitable as you can imagine when one just begins trading, especially options trading. And obviously, you can jump around. Some stuff is definitely way more advanced, and some stuff is very basic. So this course is really for everyone. The only thing that this course does not cover is basically experience, and this is something you can only really gain by doing it, because it's kind of the same as getting the best teacher to maybe teach you how to play basketball in the NBA, via a book or via some kind of course. But it's a different thing to actually play in the NBA and gain experience. And obviously, the more experience you have, the easier it gets in whatever field you are. And if you want to get that experience with me, you can definitely join the Futures Options Academy. This is a private Discord where I work one-on-one with people, and there's absolutely no cost for it. Only if you actually make money by following my trades, by learning. Only then, obviously, there's a fee. Otherwise, it's completely free. If obviously you don't get anything out of it. So I think it's pretty fair. I work one-on-one, not with too many people. Other than that, if you're interested, you can email me with the on the email address below, and that should be it. Thank you so much, and good luck with the course, and let me know if you have any questions. Hi everyone, Eli here. So this video is specifically for beginners. So this is the very basics of futures, of options on futures, and basically everything and anything around it. So if you're a pretty advanced trader, then this is not the video or the section for you. So definitely for very beginner people or beginner traders. And at the end of the video, I go through the setup on IBKR, how to set up the account, the window. This is how I do it. So you can skip to the very end if you want to take a look at it, or you can obviously stay and kind of watch through in the order I've put it in through. So let's begin with what is the futures market. And basically, the futures market is somewhere you can buy and sell commodities to be delivered to you at a future date for a predetermined price. Or obviously you can just buy and sell commodity contracts for speculation or basically trading. So like actual producers, farmers, and actual companies, they buy and sell futures contracts to be able to get the physical products delivered to them, or they deliver the physical products, so on and so forth. Some companies use it for hedging, for whatever it might be. But overall, this is basically what the futures market is. Now, the only pretty much futures that I trade, and there are a few couple more that are pretty liquid. They have quite a good liquidity, but these are pretty much all of them: gold, silver, copper, crude oil, natural gas. Then we have the grains. We have wheat, corn, soybean meal, and soybean oil. And these are the tickers for each and every product. And from here, we also need to know that futures contracts, they have an expiration date. And I will go over it in just 1 second. So, we can buy and sell the futures contracts. If you want to get the physical gold delivered to you, it is actually possible. It's not that simple. Not everyone can just kind of be able to get physical commodities delivered to them. They need a special account, special approvals, but it is possible. Or I guess is basically what we do. We do trading on futures, and more specifically options on futures. Well, so for the futures contracts expirations, something I want to show you is, so let's, for example, if you go and we type in CL, which is crude oil. So you can see here we have different expirations for the futures. So we have May, June, July, August, and each one of them has a specific letter. So K, M, N, Q, so on and so forth. And usually year after year, it's usually the same letters that kind of go over and over again. So May is always K. So you can see CLK 2025. So it's K is for May, and 2025 is the year, obviously. Now you don't have to remember the letters. I really don't. It's kind of like irrelevant, but it's just good to know that they are there. And this is what will be considered the front month. So the May expiration will be the front month for crude oil, which is just means it's just the closest expiration for the crude oil. That's about it. Now, as of which one we trade, it's also not a big deal. And when we get to the option side of it, you will see it's pretty simple. And I will explain to it. But usually, whatever options you decide to trade, they are automatically tied to one of these. So you really don't have a choice. You just gonna go with what it says, and you just trade the options on one of the contracts that is predetermined by the options. So this is for the expiration. So let's just choose any of them. Let's just go whatever May. So this is the May expiration. Let's just get rid of this stuff. Now, the next thing is futures are extremely leveraged, and they have what is called a multiplier. So basically, for every $1 move, so if we bought, for example, crude oil at $62 a barrel, and we are going to sell it at 63. So we have a 1 point difference, or a $1 difference. And this $1 is actually worth $1,000. So, and this is the contract size. This is also the multiplier. So basically, for every $1 move of crude oil, you will make or lose $1,000 per one contract. So if you buy one contract, the price goes up $1, you make $1,000. So it's 1,000 to 1 leverage, I guess, in a way you can call it. But this is the multiplier. So let's go, whatever, let's choose gold. I have gold already open here. So gold, the multiplier is 100. And it's different for each and every one of them. This one is, I believe, 25,000. For copper, for silver, it's 5,000, I believe. So it's different for each and every one. So for silver, each dollar move is basically worth $5,000. This is how it works. This is how it's calculated. The natural gas, for example, is 10,000. And this is basically why there's baked-in leverage in futures contracts. Now, we trade options on futures, but it's also good to know, obviously, what kind of leverage you are basically playing with, even though, I never really end up buying or selling the futures contracts themselves. But it's just good to know. And the contract size here, or the multiplier, is also the same one we will have for the options, and we will get to that shortly. Now, the next thing will be the opening hours. So the futures market is open 23 hours a day, basically, and there's only one break between 5 and 6 p.m. And obviously it's closed on Saturday, but it opens on Sunday, 6 p.m. Right? So again, the futures market is trading 23 hours a day. It's only closed between 5 and 6 p.m. Saturdays are obviously off the limits, for now at least. Maybe they'll change it in the future. And then the market opens up at 6 p.m. on Sunday. So you have really, really good trading hours, which means you can also trade options during these hours because the futures market is open. Now, this is for most products, specifically for the ones we trade. So for the grains, it's a bit different. They are open all day, but they are closed every day between 2:20 p.m. and 8 p.m. This is just the hours, but they are open the rest of the day. And again, on Sunday, they open at 8 p.m. instead of 6 p.m. This is about it, but they are open all day long, but only close between 2:20 p.m. and 8 p.m. So they are open overnight, basically, as well. And this is really important to remember, and it's obviously a really favorable trading hours, especially if you have a job, or if people have jobs, like I guess day jobs that they have to attend. This is pretty good because you can trade, you can trade the options on those futures at 8 p.m., which is really what I do. I have kids, so it's much easier for me to kind of put them to bed and only then open my positions, and it's been working just wonderfully so far. So let's go to the next section. This is all about the futures market. I think it's pretty straightforward. It's nothing too complicated, and I'm keeping it very simple. Obviously, we can go into a crazy amount of complications, but I think over time, traders that are really into it will just kind of pick up on the little things. And there are, the little things are really not that important at the end of the day. So I'm just gonna, I'm just kind of focusing on what is actually useful to an extent. So let's go next. So let's go talk about options on futures. So options are pretty much like insurance. So you can buy or sell them in different creative ways. I always sell options, and if you think about it, the one who sells insurance is basically the one that's profiting. So your car insurance company, they're definitely making more money than you do by buying insurance from them. They collect insurance from you and maybe probably another 100,000 people. Obviously, some people have accidents and they have to, or people have maybe a total loss on their car, so they have to pay it off. But at the same time, they collect a lot of money every single month. And, because they're selling you an option that expires at the end of each month. So if you pay $300 for a car insurance per month, they sell you, and then you have the option to obviously claim whatever a total loss on your insurance by the end of the month, because you paid the $300. And if, for example, next month you don't pay the $300, then you for whatever reason, then you don't have the right anymore to kind of claim anything under the insurance policy. So obviously they are the one that make money, and we want to act as the insurance company, and we want to basically sell insurance on futures. And like I said, there's many different ways that you can do it, and I'm going to focus obviously on what on what I know best, which is neutral trading. So I don't have to kind of think where the price will go up or down. So it's it's way more safer, and it just makes way more sense in my mind. But again, this is what options are. So basically, options provide you even more leverage. So it's kind of leverage on leverage if you sell options on futures. And this is why it's so risky for some people. But at the same time, if you know how to control the risk, and you can understand where you can exit a position or where you can kind of protect yourself if anything happens, then this risk becomes really your advantage, and you can turn it into a pretty good profit. So let's talk about the options characteristics. So options, they also have an expiration date like futures, and options lose value as you get closer to the expiration date, and it's called theta. This is how the loss value is measured. It's by theta. And so, like we said with the car insurance company, if you paid $300 for this month for your car insurance, at the end of the month it's gonna be worth zero, basically. So it's kind of the same principle, right? And if you ever cancel your insurance midway through the month, you will get reimbursed half the amount, because you already lost half of the amount due to time decay, because your expiration date was at the end of the month, because you pay only per month $300. So you will get back $150 if you would have canceled halfway through. So it's kind of the exact same thing. We are going to sell insurance, and the closer we get to the expiration of the insurance, because options, they have an expiration like futures, we will be able to collect more and more of that money. Now, options have a multiplier. We just talked about it. It's the same number as the futures, and I'll show you everything in a second. And this is pretty much the gist of options characteristics for now. So we have an expiration date. So let's see what it looks like for the expiration date. So this is an opt-in chain for the SPX, it doesn't matter. So you can see here, and this is interactive brokers. And obviously at the end of this video, I'll go over exactly how to set it up. But every broker is a bit different, but it's all about the same. So you can see we have 0 days, 1 day, 2 days, 3 days, and so on and so forth. So over here, for example, let's go to 37 days to expiration, right? So this just means we have 37 days until the option will expire. And then we have all the options over here for different prices. And you don't have to worry about all these numbers for now. We will go over it in a second. So let's also see, let's type in crude oil. We'll go to futures, and it doesn't really matter which this is the futures expiration. It doesn't matter which one you choose. You can just choose any of them. It will always open all the option chains. I will get rid of the weekly expirations. So let's, for example, go for this one, 37 days to expiration on crude oil. So we can see we have May and June. So if you kind of hover over it, so we can see that FOP, so the futures options less trading day, is May 15th, which means this option is going to expire on May 15th, which is 37 days from this point. And the underlying future contract expiration is June. So the expiration for the future itself is going to be June. So this is how you know which future expiration to look at, right? So 37 days is when the option will expire. And how do you know which future contract you're trading? You just look and see what is the second month here, or you hover over with the mouse, and you can see this is the crude oil futures expiration that expires in June. So I know it's a bit confusing with all the expirations because options and futures have expirations, but the first month will always be the option expiration, and then the second month will always be the futures expiration. So this is pretty handy to remember. Now this is how we know how many days we have for the option to expire: 100 days, 69 days, 8 days, so on and so forth. Now options lose value as you get closer to expiration. We talked about this. There's nothing to show on the broker, but options also have a multiplier, same value as the future. So if you remember, the value for crude oil was 1,000. So if you go ahead and click crude oil futures, so you can see 1 point equals $1,000, and this is exactly the same. So basically what it means to you is every single number over here you would multiply by 1,000. So for example, if we want to go ahead and sell this option over here for 3.37, so you would go ahead and sell it for 3.37, and the amount of money you will get paid is 3.34 times 1,000, which is 3,340. This is just the multiplier being used here. Now you don't have to remember the multiplier. It's all done automatically for you. I remember it just because really, when you look at it many times, you're just gonna get to remember it. But it's not super important. But again, good to know what is the multiplier, and you never really have to manually decide what to multiply the each and every one of those numbers for different commodities. Now options, they also have calls and puts. So obviously you can buy and sell them. When you buy a call, you pay a premium and you expect the price to go up. When you buy a put, you also pay a premium. So anytime you buy anything, obviously you have to pay for it, and it's called a premium. And when you buy a put, you expect the price to go down. Very simple. So for example, we have the puts on the right side here. This is also something to remember. And calls are always going to be on the left side. Now, each and every broker will look a little bit differently, but it will always be the exact same. Calls are on the left, puts are on the right, and in the middle we have something that's called the option strike. So it's just basically the price that you're looking to sell the option for. And we'll get to it. It will make much more sense. You don't have to remember strike. It's just this middle column, and this is what you decide to buy or sell at whatever strike price. So puts are on the right, calls are on the left. So for example, if I decide to go and buy the 62 call option, which is going to be on the right side, then if you go to the ask side, so this is the ask, and you can also see it's also blue and it says buy leg. You press buy. So basically it means that you will be buying and paying for this option at strike price 62. And basically what happens here is you will want the price to go up, and I'll go over exactly what it means in just it's actually the next slide, but this is what it looks like. And if you want to sell, you're just gonna press the other side, the bid side, and you will be selling the option. Now when you sell a call, you get paid the premium. So here you pay the premium when you buy the call, but when you sell, you get paid the premium, and you expect the price to go down. So you basically expect the other way, or the other thing to happen, as opposed to when you buy it. So when you sell a call, you get paid, and you expect the price to go down instead of going up. And when you sell a put, you also get paid a premium, and then you expect the price to go up instead of going down when you buy a put. It's a bit confusing. I promise you it will make a lot of sense over time, but you have to remember that it's just the other way around from buying, and over time it will just become basically second nature. So let's go for buying versus selling options. I think it's also going to be really important. So obviously selling options, like we talked about, you will be selling premium, you will be selling insurance. You're going to be much more profitable that way. And it just has a much higher probability of consistent profits. So again, if you think about it with the car insurance example, what is the probability that, even 10% of the car insurance company clients will get into crazy accidents at the same day or at the same time? It's pretty low. They might get into accidents eventually in their lifetime, but by that time they paid a lot of premium to the car insurance company every single month, and they have a lot of cash to be able to to repair, fix, or pay out if it's a total loss. So that's why you have a much higher probability when you sell options / insurance. So again, when you buy a call or a put, you need the price to go in your favor, and quickly and sharply. So when you buy a call, you want the price to go up. When you buy a put, you want the price to go down. And I will go and illustrate everything on the graph actually in just a second, so it will make a lot of sense to you. Now, why do you need the price to go in your direction quickly and sharply? Because, as we remember, options, they lose value over time, which is theta. So if the price doesn't move in your direction quickly enough when you buy options, then you run the risk of losing value, because the options, they just lose value towards expiration. Well, basically what it means is, if the price doesn't move or goes against you, you will lose, right? So 2 out of the 3 ways that the price can possibly move, the price can go up, down, or up, down, or stay the same. So if the price doesn't move or goes against you, you will lose. And this is what happens when you buy options. And again, options lose value every day since you pay the premium to buy the options, you can only lose the amount you paid, and there is actually no more risk, but the price has to move in your favor. So let's go over an example for buying options. So for example, let's say, let's go over here. Let's say we are looking at the June expiration, 37 days. Actually, let's go to the May expiration, because this is what we have opened on TradingView, 8 days to expiration. So let's say we want to buy the 62 call option. So we're gonna go ahead and buy it, and we are going to pay $830 for it, which is the max loss basically for this option. So this is how much it's going to cost us to buy this call option. So call option means we need the price to go up. So basically the price is at, crude oil. We need the May expiration, perfect May expiration. So we need the price, or we need, let's see here, 62. So basically the price right now is 59.07, and we are buying the call option for 62. So what it means that we need the price to go up and at least be at our level over here to be able to have a chance to profit on the position, and the price has to go up and above the 62 level by the end of the expiration, which is 8 days. So within 8 days, the price has to go up to 62 for crude oil on this contract, which is May, for the futures. And if it doesn't go up, even if it's a cent away within 8 days, or after the 8-day period, which is the expiration, then you lose all the premium that you paid for the option, which is $830. Right? So if the price stays the same,
you lose. If it goes down, you lose. If it goes up but not enough to be over the price of 62, you lose as well. So basically, you have many ways to lose here, unless the price goes in your favor, which is up, and pretty quickly to go over the 62. And again, if it doesn't, then you lose everything that you paid for. This is why it's not profitable, and you can see that you have to really nail it. Really be really accurate. So you cannot be wrong. If you're wrong, you will lose money. Even if you're right, you might lose money. So price might go up, but not quickly enough. You will lose money, right? So this is why buying options is really, really tough and usually not really profitable, just because the nature of how prices move. And there's no way to know how quickly you will move up or down. And obviously, if it would have been profitable to buy insurance, everyone would have been doing it. Sometimes it is on rare occasions, but usually it's not. Now, and as you saw, I chose strike 62. You can choose any strike. So if we chose strike 64, for example, we would have paid a bit less because we are pretty much not as close to the current price. So we would have paid $370, and this is the max amount of money that we can lose. But at the same time, now the price has to move quite a bit more within 8 days for me to be able to at least have a chance to profit. Now, how much will you profit? I'm not going to get into the calculations right now. It's not that complicated, but you need the price to be at least at, let's see, it's going to say exactly here. So your break even is at 64.37. So the price has to be at least at 64.37 for you to just break even on the position, because 64 is your strike and you paid $370, which is 0.37. And this will be your break even. So you need the price at least to get to that level at the end of the 8 days for the expiration, just to break even. So, and if it goes anything above it, then you'll start profiting. Now, how much will you be profiting? It just depends. And I mean, there's a nice graph here, but basically, if it goes, let's say to 64.91, you'll be up about $538 on this position. And again, it depends how quickly you will do it. If it's done quickly, or if the price will move up today, then obviously you will be looking at this graph over here and not this smooth line. This line shows you what happens at the expiration, and this dotted line shows you what happens, as of today. So April 8th, so which is today. And again, don't worry about this stuff too much. I have other videos that that explain exactly what I'm looking for here, but this is basically what happens when you buy this option. Now, let's talk about what happens when you sell an option. A call, a put, doesn't matter. So you'll profit if the price doesn't move or goes in your favor, because time decay is now your friend. So within 8 days, this option will be worth 0. So obviously, if you sell it, the price doesn't move, you get to keep all the premium that you received. Now, theoretically, there is no max loss, as opposed to when you buy options, you can only lose what you paid. Here, because you don't really pay anything, you get paid right away. Your max loss is unlimited, and you can basically blow your entire account on one trade. But obviously, it's not, it's not that simple. And, this is, I guess, something that throws people off quite quickly. But this is just part of the risk that we need to manage, because we have a higher probability of making money. So, and we have one more thing is, because you get paid to sell them, and you will have to offer some of your account value as collateral to the broker, which is what they call margin requirement. And we'll go over it in just 1 second. So let's do the same thing. Let's sell the call that we just tried to buy, and let's see what it looks like on the graph. So let's go to call strike at 62. I'm going to sell this call option. So right now, if I sell it, we are going to get paid $840, and this will be our break even currently. So it's 62.84. So let's go over here. We'll plot it on the graph. So 62 is our strike. So basically, as long as the price stays underneath 62.84, or let's simplify it. Let's put it 62. As long as the price stays under 62, we will get to keep the $840. So the price can go down, and right now we sold this option. So let's make it red. The price can go up, the price can go sideways. Doesn't matter for us. We just want the price to stay underneath this strike of 62 for us to be able to keep the entire credit of $840, which obviously you can see there's a way higher probability that the price is just going to stay underneath it as opposed to just go right up. Anything can happen, of course, but you have a way more ways to profit when you sell options as opposed to when you buy them, because you don't really need the price to move anywhere. You can just stay and do nothing, and the option will be losing value in real time, and it's going to be worth 0 at the end of the 8-day expiration. And again, the break even will be the same thing. So even if the option goes all the way up to 62.84, which is our break even over here, at that point you will not be losing anything. You will be just breaking even on the option, because the strike is 62 and we got paid $840. So we have a bit of a cushion above 62. So this is how it works when you buy and sell, and you can clearly see. So when you sell options, it will definitely go much in your favor. And you can also do some pretty creative things, which is what I do. I'll give you a little glimpse. So you can sell a call and at the same time sell a put. Let's do it this way. So we sold the 62 call, we sold the 57 put. So basically what happens here, we create a range for the price to bounce in between. As long as the price stays within this range, these options will keep losing value and they will keep making money. So if we have 62 and 57, let's see over here, and then 57 will be right here. So as long as the price stays in between these lines, we will be making money. And how much money? Well, now because we also sold the put side, we will be getting paid $2,170. And if the price stays in between our lines, we get to keep the entire amount, right? So it's quite a bit of money, and obviously it's not that simple, but this is what I do. I sell options neutrally, and basically, you can create different amounts of range that you want to go for, and they have, different characteristics, so on and so forth. And but this is basically the gist of why selling options is more profitable. Now, because we sold the call and the put, right, we get paid. We get paid $2,170, right? Now, obviously, we will have to offer some of our account as collateral to the broker, just because we got paid. We're taking more risk instead of just buying options, and the margin requirement is $8,817 for this position, which means $8,817 out of your account will be held up as collateral for this trade, basically. So it's nothing crazy, nothing unusual. It's pretty normal, pretty standard. Now this number can change. If the risk goes up, it can inflate. It can also go down. Usually it goes up a little closer to expiration, but it depends. It depends on the broker's calculations of the risk of your position and based on what's going on in the markets. But basically, this is how much of your account will be held up, and you cannot use this amount for anything else. It's held up by this position, and obviously it's including it's after you get paid the credit, right? So actually it's the margin requirement is higher than 8,000. It's 8,817 plus the 2,170, but the net margin impact is 8,800. So this includes the credit that you're already receiving, so you don't have to subtract the credit from this amount. It's already including that with interactive, right? So this will be held as collateral on your account. So again, this is margin requirements, really important. You really want to keep that in check, and you definitely want to, not overuse it, because you can only really use probably like 85% of your account. At 90%, the broker will basically either close some of your positions, or send you messages telling you to close some of your positions because your margin requirements are way too high. So because you're using 90% of your account in margin requirements. So you definitely want to keep that number low. I at most, I don't want to go over the 65-70% at most. But usually, I keep it to well under 50% of my account. Now, selling options is proven to be extremely profitable and consistent. But it is obviously more complicated, has more risk. Obviously, as you saw, we have an unlimited amount of drawdown, but obviously you have stop losses. You have many things you can put in place. Just like any insurance company, they have many policies, many ways to make sure they protect themselves, and like basically any other insurance company. So here you will be operating your own insurance company. You're gonna have no clients. You will be just you in the market, but you will have to create those rules for yourself to be able to protect yourself against big moves against you in the market, which again, everything is really possible, really not such a big deal. So let's go over more specifics for the options. Okay, so we have delta. Now actually there's quite a few things here, and it might get a bit scary, but the only few things that you really want to kind of focus on is delta and margin requirements, which we already covered. The rest is good to know. I don't ever really look at them at this point. It's just good to know that they exist, but they're definitely not something I use in my decision making. What I use is delta and margin requirements, and even implied volatility, which I'm going to go over loosely in this video. So delta, what is delta? So this is the fancy explanation. So the delta is the rate of change per 1 point move of the underlying. So just a really fancy explanation of what delta is. In the real world, delta is used to just tell you the probability of profit for a position. So let's see what it looks like. So let's see. We have the delta right over here. So this is the delta column for the call side. This is for the put side. So let's sell a strangle, or let's sell the call 62. We have a delta of 29.5. So basically what it tells you is your probability of profit when you sell the option will be 1 minus that, which is about 70.5%. So you have a 70.5% chance to profit on this position, which is right over here. Well, and the broker will always give you a bit more of an accurate calculation. And again, so you don't really have to know the stuff, but it's really important to know it. If you want to become a professional, you got to be able to to tell approximately what probability you have. So in this case, we have a 75 chance probability to make money on this position. Now, if you go ahead and you buy this option, it means you only have about 28.8% chance of making money on this position, and now the broker is going to be a bit more accurate, 25%, which obviously makes sense because we had 75% chance to make money on the position when we sold the option. So it's quite accurate. It's not the exact calculation, but it's, if someone tells you, hey, I sold a delta 30 call option, well, they have about a 70% chance of being profitable on this position, right? And you don't really have to know exactly what's going on. Now, what happens if we sell a call at delta 28.8 and we sell a put, let's say delta 28.2, right? What is our probability right now? Well, it's pretty simple. You just connect them both. So if you connect delta 28 and delta 28, and they're both short positions, we are looking at a delta of 56 in total. So it means you will have about a 50 or 56% chance to lose on this position, or about a 44% chance of making money. Because remember, if it's negative, you always go 1 minus whatever number there is. And if you buy the option, then it's just the number, whatever number you see is your probability of profit. So here we expect about a 44% chance of profitability. Again, the broker has a bit of a different calculation. It's actually 65 in this case, but it depends on market conditions, and strangles are also they're a bit different to calculate. But this is basically how you how you can use delta to help you with the probabilities. What I usually do specifically is I go usually delta 21 on each side, give or take. And again, we're looking just at 8 days to expiration, so it's not as accurate as I would like it to be. If, for example, we go to like 100 days to expiration, for example, so let's go and sell the delta, what is it, delta 21 or delta 2021, doesn't matter, on the put side, and then the delta 21.6 on the call side. So we're looking at about a 70% chance of probability of making money, which if you look at deltas, it should be about 60%, 60-ish%. But this is, again, how you use the delta, and it just kind of tells you basically what kind of probability of chance you have. Now, let's go back for 1 second for what is the rate of change per 1 point move of the underlying. So this is the fancy explanation of delta. So let's just quickly go over it. So for example, if I just go and I sell or whatever, let's say I buy the call option at strike 69, and we have a delta of 20.5 or 0.20.5. I just call it 20.5. What it means? This means that if the price of the future goes up by $1, which is from 59.27 to 16 or to 60.27, this position will gain 20 cents. So this position will be worth not $1.20 but $1.45, or let's just call it $1.40. Sorry. This is what it means. So it just means that for every $1 move of the underlying, this option will gain or lose 20 cents, if it makes sense. So it's basically the definition of delta. But again, I never really even look at the delta this way. Not really useful for the most part. And you can see here the higher the delta, the more aggressive it is. So a higher delta will be way more susceptible to the price move. A lower delta will be less susceptible. And you can go as low as like delta 6.8, 6.54, whatever it might be. So this is it for the delta. Now let's talk about the theta. So theta is the amount in dollars the position is losing every 24 hours. And let's see where we can see it over the on the broker. So let's just go and again, let's go and sell the 69 call option with expiration of 100 days. And our future expiration here is the August month. So if we go to the profile, we can see here the portfolio theta. So portfolio theta tells you just in dollar amounts how much is this position going to lose every 24 hours. And it's going to lose $15.85. As you can see, the theta here is positive, which means it works in your favor. If we buy this position, it will show up as negative because theta is going to be not a good thing for us because we are buying the option. Now you can go for instrumental Greeks, then it will just show you the theta before the multiplier multiplication. Right, so I always just look at the position Greeks and I know exactly what theta I'm getting, so how much the position will be losing. And it's really dynamic, so if the price goes up or down, the theta will change for different positions. I don't really look at this stuff. I don't really even care about my theta too much. When I open a position, I just I focus on other things, which is again going to be in another video. This is just the very basics and fundamentals, but this is your theta. This is basically it. So nothing too interesting about the theta. Now we have the gamma. So the gamma is just the rate of change of delta. So big gamma means that delta is way more susceptible to change quickly. Low gamma means that delta is changing slowly, because the rate of change of delta is also important. And I'm not gonna go any more details on gamma because I never ever really look at it. If you trade short expiration options, gamma is basically not your friend, it's against you. It basically, if there's a big gamma and you sell options with low days to expiration, with a low amount of expiration dates, which is anything under 20 days to expiration, basically means that you can get into a really bad situation really quickly, and vice versa, because gamma is big, which means delta is very sensitive to the price movement. Now Vega is the position sensitivity to the change in volatility. Also somewhat important. I don't really look at that number as well, but over here again, if you look at the profile, you can see your delta, your gamma, and your Vega as well. So this is how much the position will make or lose if the volatility basically goes up by 1 point. So volatility goes up by 1 point, and you will lose $86 on this position. Now by what point? Where is the point? Well, the volatility should be over here. I don't know why it doesn't show it, but at the same time, again, I don't really look at the stuff. And over time, you'll learn to understand where the Vega is bigger or smaller in terms of what delta you choose. Different deltas have different Vegas, and there's a whole thing, and we're not going to get into it. It's not really important currently. What is important is to understand what exists, and then over time, things will just become more and more clear the more you're going to go over and trade. So let's go over IVR. So IVR is just implied volatility rank. It shows us how volatile the underlying is relatively to the previous year, to the previous 3 months, 6 months. It's whatever you choose. I'm not going to go over it too much. It's definitely good to know about implied volatility, and there's a separate video and section for volatility and how I look at it for commodities, because again, this entire video and everything I do is specifically tailored to how I trade and how I use each and every point of data, or don't use. So this is another video that will teach you about every single thing in detail, where you can use it in different strategies and ways. This is specifically on how I do things, because this is what I know best. This is the only thing that I can stand behind. So IVR important to know about. I don't really use it anymore. I use something called CVOL, the commodity volatility index, which is just a different version of IVR, but more accurate and easier to look at. And there's a separate video about CVOL as well, so CVOL. So let's go next to the margin requirements, which we already looked at and talked about. It's just the collateral held by the broker when you open a short position. You can also have some margin requirements when you buy options. It will be very, very small. Yeah, so it will be pretty much almost the same amount that you pay, because this is basically how much you are going to pay for the position. This will be the capital held as collateral, because you need to be able to lose that amount to be able or you need to be able to have this amount in your account to be able to purchase the option for 1,170. So nothing too interesting over there. Now there's intrinsic and extrinsic value. So we have OTM, which is out of the money options. We have ATM, which is at the money options, and we have in the money options. Again, it's all fancy names. Might be confusing, might be not. All you need to know is out of the money and at the money options, they have purely extrinsic value, which means this is basically what the option can lose. And when you have intrinsic value, this is basically value that the option cannot lose. So if you're in the money, so if the price is past your option price, then it has an actual value, and it cannot lose that actual value. So it doesn't matter what theta you have, or if you buy or sell, doesn't matter. You cannot lose that value. So it becomes a bit more like just holding the future itself, the future contract itself. Again, nothing crazy. Out of the money, at the money, and in the money. Let's go over it very quickly. I think it will be very simple if you look at the SPX actually, but it's nothing too crazy, nothing too important, and I don't really kind of think of it. So as you can see, the current price is 5,048. So it's right in between 50.45 and 50.50. So right now, these options over here will be considered at the money. So this option, this option, this option, and that option, they will be considered at the money options because they are exactly at the current price of the underlying. Now on the call side, you can see we have the shaded blue area. So everything in the blue area is always in the money, which means the price has already surpassed, or the underlying is already surpassed, went, I guess, over the strike price. So strike price 5,000, the price already went over it by $48, right? So this will be worth basically at least $48. Again, there's the different multiplier here, so on and so forth. But this is in the money options for the call side. Put side, the same thing. It's in the money where you have the green shaded line. And then out of the money is basically everything else. So it's everything that the price hasn't reached just yet on the call side and on the put side. And out of the money options, so these options and at the money options, they have purely extrinsic value, which means they can lose all the value they have. And anything in the money is mostly intrinsic and very, very little extrinsic. But, again, it's not really relevant too much, but good to know. And obviously, they cannot lose their entire value. It just doesn't work this way because they are actually worth something because the price has went over those strikes over these options. So for the most part, this is, I think, basically it. Now, we already talked about the probability of profit, which is really important, which is what delta is used for. But again, your broker will display the numbers for you as well, which is, I think, really important. Let's see how do I set up my Interactive Brokers account. So let's go ahead and just open a new window. Let's call it new. So I think this is also pretty important because some people really have struggled with it, and I know this platform might not be the most friendly, but this is what I'm used to, and it has been doing pretty well for me. So I'll go to new window, and first of all we will click portfolio because we want to see exactly what positions we have. Now let's go over here, and we can just put it a bit larger over here, and I keep my portfolio pretty large for the most part. Now, this is a demo account. Obviously, this is not a real account. So it's just things that I'm trying out for now. And this is the first window that I would open up, the portfolio. The second window, it will be, see here, the order entry. So it's also pretty important to have this window open over here. This is where you can, customize positions or, create closing orders, so on and so forth. So I always put it underneath. Then I always go to my watch list and I keep it on the right side. Some people don't really use a watch list. Some people do. It's, I know, up to other people. And the last but not least is I'm looking at my, where is it? I think I just lost it. There you go. The order management. You just click orders. And then you can see here all of the orders that has been executed, or if you have a stop loss, a take profit, it will appear over here. And then you can adjust it, and you can you can also add the trades. You can add the summary, so you can see exactly what happened. Well, this is how I keep everything for my portfolio. Really simple, nothing crazy. Watch list. You can just go ahead, click crude oil. Let's go to crude oil. We have futures, and then I choose whatever futures I want to be looking at. And then we have our orders. This will be always the open orders, and then you can look at trades, which is basically closed trades, the price, the commissions, so on and so forth. And summary, it's pretty much the same as trades. I never really look at it. And here we have all of our active positions, our account value, everything you need to know, profile. And here's the order entry. So think really, really, really simple, nothing too crazy. Now for the option chain. So for the option chain, what I would do is I would open a new window. So currently I have the option chain window, and then I have this window obviously. So it's just two separate windows. I also have a graph window, which I don't really use, as you can see. So let's say we opened up a new tab, and we wanna get the option chain over here. So I will go ahead and click option chain. I will make sure it's going to be. Actually, I think we need to do this. So there's a little lock here that you have to unlock to be able to put things within the tab. I'm going to put it to full size. So, and I already have everything that I need being set up. Let's lock it, save changes. And the way you can add delta, volume, bid and ask, or whatever you might need is you just right click and you go insert column. So you would go to Greeks and you would add, what is it? The delta, what is it? Sorry. Oh yeah, we already have delta added, so it's not in over here, but we can add, say, portfolio theta, right? So, now we know how much these options are going to be losing, right? I don't really use portfolio theta, so I want to keep it as clean as possible. I use only volume, open interest, and delta. And just so you know, volume is how many contracts has changed hands in the past 24 hours, and open interest just tells you how many contracts are currently in circulation for each and every strike. So for the put side, and then for the call side, these are different numbers. But this is how you would go and change the columns. I think there's many ways. You can also probably go through settings. I'll see. I'm not sure exactly where you will go to get the columns here. So I just right click whatever I need, insert column before the delta column, and I add whatever I need, which is basically only the theta. You go to the Greeks, you add the delta, and that's about it. I don't really add anything else. Quantity, prices, you can customize it in whichever way you think is the best. So this is how I create this window, obviously, and then it's pretty simple. Just go, you sell, you buy whatever you need, go to profile. Then if you want to place an order, you just press submit on the bottom right side. Now, let me close this tab and let's go over here, because I also customize my my portfolio window. So what I do is I go right click, doesn't matter on which column, and we can go to manage columns. Then you can see we can choose whatever we want. We can choose, let's say, IVR or implied volatility, dividends. We have 26 week IV low, 26 52 week IV rank, which is just IVR. So we can click add. Then we can just, if we want, we can move it up or down. Doesn't matter. We can remove it. And these are the things that I have. So I have the unrealized P&L, so how much the position is up or down. I have the daily P&L, so how much the position is up or down today. The actual position, or whatever future it is, and then the actual position. Then we have the market value, how much is it worth today, the delta of the position, the portfolio theta of the position, and how many days are left to the expiration. So it's really, really simple. The position, how much is it worth today, the delta, the portfolio theta of the position, and how many days are left until the position is going to expire. This is about it. Now, when you open the unrealized P&L, you want to right click it. You want to go to display both, and you want to display both value and percentage. So usually by default it will be only value, but you want to see both value and percentage, so you can know how much you're up and down in your position, not just in dollar amount, but also in terms of percentage of your credit or your premium that you received or you paid for. I think this is about it for this video. It was pretty comprehensive. I hope it was just the basics, the things that are really, really important when you basically sell options or trade options and futures. And again, if you have any questions, please let me know. But that should be it. And thank you so much, and I will catch you in the next one. Hi everyone. So in this video I want to go over my actual strategy from start to finish, exactly what I do. and I think it'll be really, really good to kind of to show my workflow and how everything just gonna make sense and fits together. And yeah, my strategy is pretty, I would say pretty good. My overall approach, I guess, to the market. I do have a 92-93% win rate as at the time of making this video. This year I'm so far up about 12.5%, where the S&P is down, I think maybe 10%, 12%, give or take. It's been a pretty good year, no losses so far. So let's get into the strategy. I think it will be really, really cool to show you exactly what I do, and it's been the same thing for quite a few years at this point. So we'll go over the boring stuff, the technical stuff, and then we'll go to look at an actual example, to open it up and basically do the exact same things that I would normally do. So basically, I mostly sell short strangles, and this is what I will focus on in this video. Of course, I try to stick to 45 days and less. It was a pretty, it's a pretty good rule. Theta is pretty big at 45 days, but this entire year, I just had trades with over 100 DTE just because the range that you get to your stop losses is pretty small with 45 days, and I'll show you exactly what I mean by that. So 45 days is ideal, but depending on the market, you gotta use a higher DTE to be able to actually have a pretty good range or a safety range to be able to stay within the position. Now, these are the prices that I trade. Lately, I don't even trade any of the currency futures and the meats, basically from gold and all the way down to soybean oil. But occasionally, maybe I'll put some trades on these products. Very rarely. So these 10 products from gold to soybean oil, these are the ones that I, really look at all the time. My short strikes are always at around delta 20 for the short strangles, and for if I sell a short call or short put, it will be around delta 35. But again, I barely take these trades. I'm mostly, most of my experience is basically with strangles, so I'm gonna stick to what I know best, and for this video for sure. Now, my profit target is always at 50% of credit. My loss target begins at 50% of credit, sometimes maybe 45, 40, again, depending on the range. But this is a rule of thumb. I never risk more than $1 to make $1. And my stop loss is dynamic, so I'll go over it in just a second. Basically, as the position is getting better and better, I am lowering my stop loss to kind of make sure that I have a good risk management. And again, it's pretty simple. We'll go over it in a second. And I always use CVOL, so the Commodity Volatility Index, for a good entry. Basically, I want to see if the option pricing is relatively overpriced or not, and make my decision based on that. And again, I'll go over it, an exact example in just a second. I can exit the position if my targets are hit, obviously, take profit or stop loss. Exit at 21 days to expiration to avoid gamma risk. Usually I never get to that point, but sometimes, once in a blue moon, you can definitely get to that point where you have 21 days to expiration left and you kind of need to decide what to do. So I will always exit. I can adjust the position if needed. Basically never do it. Maybe I've done this maybe one in the past 3 years. And it was a very unique situation. Yeah, so really hard to give an example for that, but this is not something I usually do, or ever really. I just take a loss or a profit. That's it. I found it to work really the most efficiently for myself, and I can exit early if something unexpected happens. Let's say I'm in a position on wheat or corn, or I'm in a position on copper, for example, and then we have some news coming out that potentially one of the biggest copper mines in Chile got destroyed or kind of got damaged. Well, at that point I would exit early because I don't want to risk the price going up or down really, really hard, probably up, and just exit the position early, which lately has been happening quite a lot because many things are happening in the economy. So I definitely have to be really, really receptive of the news. So the most important thing is I'm just looking for a good opportunity where the risk is worth the reward. Pretty simple, nothing much else to it. And this is the whole point of everything. So I want to make sure that mechanically I have a good position, I have a good range, and I promise you it will all make sense in a second in terms of the good range, what it means, what it looks like. And this is about it for the technical side. Now for the stop loss, for the dynamic stop loss. So again, let's say we are opening the position with a 50% stop loss, which is, again, the max stop loss that I would put on a position. Then at 15% profit, I move the stop loss to minus 35, 20% or 20% profit, I move the stop loss to minus 30, so on and so forth. And at 35% profit, usually I would move the stop loss to 0 or minus 15, depending on the position, depending on what happened. But usually to just break even. And then at 40% profit, I will move my stop loss to plus 10%. So on that point, I either make 50% or I make 10% on the position. And you wouldn't believe, but this will do wonders to your win rate, especially if you follow my exact method, because basically I'm looking to place positions where there's a high uncertainty that there will be no volatility, or the volatility will be coming down, or no price volatility during the trade. This is what I'm trying to aim for. And then obviously to set an estimate stop losses and the ranges, I used the position profile on interactive brokers, which we will go over. But this is the dynamic stop loss. This is what I do. This is a game changer. I mean, I've been doing it for quite a while. It's not something new, but this is amazing because there's nothing more painful than getting to 40% profit and then something happens and the position just goes all the way down to your max, to your stop loss, which is minus 50% if you don't actually move your stop loss. The most terrible thing, and it happens. It happened to me a few times where from 40% it went down to 10%. It hit it. We got out of the position, and then it continued on to the negative territory. It happens, but it is what it is. That's trading. You just gotta make sure that you are limiting your downside as much as you can. And it will just do wonders for your risk reward and for your just for your confidence and sanity as well. So a few more specifics. The risk per trade is up to 4% of the account value. So give or take, I can risk about up to 4% of my account value per trade. Sometimes more, sometimes sometimes less. Usually less. I probably never go over 4%. And this just to make sure that we have a pretty small position size and pretty consistent. And I am mostly neutral. I rarely trade directionally, and this is because neutral trading is much more straightforward, and it eliminates the need to be right in my directional assumption, which I'm really good at. And the stop loss range is much bigger because we get extra credit. So we have extra safety basically when we are neutral. Now, for the adjustments, again, they are mostly useful. They are a useful tool, but only if you plan to hold the position until expiration, or if you have an assumption the price will move in a certain way. I avoid making these assumptions because I find them not as profitable based on how I trade. My only assumption is the price will stay within a certain range for the next 20 to 30 days. This is the only assumption I take. So I never take a directional assumption. I'm just really bad at it. I found it not to work for me, at least not consistently. And this is trading neutrally is the only thing that's been working for me consistently for many years at this point, and with money management and so on and so forth. So let's go ahead and take a look. So we'll go over all the commodities, and I'll give you my thoughts on which one is a good candidate, which one is not. So basically I'm looking for the price to kind of be in a range. Now, as you can see here with gold, it's kind of like uptrending, so there's really no way for me to place a position or put it in any kind of reasonable range, because it's been uptrending for quite a while, since the beginning of the year, 2025. So let's look at silver. Silver, ideally, if we can get this kind of range for our stop loss, to our stop losses, basically, if we open the position and it stays within this range, we can make money. This will be ideal. The only problem is the price is really high, not really high, but it's closer to the top, to a point where even if I use a skewed strangle, it's not going to be very good because it's just way too close. So if the price would have been maybe in the middle here, so, so maybe at this point over here, I would have been, happier to maybe open the position. So for now, not ideal, but let's think about it. Let's see if there's anything else, but not ideal. And if it's not ideal, there's no point opening up the position. Copper is also one of those not ideal positions, and this is, and I'm just kind of putting what, in my opinion, will be the best range for a trade. So this will be a pretty good range. The price would have been moving within this range since, March 2024. So a bit over a year, but again, price is a bit closer to the top. This one is a bit better than silver, but at the same time, not ideal. Maybe if we just move it a little bit, still a pretty good range, but still not ideal currently. Let's go to crude oil. So crude oil is kind of the same thing. The ideal range will probably be somewhere maybe like that, maybe like this. Also not ideal, and you can definitely do a few tricks. Maybe lower it a little bit, and you have a much better range. But again, you can see most of the range was over there. Now, another reason I'm not gonna, like, even if everything would have been fine, I would have not traded, is because of the fundamental analysis. Just because of what's going on in the economy, and because the prices are pretty volatile for most commodities, not all of them. And I definitely don't want to play in a playground where volatility can just increase on me quite sharply and quite easily, right? But I'm not going to go into fundamental analysis in this video. I have a separate video for that. But this is why these positions are something that I would not open. So we have silver, which is definitely too close. We have copper, which is somewhat okay, somewhat yes, somewhat not. Again, if it's then there's no point. We have crude oil, which does look much better, but again, at the same time, my ideal range will be this, right? And it's a bit too close to the bottom. I can definitely get away with a skewed strangle, but let's see what else is out there. And we're looking for something ideal. If we can find something, this is exactly what we are going to go for. Now, let's see here. If we can get this range over here. It would have been a pretty good range. But again, the price has been somewhat directional, up, now down, and we are pretty close to the bottom range, so there's no point in trying to make it work. Let's look at ZW. So ZW would be the same thing. The range will not be ideal. It's way too close to the bottom, and then quite far from the top. And corn. Actually, corn looks much better. Let's see, corn, ideally you want to go for this range. And again, this is exactly what I do. Probably like, well, not every day, you're just going to do it once and you're just going to follow the price and see what's going on. Yeah, this is not too bad. This might be actually a really good position. So we'll keep corn in mind. Let's see here. This is also might be a pretty good position. It's just soybean. So ideally, this is the range that I do want to get. You can see how this is pretty much dead center from to kind of have this range. This is even more ideal than corn. And then we have soybean meal, which is obviously not ideal in any way. Doesn't matter how you look at it. And we have soybean oil, which is kind of the same, not really ideal in any way, the price. So we have corn and soybean, which are my potential candidates, right? And again, this is all just mechanically looking at the graph. This has nothing to do with fundamental analysis. The reason I would not trade any of these right now is because we are getting into the harvesting and planting season, which according to seasonality, and every year commodities or the grains usually get pretty volatile during this time. So I'm not trading them regardless, even if I see a good opportunity. So my next step will be to go look at the commodity volatility index, which is the CVOL. So let's look at the CVOL for corn. So let's look at the 3 months. So it's closer to like the bottom half. If this is the high, this is the low. It's closer to the bottom half. Volatility is not that high. Let's look at soybeans over here, see what it looks like. So soybeans, let's see. So soybeans are kind of the same. It's kind of closer to the bottom, right? So this is pretty much a giveaway for me to not open the position. But let's continue on. Let's say the volatility was, you know, anywhere in the upper 60% or so. Anywhere in the upper 60%, it's perfect for me. And I usually look at the 3 months. So, you know, anywhere over here, anywhere over this line would have been perfectly fine for me. I would have been okay with that. You can never expect a perfect volatility, but yeah, you can definitely expect for a good volatility, which is all we're shooting for. So if it's, you know, really perfect and all the way to the top here, you know, that's great. Then we take the trade. If it's like this, I'm not gonna take the trade. Now let me just show you a graph that is somewhat ideal, even though on the actual range for soybean oil, it's not ideal. So you can see here volatility is relatively up or relatively high compared to the previous 3 months. So this is a perfect volatility for me, and I will definitely go for a trade. But this is soybean oil, and soybean oil, we have a pretty bad range here, so we are definitely not going to trade this product. So let's say we go for soybean, just for the soybeans. Right, let's say volatility is good. Well, let's say volatility is the best with soybean. Right, you can see the price have been moving sideways within this range quite nicely. And my key thing is I wanna at least close to 3 months of price movement within my range. So in this case, price have been moving within this range since July of 2024. Right now it's, you know, we're almost in May 2025. So, you know, 10, 11 months, that's perfectly fine. Way more than 3 months, which is perfect for us. Now let's see what kind of range can we get if we take a look at the option chain here, and we'll open the position. We'll do everything. So let's see if we can actually get this kind of range when we look at soybean. And this is soybean September. So if you look at soybeans, so we have a few expirations here. So let's see here. This is July. This is August. Okay. So let's move it here. So we have 58 days, 93 days, and then we have 120 some days. Now, what I would do, I would definitely start with 58 days, and 58 days is a different contract. It's the July contract. Now, I'm not going to do it in this video because I know with 58 days, we will not have enough credit to be able to create this this kind of range. The range will be much smaller. So, and again, it depends on the year. Some years the price doesn't move up and down that much. You can get away with 58 days. Here, for a fact, I know that we are probably going to need the 120 days. Now, also a little trick: if you have two of those contracts for grains, you always go for the first one. This is usually the more liquid one. So let's go and we sell the Delta 20. In this case, Delta 21.6 call, and then we'll do the same thing on the other side. Will be Delta 20.8. So this is a strangle. Let's go to the profile. So let's see. So if you go to maybe a 10% move, maybe 30% move, there we go. So let's say we have a $100,000 account, and we are looking to risk no more than 4%. So for now, let's analyze it as one contract. So let's say we're getting about $1,500 in credit. It means our stop loss will be at $750, which is 50% of credit. So let's see if we can get closer. So basically, I'm gonna go in and I'm gonna look at the dotted line. I'm gonna look here where it says minus 750, which is right here. And then I wanna see where is it on the bottom graph here, which is the price of soybeans. So let's go to the left side. We go to minus 750, and we can see it says 9.45. So 945 means 945 right here. So this will be our bottom stop loss range, which is really nice. And now we'll go ahead and do the same thing on the other side. So 750, it will be 1103. So 1103, which will be right here. So you'll be cutting it really close. 1103. We'll be cutting it really close, which I'm totally okay with. So this is a perfect range. This is exactly what we were looking for. And again, you don't really have to go to 124 days all the time. It depends on what the market is giving you, right? Sometimes the range is way more narrow. So for example, here with natural gas, you can see the range is way more narrow. And here, I know because I traded it, like 45 days to expiration will do the job beautifully, very simply. But now, prices are just way more volatile, so you just need to get more premium to get a better range. And again, these are not the strikes, right? This is just the distance to the stop loss. Now, the range is getting bigger as the position is getting more profitable, obviously, even though we move the stop losses. Usually, as you move the stop losses or lower them on the position because it's profiting, your range to the stop loss will stay approximately the same. It's all my values are not just kind of guesses. It's something that I've actually checked over the years, and basically, if the position is up 20%, stop loss will be minus 30%. On the graph, if you look at the position profile at that point, you will see that the stop loss is actually around the same point, just because the position is up 20% and stop loss is down 30%. So it always maintains a really good range, which is really important for us. All right, so this is a perfect range. This is a position that I would normally go for. The two factors that might put me away from going, or that turn me down from going into this position, is definitely the volatility, but at the same time is because I know that this is the seasonality. Usually starting April or May, usually I just stop trading the grains in April. The planting and harvesting season is coming to effect, and this is when volatility really picks up every single year. Sometimes more, sometimes less. Regardless, this is not this is not an environment that is good for strangles. But then after the season is over in usually July, this is time to get back and we can get some really nice positions. But again, this is to go over the mechanics. So all good, we like it. Now, let's say I want to risk $3,000, so 3% of my total account value, and my account is $100,000. So it means that my stop loss will be 3,000. It means that I need to collect about 6,000 in credit, which will be about 4 contracts, right? So 4 contracts will give me about $6,000 in credit, give or take. Stop loss will be about 3,000, and which is 3% of my account. And again, this is initially. As we move the position and the position is getting better and better, then obviously our risk will go down and down. So we will be risking less and less on the account while still having the same kind of profit target. So yeah, let's go. We have 4 positions. Now this is a demo account, so I'm just gonna go to market. It doesn't matter too much. I just want to show you how we are going to set up the take profit stop loss. Here we go. We got to fill at 29.5. We opened up this position. It's down 2.1% on a demo account on a market order, which is really good. It means we have really good liquidity. Soybean. So after the position is opened and we know the full price is 29.5 right here, let's go ahead and create the closing orders, the stop loss. So let's go close, and this will be the take profit order. So let's change from data to GTC. Now 29.5 is our fill price. It means that our take profit should be half of this, which is, if I believe correctly, 14.75. So let's go and look for 14.75 or for 14.75, just right here. So this is our take profit order because the position will be worth less than it is now, right? This is also pretty important to remember. So now we go to advance, one cancel another. We'll choose the contract, which is the soybean. From limit, we'll change it to stop. And if you don't have the stop, you just press this button over here and you choose stop. Now some people do stop limit. I just use stop. Usually I close my losses manually. I never actually close them, physically, just because I want to be able in control to get the best possible fill. Now quantity will be 4 is the position from day to GTC, and here we're willing to lose 50%. So basically we will add 14 3/4 to 29.5, which should be 14 3/4. It should be 44 1/4. So let's go to 44 1/4. And it's always with interactive, it's always best to scroll physically and get to where you need to get. Just because if you mess up the minus sign, it will be a completely different order. But this is how you do it. You don't mess up with the buy and sell here. You just press right click and close because you just want the platform to do the rest for you. So this is how I set up the stop loss. Click submit, transmit. Now we have the take profit, which will be always in green, and then we have the stop loss, which is being held and monitored. And whenever you need to move the stop loss, you just go here, you move it to the new value, whatever it might be, click update, and that's it. You move your stop loss. So I'll leave it at what we need, which is 44 1/4. And this is it. This is my strategy pretty much. But again, this is the mechanical side of the strategy. I want to emphasize the fundamental side of the strategy is extremely important, because you can get yourself in a lot of trouble if you don't know basic seasonality patterns. I do have a very, very detailed video about it for every single product, and you should definitely check it out. So this is it. Hopefully this video was really useful, very insightful. This is basically everything I do. Somewhat simple, but at the same time, very profitable. Again, thank you so much for watching, and I will catch you in the next one. Hi everyone, so I want to go over my stop loss strategy, how I choose, how I set, and how I adjust my stop losses for my short strangles. And I think it's really, really important, and this is a video I've never made before. So basically I'm going to show everything from how it looks like, how it looks on the graph, what do I do on interactive brokers, how I find the stop losses, how I set them, and how I actually manually also input the stop losses on the position in interactive brokers. So basically, this is an all about video about stop losses and how I specifically use them for strangles, and I'm sure you will find some value within this video. So to begin with, I just want to go over my dynamic stop losses and basically how they work in theory, and then we'll go over exactly step by step of what I do when I want to open a position, and how I label my stop losses on the graph, and how I know if the position is safe or not safe depending on what stop loss we get. So basically, when I open a position, my max stop loss that I will ever go for will be 50% loss on the credit. So this is the absolute max stop loss that I'm going to go for. The past few trades I went to a stop loss of 40% because it gave me a really, really good range, and I promise it will make a lot of sense when I talk about my stop loss and what kind of range I get for that stop loss. So for now, if the position is getting to positive 15%, so we're up about 15% of credit, then I move the stop loss to minus 35. Then if I'm up 20%, I move the stop loss to negative 30%, so on and so forth, up until we get to about 40%, where at that point I move my stop loss to positive 10%. So throughout, basically up until 35% profit and beginning 15% profit, I move my stop loss. So there's basically 50 points difference. So 15 plus 35 will be 50, 20 plus negative 30 will be 50, so on and so forth, up until I'm up at 40% of credit. At that point, I move my stop loss to positive 10%. Now, this is basically done to protect us against some massive moves that might happen in the market that are unexpected because of some unexpected news. And from my experience, I've never had a position that went to 40% and then went all the way down to 10% to hit the stop loss and then went back to 40%. Usually the position from that point goes down all the way to 10%, it can go down to to the negatives and even stay there for a while, or even really lose a lot of money. So it's all based on a lot of data, a lot of data, over 9 years of data that I've been working with. And I began with a stop loss of 200%, 150%, and over time I learned how to optimize my trades and how I can have a much better risk reward, the stop loss, and how I can actually choose it. Now here at 35% profit, some trades I might move at the stop loss instead of negative 15% to actually 0 to break even. Basically, it's kind of the same reason as I move the stop loss at 40%, or at profit, at 40% profit, I move the stop loss to 10% profit. It's really unlikely for the position to go all the way down to negative 15 or even to 0 at this stage, because from 35 to 40%, it's a really small jump. It can happen really even in the same day. But usually, I'll keep it at negative 15. But if I see that that something happened to the position, and from plus 35% we are down to like plus 10%, I'll move the stop loss to 0 to break even, just because probably something unexpected has happened and I don't want to lose on the position. So I'm okay with taking a break even on that trade. Now again, to set an estimated stop losses range, I use the position profile on IBKR, which is exactly what we are going to go through right now. So this is my demo account, where I keep all of the trades opened. The ones that I closed, usually I just want to keep them open and see what's going on. So these trades are all closed on the actual account, but here obviously we can see what's going on afterwards. So this is basically post tariffs, but this is not what this video is about. So let's choose silver, 112 days to expiration. Now this is just for to give you an example but this is an actual position that I might be looking at depending on what happens on the tariffs. So I'll go with about delta 21 on each side. So I'll go and sell the put side, delta 21, and I will do the same thing on the call side. So let's go for delta about 21. We'll sell it. Now I'll go to the position profile. That now that I have a strangle, and again I only really trade strangles. Now here's what we get. So we get a P&L graph here, right? So we can go to 30% here, so we can see the entirety of the graph, and we can see how much credit we get. So we'll get $6,600 in credit. So let's say I want my stop loss to be half of that, which is at 50% of credit, which means my stop loss will be at 3,300. So over here, the dotted line is actually represents today's date. So what will happen if the price moves, to any one of those points today, and then the solid line represents what happens at expiration. Now this does not include changes in volatility, which is obviously a big thing. So this is why these are estimations, but they tend to be really accurate from my experience. And obviously you can go ahead and change the date that you want to be looking at, and it will adjust it based on the theta. But I'm just looking at the default view. So I will go ahead and over here on the right side, this is the P&L of the position, and on the bottom, this is the actual price of the commodity, which is silver at this point. And this is the silver July futures contract. We will be taking a look at it just in one moment. So let's say stop loss is $3,300. So let's go see on the put side. You can see it's negative 3.3K. And on the bottom here on the other axis, we can see that the price should be at around 30 for silver if the position will be down about 3.3K. So at this point, I'll go to my silver July expiration here, and I'll go and I will draw basically a line at 30. So this is approximately, or I guess we can go a bit up to get to 30. Yeah, so this is basically where my stop loss approximately will be on the put side, and this is giving that we open a position right now based on the credit that we have on silver on this DTE. So, and let's see where is it on the call side. So $3,300 will be 37.1. So we'll do the same thing at 37.1. It should be right over here. So this is basically my range to my stop losses right now. So these are not the strikes. The strikes are, well, actually on the put side is the strike, but I don't really look at the strikes. I only care about my range to the stop losses. But on the call side, you can see this is, the stop loss is not the strike. So I don't know, maybe actually when I edit this video, you might not be able to see the numbers that I see. But basically our put strike is 30 and our call strike is 39.25. But again, I don't really care about the strikes. I care about my distance to the stop losses. So basically what happens here is, so if the price goes up all the way to 37.1, this is where our stop loss is supposed to get hit. And same thing on the bottom side. Now, anything can happen. It all depends on volatility. If volatility is not a factor, then it will be super accurate. Volatility is a factor. But at the same time, these stop losses, they do get wider and wider as time goes. But this is exactly how I go ahead and I check, okay, what is this position that I have? Is it going to be a good stop loss, a bad stop loss? Now, as you can see, it all depends on how much credit you get. So if we would have gotten more credit on this position, so instead of 6,600, it would have been like 7,500. Then obviously our stop loss would have been wider because we can afford a bigger loss. And if the credit is higher, then it means the volatility is higher. So it's just a little thing to kind of think about, right? So this is basically what kind of range I will get for this position, and this is really accurate or extremely accurate from my findings, and I go based on that to make my decisions. Now, a good question will be, okay, where are these lines will be if, for example, the position is up 20, let's say the position is up 25%. It means that my stop loss will be moved to negative 25%. Now, where would my stop losses be on the graph here? Well, this will be just an estimation right now, but usually they stay at the same spot, or they're actually a bit wider. Because we maintain the difference of 50% or 50 points, basically. But don't take me on this one. If you're in a position and you're up 25%, go into the position profile of the position, and then you can definitely check it and see, okay, if I'm going to be down right now, negative 15% of credit. Let's see where are these lines are going to be relative to where they were when I just opened the position, and you'll see it's basically either the same or even a bit wider. So, which is obviously better for us. So, my philosophy will be to always get a really good range for the stop losses. And how would I know if this is a good range or not? Well, it depends on the graph. So here, for example, ideally, this is not a bad range, but ideally, I would want maybe the price to go down a little bit and to maintain the same range, but just shift it down, right? So then I can see that the price moved within this range since the beginning of September of last year. So it's a good 5-6 months, right? And right now it's just a bit cutting it short here. So I would definitely want price to go down a little bit and then open a position, or I can just open a skewed strangle and then try to move my stops for them to be this way. But then I'm going to be not as neutral, which is okay if it's not too much. But this, for example, will be a really good range to the stop losses, because the price have been moving within this range for quite a while, like I said. And this is how I know, okay, this is a pretty good stop loss. Now, if we have something like, natural gas, right? So I'm not going to go over and check the exact where the stop losses are for natural gas. But as you can see, it's really directional. So even if we get a massive range, it doesn't matter how big it is, you can see the price was moving within this range for, without exiting it for a month maybe, which is definitely not enough. I need at least 3-4 months. So this will be considered a pretty bad range, and I don't want it at all, right? So basically, looking for something where I can say, okay, the price have been moving within this range for a few months. Now, it also depends on the DTE that you choose. This is specifically for about 100 DTE. I want the price to be moving within this range for 3-4 months. And again, the DT really depends on what's going on in the market. Sometimes, some years or some products are pretty good with 40 DT or 50 DT or days to expiration. Right now, silver is definitely going to be much better with 112 days to expiration. Why? Again, just because of the range. Because with 40 DT or 50 DT, there's no way to get anything meaningful. It will just be too tight, and you'll be putting yourself into too much risk. But some years, when the price is way tighter, the average true range is way smaller. 40, 50 days to expiration just works much better. And right now, that's not the case, which is totally fine. It's not a big deal. Options are just tools that we use to adjust our trading based on what the market is doing, or based on what the commodity is doing. So hopefully this was really, really clear. And if not, please let me know in the comments. But right now, let's go ahead and see how I actually place these stop losses. So, we actually have a silver position over here. So let's go ahead and right click it, and I will press close. Now the window that pops here will be my take profit. So from day, I will change it to GTC, so good until canceled, and I will choose my my take profit. So my take profit, let's just throw a number. It doesn't really matter. Just for the mechanics, let's put it at 0.341. Now this is the take profit order is set up. I'm going to click advanced and go to one cancel another. Now I'm going to click contract. I'm going to choose my silver contract. From limit, I'm going to change it to stop. Quantity will be just based on the position. Get from day to GTC. Then I'm going to set up my stop loss, which we can just place at whatever number. At the moment, doesn't really matter. And one important thing is, I'm never actually going to change this from sell to buy, or this. Interactive has a funny way of basically naming the buy and sell orders. So this is why I'm just gonna right click the position and click close. So it will be the default settings for me. And then at this point, that's it. You just press submit, override and transmit, and yeah, there we go. The green one is the active order. This is the limit order, which is the take profit. And the blue one, this order is just being held and monitored. This is the stop loss order. And this is basically it. And then whenever you need to move your stop loss, you just go here. You move it to whatever you need to move it. Click update. Stop loss is updated basically, and this is your take profit, which basically doesn't really move. Now, if one of the orders is going to get filled, the other one is automatically will get canceled. So there's no way for you to gonna get filled on both of them if something crazy happens, which is I think really important and really good. So this is basically it. Really, really simple. Hopefully this video made a lot of sense. This is how I choose my stop losses, and basically this is how I move also my stop losses during the position. And I know I got a lot of questions about or requests to make a video like that, so here it is. So hopefully it was a pretty good value, and thank you so much for watching, and I'll catch you in the next one. Hi everyone, so let's talk about my technical analysis and my method to achieve a 93% win rate for short strangles. So I know this is a historical win rate, so it's not the past month or anything. It's the past really 8 or 9 years at this point, and you'll see there's nothing really too complicated. It all makes a lot of sense. So let's begin. And basically, before I begin every video, I'll go quickly over my strategy. You can jump forward if you already know the section. But basically, I mostly sell short strangles. I can also sell some calls and some puts. And in this video, we'll go over of the technical analysis for calls and puts, but or for directional trading. But mainly I trade short strangles, 45 days or less, even though the past few trades were at 100 days. And you'll see exactly why, it's actually because of the technical analysis. And these are the products that I trade. I stick to about delta 20 for short strangles, 2021, and about delta 35 for short calls and short puts. My profit is 50% of credit, and my stop loss is also 50% of credit to begin with. And then as the position is getting better and better, I'm lowering my stop from 50 to 35 to 25 to plus 10%, just to kind of keep tailing the position, so we don't have a situation where we're up 40% and then our stop is still at 50%, and then the position just kind of turns around and gives us a full loss, which we don't want, and it's it's definitely not nice. I've been through it. Now I'll always use the commodity volatility index for a good entry. Basically, it just tells me if the option pricing is if it's overpriced or not, and based on that, I will kind of make my decision. And I'll make a separate video for my strategy in depth, but this one will be specifically about how I look at the graph. And let's get into it. So I think everything on this side, on the right side, is self-explanatory. I'm just looking for the best deal where the risk is worth the reward, and where everything is basically looking to be on my side: time, theta, CVOL, everything, and the range. So my technical analysis, it's really simple. It's all about range. It's all about the range to the stop losses, so not the range to the short strikes. And I'll go over in a separate video exactly how I know my stop loss at different points of the price. And it's really simple. Every broker has those tools. I'm just looking at the position profile and kind of estimating where at what price of the underlying my position will be down a certain amount, like 50% of credit, basically. Nothing crazy, really simple. We'll go over it in a different video. For now, let's talk about the neutral stop for strangle. So I'm looking for the range the price is moving within, and what my stop loss is to be outside that range. So not too complicated. Let's go right to the graph and see what I'm talking about. We'll go over a few examples, so it will be really, really, really simple, and I promise you won't have any questions after this video. Sorry. And also forgot to mention, I opened an academy. So if you're interested, it's basically where you can trade with me and all this kind of stuff. I teach there, and there's no upfront cost. I try to make it so it will make sense. So there's no upfront cost. It's not like a monthly fee or anything like that. Just message me and I'll explain exactly how it works. But basically, if it doesn't work, then if it doesn't work for you, then obviously it's completely free, basically. So let's begin here. So this is the gold position. We're looking at the daily graph. I only ever look at the daily graph. So this is a demo position that I opened on this day. So these are the not the strikes. This is the range to my stop losses. So even though the price of gold went up, this position is up. I'm looking at it right now about 20% of credit, which is really good. And it was open maybe on January 10th, so a few weeks ago. But basically, when I open up the graph, what I'm looking to see is, okay, are we going sideways? Are we going, is it a uptrend, downtrend? This is, a clear, essentially like sideways trend, right? So for me, ideally, I would want my stops to be outside the absolute high and absolute low of the price range of whatever the price is moving within. And without counting this, basically the last time the price kind of broke out from this range was on it's September 12th, as you're watching it now. Right now we're at the end of January 2025, so it's been a few months, right? So this is a really, really, really good range. The reason I did not open it on my live account is basically because the CVOL, the commodity volatility index, wasn't high enough. But it was high, but not high enough for me. And when I'm not sure, I just open it on a demo account and just kind of see what's going on, and based on that, I can learn and see what's going on. Now this position had over 100 days to expiration, and the reason is because the range with any less days than 100 days, or with any other cycle less than 100 days to expiration, did not provide me with such a big range, right? And I want to see what's going on on the graph, and I want to be able to to use my toolbox, basically my options, different expirations, different deltas, to be able to match it to what's going on at the graph, and potentially get the best possible deal. So this one is really simple, right? Basically, it's moving sideways, up and down, up and down. It's not perfect sideways, but it's not a crazy uptrend. Maybe like something you would see over here. This would have been a clear uptrend for a few months, but here it's been moving pretty much sideways, where this is the absolute high, this is the absolute low, and this is the range that I would draw for myself. For example, I would do something like this, and then I would go and look for a position that can match at least this range, right? So for me, it ended up being like this, which is quite wide, really, really good, and I really, really liked it. Now for copper, I also have a position on a demo account. So here, I'm sure you already see it, right? So ideally, this is also why I did not open the position. Ideally, I would want my range to be outside of this price movement, right? And this is the actual range that I got. Again, it's around 100 days to expiration. I try not to go over too much because at that point it might not be really cost effective in a few ways. But basically, you can see, I'm looking for my stops to be outside, right? So I just go to the graph. This is, I'm gonna draw the lines outside here, and then I will go to the option chain and see, how I can get the closest without obviously, breaking my mechanics, without going, like a delta 40 strangle, which obviously going to collect a lot of credit. We'll have really wide stop losses, but it will take like ages for us to profit on this position. So I will always want to stay around the delta 20, and I would always play around with the expiration rather than anything else. Again, really simple. So let's take a look at actually a position that I did at the beginning of the month. Now, this is more typical 49 days to expiration. As you can see, this was the range, which is a pretty good range, and the position profited in 11 days. It was a really good position. Everything worked out. Again, I wasn't sure about this position because the range was actually big enough, right? But from my experience with wheat, you can have like a massive 2-3% day, or even two of them, and it will easily hit the stop loss. So this is why I went only half a position here. But it's been moving sideways over here, and this is where I was opening the position. And I guess if I really opened the position over here, right? So this is why I wasn't really sure if it's a good one or not a good one. I ended up only opening half a position. And this is a position I currently have on, and you can see it's quite different. The range is massive, right? And again, like I said, it's all about the range. It's all about the range for your stop losses. These dotted lines are just alerts for me, but this is the range to the stop losses. It's massive. The position is currently up, I think about we see here 5.5%, give or take, which is not too bad. It was opened at maybe a week, less than a week ago, actually. So, and the range is massive, right? Last time the price was out of this range was on October 14, which is really good. We're at the end of January, right? So this is what I want to be looking at. And I guess it all depends on your risk tolerance, because ideally you can go with smaller range and less DT, and you might profit quicker. But for me, I decided to be a bit on the safer side, and stay in an extra maybe 10-15 days in a position. But my range is just insane, right? So when I saw that, it was a no-brainer. Now there's another position that I currently have on. This was also a no-brainer. It was opened on January 13, and you can see the range is massive. So without counting this little blip over here, the last time it was out, it was over a year ago, right? So in October of 2023. So you can see how it would just make sense for me to get this range. I will also open this as a skewed strangle. So basically, it's not symmetrical. So the range to the top and the bottom was not symmetrical. That was on purpose. And it was on purpose to be able to get that range. And I'll make a video on how you can do it. It's really, again, so simple. It's much simpler than you think. As long as you can get your range right. And when I just opened up the graph, right, when CVOL was okay, everything was okay, I just drew the lines. I was like, I would say, okay, this is the ideal range for me, right? It will be great. Even though the price was here, it would have not been that easy to obviously to get that range, and the best I could do was this one with the expiration that we had, and this position is up about 40. What is it? 44% right now at this very moment. So it's almost at profit target, right? So it's been really good, and it's only been what has it been? From the 13th to the 29th, 16 days, 16, 17 days. So not too bad. Planning to close this position before the end of the month, of course. Or I guess this video comes out on February 2nd. So I guess this position would have already been closed. But this is very clear where the price is moving sideways, right? So let's. I think. Oh, actually, I have another example. So I think was it this one or. Let me see here. No, yeah, it was this one. This is, if I believe correctly, the new position. Let me double check. Yeah. So this is also right. So if you look at this way, this is a perfect uptrend. But then it could kind of wait sideways, and again, I opened up when the price was all the way down here. This is a demo position. So again, a position I'm not sure about. I don't really like the meets. If I ever open a position on them, it's rare. It happens. But actually, in December, I had a trade on the I think it was this trade over here, if I believe correctly. I don't remember, but yes. So again, this is a good neutral position, right? When you talk about the range, right, and obviously you can go get the range a bit more up and move it upwards this way, but this is a different story. This is a topic for another video, but here we want to focus on knowing where what range we want for our position. So hopefully it makes a lot of sense for you guys. And obviously not every graph is good for this stuff, and this is where I'm going to talk about the directional trades, which is a way more tricky, but I'm looking for obvious trends and obvious points of resistance. And let's take an example. So LE right now, so obviously there's no way that you can get for a neutral position, there's absolutely just no way for us to get a good range. Like what would be a good range? Like this, that. There's just no way, and obviously there's no way to get this big of a range. This is way too much, right? Maybe beforehand when the price is kind of moving sideways, but here the price just kind of shot up. So this this will definitely just count as a directional trade. So we will only look to sell puts on it, right? Now, ideally, I would want my stop underneath the previous swing low, so at least over here. Now, I already went through this position. Basically, impossible to get the stop the stop this low when the price is all the way up here, which is a bummer, but it is what it is. I think the best stop that I could get was like somewhere here, and it's just too close, right? One day and then you're done. But if you can get something like this, way safer, way safer. But I couldn't, so obviously I did not open any positions or any trades on LE. And let's look at another one that actually a trade that I did actually. And it was opened up somewhere either here or here. I don't remember. I don't know why the arrow for the opened is missing. But basically, this is the Canadian dollar, the Canadian dollar futures. As you can see, the price is just tanking down. Absolutely no way to to get a neutral position here. No way. This is just completely downtrending. And it's really obvious, right? So I'm only looking for the obvious stuff. If it's not obvious, I don't know, right? If I cannot clearly tell if it's a neutral trade or a directional trade, then something is wrong, or it might be somewhere in between, or I just don't touch it. And actually, this is a different trade that I tried because I do remember that my stop was here, and the position I opened it. When did I open this position? I don't remember exactly. I think it's in one of my videos. It was in December. I don't remember. It was December. I want to say it was December. Either 16 or 17th. But it was somewhere around this area, and my stop was if I believe correctly, either here or here, but it was really far away. The calls were really expensive, and I was able to get a really good stop with only 42 days. This rarely happens that you get such a good stop loss. And again, I was just looking to see what was the previous swing or whatever the price stopped beforehand. Ideally, you probably want to stop like this, but and probably this was probably a possibility with probably 100 days to expiration, but I was attracted to the 42 days, even though it was a bit lower, because of the theta. It was way bigger there, and the price obviously went down, and the position worked out pretty well. But this is really obvious. This is obvious for anyone trading outside of trading. This is obvious that this is trending, and for example, what is it? This is obvious that this is this whole price movement here is just going sideways. It's really obvious, right? So you don't really have to think much there. Same thing with gold. It's pretty obvious the price it's been moving sideways, right? Even though it's kind of big ups and downs, but it's been moving within the range of this high point and this low point for quite a while, right? So this is essentially it. This is all I do for my technical analysis. I think it's pretty simple. I think it's pretty self-explanatory. And at the end of the day, I try to keep it simple and obvious. The best range is the one that is extremely obvious to both experienced and new traders. So hopefully it makes a lot of sense to you guys. And again, if you have any questions, let me know. I'm still working on the course. Basically, these weekly videos, they will be part of the course at the end of the day. So I'm basically just building up, and where I can just put everything together and then obviously provide more good content. Again, thank you so much for watching, and I will catch you in the next one. Hi everyone, so let's talk about fundamental analysis for short strangles, specifically for futures options. So this is the full guide, and again, this is based on my experience, and I basically 95% of the time trade strangle or sell strangles on futures options. So I'm neutral. So this will be from this perspective, and again, this is based on my 9 years of experience and the things that I've seen in the market. There's definitely more to it, and I'm still learning. Obviously, there's always new stuff happening. But overall, this is going to be pretty helpful, and I'm sure some people can get some value from it. So, what is fundamental analysis? It's pretty simple. It's the analysis of commodities news. So basically, anything that can potentially affect the supply and demand. So basically, news is just news, titles, news, and this kind of stuff for commodities. So there are two types of news. There are critical and non-critical news. The critical news are news that are certain to affect long-term. These are news that are certain to affect long-term the supply and demand balance and the price and the volatility of a commodity. And a quick example will be a copper mine collapse, some parasites in the cornfield. So these are major kind of events that can really affect the price and volatility long-term of the commodity. And in the video, we will go over each and every basically commodity or every sector, and I'll tell you exactly which or what are the critical news and the non-critical news for each and every one. And at the end, I'll also go over my strategy, which I go over, I guess, at the end of every video now instead of the beginning. So if you're interested, it's gonna be at the very end of the video. So the non-critical news are news that affect the price and volatility of a commodity for a short period of time, but don't change the supply and demand balance. So basically, let's say we have an extreme cold weather for natural gas, right? So there might be more demand right now for natural gas for the heating, but again, cold weather will pass. Obviously, the seasons will change. And for example, another thing we have is maybe a low amount of rain, or maybe extremely high amounts of rain for the crops, for the grains. You're not going to have crazy amount of rains for 4 and 5 months, right? So these are usually non-critical news, things that really spike the volatility, sometimes also spike the price, but usually it ends up being okay in the following days or weeks. So let's begin with the metals.
which is a bit different. So if you look at gold and silver, so gold is basically more of a currency than a commodity at this point. Silver is somewhere in between. It is a pretty useful commodity, so it's being used in a lot of applications, way more than gold is. But it is also some kind of measure for for how the economy does and so on and so forth, because it is affected by how the gold is doing. And there's a whole thing about the gold and silver ratio. But basically, the critical news for both of these are anything to do with the US dollar news. So interest rate changes are a big thing. Geopolitical conflicts are a pretty big thing, because those two metals, they're, I guess, like precious metals, they're like safe havens, so people might invest and buy them even physically to store their money and to basically store the value of their money, because these obviously two metals are always going to be valuable in one way or another. And if we have obviously this like a stock market collapse, or maybe like a quick rise in the market, so money might flow from gold and from silver to the stock market, so on and so forth. But this is, I guess, not as simple, but obviously when you have geopolitical tensions, and at the time of me making this recording, this is when Trump put some tariffs on Canada and Mexico, and then there was a whole negotiation. So gold and silver will react to this stuff, and this is basically like geopolitical conflicts or I guess tensions. So basically anything that can make investors think, oh, maybe I should take my money out of the stock market, put it in in precious metals, and buy some gold and silver. This is basically what it is. But overall, it's not as easy, not as clear to know what is critical news and what is not. But usually, what is really critical is interest rate changes and geopolitical tensions or conflicts. Now, the non-critical news is basically everything else, and there's really not much to it, really. So, let's say something happened to Nvidia, or something happened to any kind of stock, not a big thing. Now, obviously, if we hear there's a mine collapse for silver or for gold, these are also pretty major news. But this, rarely, it never happens, basically. So in 9 years, for me, it never happened. Maybe I'm mistaken, but this is not something that can easily happen. Now, for copper is a completely, industrial commodity. It is needed basically for in every single thing that we consume and buy and even sell. So real estate, phones, everything. So copper is really, 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 really important in everything. So the critical news will be a mine collapse, which happened in March of 2023. A mine in Chile collapsed. I think it was the biggest, or one of the biggest copper mines that collapsed. And the price of copper just kind of went up like crazy, and volatility went up with it. So this is obviously pretty critical news that will change the supply and demand balance. So there will be much less supply, and basically the same amount of demand. So the price will shoot up. Now the other thing is China, China's economy collapse, because China is the biggest purchaser, the biggest single purchaser of copper. They make everything, and they have a lot of real estate. So anything happens to their economy, like something really critical, copper will definitely react to it. But usually nothing really happens, and we will probably never really know, because China can really just kind of make up their own numbers and post them, and we will never know. But these are the really critical news for copper. Now the non-critical news is basically what it happens all the time is China economic policies change, and they change their policies all the time regarding real estate, manufacturing, so on and so forth. It's never anything crazy. The copper volatility always kind of rises up, and then this is like me personally, I've never had a situation where the China economic policies change affected really a position, because basically when that happened, or when they announce some kind of policy changes, or they announce that they are going to announce some key economic policy changes, the copper price might shoot up, volatility will shoot up as well, and this is usually a really good time to sell, given some other parameters are in place. And then usually after the announcements, nothing crazy is usually being announced, and the price either goes down or stays the same, and volatility usually goes down or stays the same. Either way, we entered at a good point because it was basically non-critical news, things that will not really affect the supply and demand chain in a big way. So just so you also understand, so these policy changes can definitely affect the supply and demand balance, but not critically, right? So, and the only thing we are afraid of is basically major things that happen really quickly, like a mine collapse, or obviously the Chinese economy collapse. This is it for metals. It's pretty easy. Everything just streamlined, makes sense. This is the way I like to work. This is the way I like to look at this stuff. Now let's go to energy, natural gas and crude oil. So natural gas, the critical news is geopolitical conflict, obviously. So what happened between Russia and Ukraine, 2022, and because Russia exports a lot of natural gas and crude oil, but specifically now natural gas, the price kind of shot up because we don't know how the exports will now be affected because of the conflict. So this is pretty basic, obviously. And extreme cold weather in the wintertime will also affect the supply and demand chain, and obviously damage to pipelines. So if it's, like I said, if it's too cold, and there will be more demand to natural gas. Now, it's not really, it's in between critical and non-critical, because I believe at the beginning of the video I mentioned this is not non-critical news. It depends when it happens. So in wintertime, generally natural gas always has a spike in volatility, whether it's too cold or not cold enough, because it's never what is expected. And this can definitely lead for, extreme cold can definitely lead to increased volatility for a few months, or it can just cause volatility to be increased just for a few months. So this is why I basically decided to put it on the critical news, because we don't know, and it's just better to stay safe than sorry than try to guess how long will the extreme cold weather effects will affect the natural gas. And overall, I never ever trade natural gas in the wintertime. It's too unpredictable. There's too many variables, and volatility always goes up, historically, always. And usually the summertime is when you want to trade it. Now, if there's damages to the pipelines, obviously that's pretty critical. Doesn't happen often, and there's definitely some spills and stuff like that, but nothing major. Again, if anything major happens, it will be pretty easy to observe. You'll see the news. The price will move right away. The news will definitely cover it. And the good thing about commodities is usually takes a few days for the news to completely be unveiled, because there can be some, let's say something major happened to the pipelines. Actually, this is what happened to the mine collapse. So there were reports that the mine collapsed and the price of copper shot up. But the thing is, the extent of the damage was not known, right? So, and over the next few days, the reports came out, and it was actually a major mine collapse, and the mine was basically unoperational, right? So same thing over here. We can have some reports about damaged pipelines, but it will take time to know exactly what happens and the exact extent of the damage and how it might affect or not affect the supply and demand chain. Now, the non-critical news for natural gas is the natural gas reserves and the liquid natural gas reserves. So say if the reserves are a bit high or a bit low, or people expect it to be this and then it's going to be that, usually doesn't have a lasting effect on the volatility and on the price and on the supply and demand balance of natural gas. Now, crude oil, critical news is again geopolitical conflicts, as you can imagine, just like I mentioned with natural gas. Extreme cold weather in the winter can definitely affect crude oil. The exact same explanation as for natural gas. And like I said, damage to the pipelines, same thing. It can definitely happen. And again, these are pretty big things, so it's not something light. And for non-critical news is everything else, because crude oil, even though this is probably the most useful or the most maybe traded commodity in terms of its usefulness, because we need crude oil in everything and anything. To make anything, to do anything really, we need crude oil. But for the non-critical news,
I labeled it as everything else because there's really not much else going on. So there's those pretty huge critical stuff. Maybe some small policy changes for maybe OPEC and stuff like that. So this stuff can fall between non-critical and critical news. It really depends on what happens, and at the end of the day, this stuff is not that easy. So basically, commodities that are kind of intertwined with the economy and are not only affected by supply, are not only affected by supply and demand balances, can react a bit differently. It depends if there's some tensions and between some countries, so on and so forth. But I guess this all falls into geopolitical conflicts and tensions. So let's move on to the agriculture, which in my opinion is the easiest to understand, as it's really the easiest commodity to trade in terms of knowing, if you're dealing with something major or not. So obviously critical news is the geopolitical conflicts. Now, when the situation between Russia and Ukraine unveiled, now Russia and Ukraine, they export over 25% of the world's wheat and even the corn. Obviously, the price of wheat and corn shot up like crazy because this is a major geopolitical event. Really easy to understand. And let's say you're in a position and you hear that like Russia invaded Ukraine, right? So we will not know the full extent of it because the news just came out. And trust me, it depends on you, but for me, I have alerts on my position. So if anything happens quickly, I'll know right away, and then I can read the news. At that point, when you see there's something major happening, like Russia invading Ukraine, and you know that they export over 25% of the wheat in the world, you just go ahead and you just close your position because there's no point in taking that risk. You don't know to the extent of it, but again, the rule is always be safe than sorry, especially in critical news, right? And then obviously we know what happened, and the wheat price shot up. Now, trade agreements is also a big thing, and then crop parasites, so things that can really completely disable the harvest. It can be a big thing, and I guess it depends to what extent. So this is again something to follow up. The crop parasites can also be something under the non-critical news, but again, better be safe than sorry. So I'll put it under critical news. And then extreme cold weather, also not always, but it can definitely affect the crop conditions and how easy or hard it is to actually plant new crops and or collect or harvest the old ones. Now the non-critical news is there's not enough rain, there's too much rain, it's too hot or it's too cold, and there's low past exports. So let's say in 2024 or 2025, January 10th, a report came out, and the monthly report for the agriculture supply and demand estimations, and they reported that the soybean oil exports for 2024 were way lower than expected, right? So this report caused the volatility and the price of soybean oil to shoot up, right? And these are news that don't really affect us going forward. These are news of the past. So obviously, I opened a position. The position was really profitable. Within just 17 days, it was a really good position. Because again, this is not something that can affect the supply and demand balance. These are news of the past. And as for the weather, usually when there's not enough rain or there's too much rain, these things usually always end up balancing out. And this is basically just noise that I believe, major hedge funds or major players in the game, they kind of enjoy those news because they get them quicker and they can make their plays off of just, panic in the market basically, or fake panic. So this is just basically noise in the market in terms of the weather. It happens all the time. And this is definitely a good time to enter a position and enjoy the profits because they usually come rolling pretty quickly. Now, for the meats and the currency futures, so this will be pretty quick and easy. So for the meats, we have HE and LE, and I really don't have enough data. However, any types of news, they appear to move the price of meat strongly. And I think this is because the trading hours are extremely limited. It's open from like 9:30 a.m. to 2 p.m. So it's open less than the stock market, and there's no pre-market or aftermarket. Basically, this is a very liquid and big commodity because everyone likes meat, basically, right? Or not everyone, but there's a huge consumption of meat, and for consumers, for big chains like McDonald's and so on, right? So this is a bit problematic for me. I've only ever done, I don't remember how many trades, but my win rate is definitely not that good with live cattle and lean hogs. And I think the biggest thing is probably because the hours are really limited, and there's a lot of pressure when the market opens. There's big movements because the market is not open for long, and it's really liquid and it's really sought after commodities. So I usually don't trade them, but this is pretty much my 2 cents about it. But basically this is just livestock, right? So if there's cold weather, if there are parasites, stuff like that, but it will also affect the supply and demand chain. But overall, this is a pretty hard commodity to sell options on overall, especially neutrally, the way I do it. Now, for currency futures, so you can imagine this is basically, these are not commodities, and there are many different factors that affect the price movements. And generally, it's extremely hard to trade these products neutrally, but some years are very stable for certain currencies, some years are not. But overall, just impossible to kind of gauge what is critical, what is non-critical a lot of times, and many times there's some surprise news, and things happen in the economy, and you can imagine how many things just affect, let's say, the Canadian dollar, right? So because this is measured against the US dollar, right? So CPI, GDP, interest rate changes, many things can affect each and every one of these commodities, and maybe the economy of that specific country, of Japan, can be affected, and alongside it, it depends on how the US dollar is doing. So there's many things, and these are really hard to trade neutrally because things just don't make sense, and it's impossible to piece stuff out, or basically. So for me, my bread and butter is definitely the metals, specifically, specifically copper. Copper has been really good. I've never lost a single position on copper, and I've done many positions on copper. And gold is also pretty good, and silver is also pretty good. Sometimes silver is much better than gold, and sometimes they're vice versa. It really depends. And obviously the energy sector and the agriculture sector, these are my 3 best sectors, best performing ones. I have the best win rate. Then the meats and the currency futures are way more problematic. I barely trade them. I trade currency futures way more than I trade lean hogs and live cattle, but still barely, maybe a few trades a year, because they're much tougher to kind of, to open a position and expect like a really high win rate, which is obviously what I'm looking for. I'm looking for at least over 90% win rate over time, which is what I get with the other 3 sectors, and with these 2, way tougher. So this is my strategy. I'll go over it really quickly. I basically 95% of the time I sell short strangles. I can definitely sell some short calls and some short puts. Usually not. I try to stay at 45 days or less, but lately as I'm making this video, I've been trading a lot of 100 days to expiration because the market is way more volatile. Prices go up and down way more. So 45 days to expiration is just pretty hard to trade, basically impossible right now. But some years it's 45 days it's ideal, and sometimes some years even 30 days to expiration is ideal. It really depends on the year. These are the products that we just went through. My short strikes are always at delta 20 for the short strangles, and around delta 35 for the short call and short puts. But again, I usually only trade the short strangles. My profit target is 50% of credit. My loss target is also up to a 50% of credit, and it's dynamic. So basically it means if the position, let's say, is up 25% of credit, I'll change my stop loss to minus 25% of credit, right? And then so on and so forth. Usually it's really mechanical for me. And I'm always going to use CVOL for good entry. So CVOL is the commodity volatility index. It's basically like the Bible for option traders or option sellers. It tells you if the options are oversold or not. And I have a entire video about that specifically, and I'll link it in the description.
And my exit rules, I can exit obviously when one of the targets is hit, profit or loss. I will exit at 21 days to expiration because of gamma, and I can adjust the position if needed. Usually never happens, really rare. It can maybe happen. It happened maybe once or twice in the past 3 years. Usually I just take the loss, or if something is really clear, I might do something else, but usually not. And I can definitely exit early if something unexpected happens, and the risk is going to be not worth it at that point. And the last thing is I'm always looking for a good opportunity where the risk is worth the reward, and basically where the odds are extremely in my favor. This is about it for this video. Let me know if you have any questions, and I'm still working on that on that course. So thank you so much, and I'll catch you in the next one. Hi everyone, so let's talk about the commodities and the seasonality, and I'm also going to talk about the metals obviously and the currency futures as well. So this video is going to be I think really important if you are looking to get a better understanding of the futures market, the commodities market, and become really a professional trader. So let's begin with what affects seasonality. So really there are just a few things, and it's really not too complicated. And once you get the gist of it, it becomes really common sense. So obviously the weather seasons can affect seasonality. So winter, summer, fall, and so on. Especially the transitions from summer to winter and winter to summer. This is something you really want to kind of keep an eye on. And during these seasons, kind of follow very specific commodities. And we are going to go over every single commodity, so you'll know exactly what's going on for each and every effect of seasonality for it. So holidays are also a big thing. So for example, Thanksgiving and Christmas, during these holidays, the meat commodities, they tend to be more volatile because obviously there's more demand. People just buy more meat to for the Thanksgiving meals and the Christmas meals. So there's usually more volatility during these times. So usually when there's more demand for a commodity, you can expect volatility to go up. Now, I never really know if things will go up or down in price, but what you can expect is volatility to go up. You just don't know in what direction it will go up. That's the only thing. Now, the third thing is the crop harvesting season, and this applies to pretty much only the grains. And it's usually from April to July, and I'll show you exactly what it looks like on the commodity volatility index, so on the CVOL. So you'll be able to, see exactly where I derive those, or how I get to these conclusions. And it's really simple because everything I know is just based on experience and common sense, and you'll be able to see that commodities are much more common sense, especially when it comes to seasonality. Now, the definition of seasonality is really simple. Essentially, it's the same events that take place every year around the same time of the year, and excluding obviously reports that commodities have. So essentially, like every year winter will come, right? Like winter will come every year. It might be colder, might be warmer than the previous year, but winter will come, and then obviously you'll have a summer, you have a Thanksgiving, Christmas, so on and so forth. It's always the same thing. And this is why it's really useful, I guess, depending on how you trade. But overall, it's really useful for your own knowledge as well, regardless of how you trade. So let's begin with metals. We have gold, copper, and silver. And I only include the metals that I have experience with, because all my videos, including this video, is only based on my knowledge and my experience. So there might be much more to it, but this is what I use. This is what I know to profit from selling options on futures. All right. So, and these are the only futures or the only metal commodities that I sell options on, or ever sold options on. So the metals really, they don't have any seasonality. They don't have any like recurring yearly events. Like the winter doesn't really affect much, like the gold, the silver, or the copper. But and I guess this is in part because for gold specifically, it's more of a currency than a commodity. So
gold. So there's more futures contracts for gold than there's actual gold, like on Earth, or at least than there's actual physical gold at this moment. And this is because essentially gold is just a currency. It reacts to geopolitical tensions, to the stock market itself. So it's not a commodity that is heavily used like silver and copper. And silver is actually used in many practical applications. But again, there's no seasonality for silver as well. It's nothing that you can kind of follow and predict in a way if the volatility will go up and down, because this is the only thing we care about with seasonality. We care about volatility. Is it likely to go up, or is it likely to kind of stay the same or even go down? Now, copper is an industrial metal. It's used heavily, essentially in every single domain, from electric vehicles to real estate to anything really. And China is the biggest consumer of copper, and I guess a few times a year, when China reports its finances and future plans for its economy, for its real estate, for the yen, this has effect on the copper, and it can affect the volatility of the copper. But at the same time, this is not really seasonality. It's more of a reporting of yearly reports that you can expect to affect the copper. And for that, there will be a separate video specifically talking only about the reports or what reports affect each and every commodity and how. So for now, metals is something you don't have to worry about in terms of seasonality, and it's good to know, I guess, how each and every one is viewed currently by traders all around. Now, currency futures. So as you can expect, they have no seasonality, and like the metals, we have the CPI, PC reports, and other like reports that can affect the volatility of currency futures. But again, this refers more to reports, which will be in a separate video. So let's continue on. So this is the more interesting stuff. So grains, we have corn, wheat, soybean oil, and soybean meal. Now, obviously, we have the winter or the winter harvest. So this is where you have a lot of volatility in the grains. Now, it's different. It's a bit different for each and one of them. And in a second, we'll go over an example. But usually from April to July, every single year, the volatility will increase. And prices can be volatile. Sometimes they're not. It really depends on the year, but volatility will always increase between April and July, because the winter harvest is being done for most of the grains in most parts of the world where there's a significant amount of export of these grains. Now, so if we take a look over here, I'll show you an example on corn. So if we take a look, so let's go as early as 2014, or I guess 2015 it will be, or let's see here. Yeah. So usually you have elevated volatility. It usually starts from April, but it depends on the year, but usually it goes from April and all the way up to June, July, and then it kind of drops really sharply. But usually you have an increase towards April or towards May, and it goes all the way to July, and then just kind of goes down. See if we find a year where it's way more apparent. So this will be a perfect example. So you can see from April, it's gonna climbs up and up and up all the way to July. Then we have a big drop down, and it keeps on dropping. So it happens every single year. So it's really hard to kind of trade the commodity in certain ways, I guess. If you sell options, because when the volatility goes up, obviously when you sell options, it's kind of defeating the purpose of you selling the insurance on the commodity. So you can see the same thing over here from April. It goes up and up until July, and usually since July, well, at some point in July, it's gonna start coming down. So this happens basically every single year, every single time, and this is what I want to talk about when I talk about the winter harvest. Now, there's also a transition to the winter, so there's usually no significant volatility changes. Sometimes if there's really extreme cold, then yes, something might show up. And the way to follow is just to follow the news. So essentially, let's say for the winter harvest, I know approximately what time of year to expect it, but you have to follow the news. You essentially have to follow the reports every single morning, every single evening as well, and see what's going on. See the reporting that's being done on each and every, grain commodity or whichever one you plan to trade. Right? It's just a matter of following and reacting to what's happening based on how you trade. And for the winter, it's when we go, I guess, from summer to winter, it's the same kind of thing. If it's really cold, I mean, like extreme cold, like not expected cold, then it might affect the volatility. But usually, there's nothing significant that I've seen over almost 9 years now. Now, from July to December, usually volatility decreases, as we saw over here. So usually from July to December, it kind of decreases, then it kind of goes flat, and then we have the same cycle beginning where the volatility goes up and up and up. So usually between July and December, it's a perfect time. It's a prime time for short strangles, I guess, not just strangles. And this is really where the bread and butter is for most. Well, for me at least, for the grains. And from January to March, volatility can pick up, but it's usually pretty favorable for strangles as well. As you can see, in this example, from December, I guess, up until to almost the end of March, it's pretty flat for the most part. So you can kind of wait for a spike in volatility and go in, wait for a spike, go in, and you'll be doing just fine. Now let's go to the energy and the energy sector. So energy, we have natural gas and crude oil. So the winter for natural gas is a huge thing. So from around October and up to March, and again, it really depends on when the cold weather will pick up. Natural gas can become extremely volatile, and volatility is ramping up. And this is just due to the demand for heating during winter, right? Because in North America and in Europe, natural gas is being used as a primary source of heating, right? So there's a lot of demand, and like I said beforehand, anytime there's something with seasonality, something that has to do with a lot of demand, it can really skyrocket the volatility. So there's an increased demand, like there is with meats during Thanksgiving, for example, and the CVOL will go up. Now, crude oil is generally not really affected by winter, but volatility can increase here and there if there's extreme cold. So if there's an extreme reason for crude oil to something that can really affect the demand or the supply for crude oil, which is usually extreme cold, because then I guess machines and cars will be burning way more fuel, and then they will be needed. They'll need to fuel up way more often. So crude oil will be in higher demand, and it will be unexpected. Again, it's only if there will be extreme cold and it will be unexpected. So for natural gas, let's go just for an example to see what's going on from around October to March. So if we go to natural gas or nat gas right here. So currently, as you're watching it, I guess it's 2025. But as you can see, since October, we have just an increase in volatility. And, if you're watching it right as the video is out, you know how cold it is in parts of North America. It's extremely cold, and obviously you can see the volatility is being reflected. Now, if you go to the previous year, same thing you can see from October. Essentially, it's been going sideways for the entire summer, which is a talking point I'm going to go over in a second. But after that, I guess here from November, it kind of kept going up and up and up. And then usually as the cold dies down, the demand also goes down, and it's nothing too bad. So if you see over here, we have kind of the same thing. The demand is increasing and then decreasing towards the end of the winter. So again, it happens every year. It's nothing special, but the way I kind of use it is I don't really sell any strangles or natural gas during the winter months, and I follow the news obviously, and I follow the weather conditions and the demand for natural gas, which is really, really, really important because there was I believe, a fund that was managing $150 million, and they lost everything on strangle on natural gas just because there's a few reasons, but like a simple way for me to avoid this kind of loss is obviously having a stop loss, which they had, but they took it off. But also you don't, they lost on a position where natural gas went down by 70%, the commodity itself, right? And it was winter time because it was actually the previous winter in 2023, and it was not as cold as expected, so the demand was really not that high up, and the price just kind of tanked 70%, right? But you don't really know if the price will go up or down because the weather can change. It's unpredictable. It can be extremely cold or hot. You only know after the fact, really. But what you do know is, again, volatility will increase because demand is never ever the same as expected, right? So it's always going to be more or less, and it will create volatility. Now, from March to September, crude oil is usually very flat, and it's perfect for strangles. And in some years, it goes the sideways trend continues into the winter. And natural gas is also goes sideways most of the summer due to the lack of demand and the predictability of a non-cold weather. So I guess in summertime, you can expect not to have cold weather, right? It's either going to be hot or really hot. And when it's hot, you only use AC, which uses electricity for the most part, or for most areas. So you don't really need natural gas. So I hope that you can see some kind of, like trend that's going in here. So if there's no demand, if there's if there's easy predictability for how the demand might go up or down or not move at all for the commodity, you'll be able to to tell if it's a good time to enter the market with a short strangle or not. And as you can see, let's see here. I think we looked at this year over here. So so usually like after April, as volatility goes down, as the winter kind of ends, the price really just goes all the way sideways until, in this case, I guess mid-November, and then it breaks kind of this formation here and keeps on going up as it gets colder and colder. Which this year, like I said, 2023, it was actually the opposite. It was way warmer than expected, and the price tanked by, I believe, 70%. Yeah. So the price tanked by 70%. So the dotted line is the underlying. So it's the price of natural gas. So it tanked by 70%, and then it actually increased quite a bit and tanked again. But the point is, volatility increased in the winter, and during the summer months usually go sideways. The graph also usually goes sideways, and it's perfect for strangles. You just kind of need to pick your spots to to enter with at least some volatility, and obviously enjoy the profit. So this is it, I guess, for natural gas and crude oil. Nothing too crazy, but again, it's all kind of the same things. And when you just do it over and over again, and you look at the news over and over again, you can also know when to look for stuff, right? So natural gas, crude oil, you would look for news like closer to October, when the winter is in effect, basically. So let's talk about meats, which is essentially the last commodity that we have. So we have lean hogs and live cattle. Now, in winter, and this is a funny one, I just found out about it recently, but during extreme cold, livestock burns more energy to keep itself warm, and therefore it will become leaner, and this can affect the supply. So essentially, each cow or each pig or each hog, I guess, they'll just have less meat on them because they burn more calories to be able to, or more energy to be able to warm themselves up. And volatility can actually increase significantly because of it. And as you can imagine, it doesn't happen often where there's extreme cold to a point where this is actually a concern. But it does happen, and again, you just follow the news, right? So you don't have to predict anything. You just need to react to what's happening, and decide if you want to take on the risk to put on a trade in a certain way or not, right? This is just to aid you to make the decision, a better decision. Now the holidays are again very, very simple. So we have Thanksgiving. Oops, I'm missing a Thanksgiving. I'm missing a G here, but it's okay. So Thanksgiving, Christmas, and then I guess what other holidays people tend to buy a lot of meat. I'm not sure, but usually in the holiday season, there's more meat consumption, there's more family meals, so on and so forth. So consumers just purchase way more meat, and therefore the demand increases, and this causes volatility, right? So again, demand increases. We can see that the demand can fluctuate in an unpredictable way. Because it's Thanksgiving, Christmas, whatever the reason is, it's pretty clear that people will buy more meat, people will make meals. It's not something that can easily just change or not happen, right? And the demand can be essentially changed or affected by an unpredictable way, and this will cause volatility to go up. So if we expect volatility to go up, we don't sell options. I don't know if we buy options. I don't buy options, but overall, if I expect volatility to go up, I really don't want to touch the commodity. I just want to kind of wait and see for for something to happen, and then maybe react to it. And maybe when volatility is really high, maybe I can go in there and sell a call or sell a put for a really, really high price, have a really good stop loss, and then when volatility eventually goes down, just gonna profit off of it and off of theta. And this is basically also basically what I do in a nutshell, with strangles, with short calls and short puts. Now there's one more thing that I guess livestock count, which can affect the volatility for the meats. But again, this refers to reports, like I said, with the metals and the currency futures, and this will be in a separate video where we will talk all about reports. But this is basically it for this video. I hope it was really, really helpful, and for me, all this data, all this knowledge, just gonna help me either avoid a lot of losers or just take advantage of really, really, really good situations during the seasonality for each and different product. So this is it for this video. If you have any questions, please let me know, and I will catch you in the next one. Hi everyone, so this is a quick video about the major reports for each futures commodities product, and it's pretty important. I don't think I've made a video about it where I get all the reports, which ones to look for, and you'll see it's pretty easy, pretty intuitive, and there's really only a few of them. So let's begin. So for gold and silver, they don't really have their own reports that I'm looking at. I'm just looking at the pretty much the major news that come for the economy. They can affect mostly maybe CPI reports, maybe monetary policies, but there's nothing else specific for the gold and silver. Now for copper, so copper is mostly affected by the Chinese government. So what I did is I just went to the filter here and I just add China under the filter, and sometimes the copper might react or not react to the Chinese news, but generally speaking, we have gold, silver, and copper. They don't really have any specific reports that they are affected by. Now we have gas, natural gas, and crude oil. So crude oil, there are weekly inventory reports. Usually it's on Wednesdays. So usually on Wednesday, 10:30 in the morning Eastern time, and this report can definitely affect the price of crude oil. Usually, it doesn't, unless there's something really drastic in the actual versus the forecast. But again, usually not a big deal. But this is the only report I look at for crude oil, and obviously sometimes there are yearly reports from OPEC and stuff. So I just always go to the news and I always read news, and if there's a major report coming up, You can always look it up over here, or just Google the next big OPEC update or the previous update for crude oil, which is important because OPEC really controls the price of crude oil. Now for natural gas, there's the EIA, the weekly natural gas storage report. Here you can see the previous one was April 10, 10:30, and then the next release. And the time will probably be updated as we get closer to this date over here. But this is also something that can or cannot affect the price of natural gas. But again, this is weekly reports. Weekly reports usually don't really affect the price too much, so I wouldn't worry about them. But it's good to know when they're coming, and I think it's really important. Now, the other few things are just the grains, basically. So for the grains, it will be basically the USDA scheduled release dates for agency reports and summaries. So there's a bunch of different reports here. The biggest one that you look at is this one, the World Agricultural Supply and Demand Estimates reports, which is the WASDE report, which comes once a month. So this one is due on May 12th. And the other major report, or I guess not a major, but this is a weekly report, is this one, the weekly export sales, every Thursday, 8:30 a.m. So sometimes the time's a bit different. Sometimes it might be at noon. It depends. You just gotta look at it. But again, this report doesn't really affect the price too much. But obviously, I'm with my eyes on the screen when when this report is coming out. Sometimes something is pretty crazy there. So you gotta be on there to decide if you want to do anything with a position or not. But overall, not big of a deal. This report is usually pretty big deal, and I try to not have any positions during the report. Either open a position after the report, or way before, and close it before the report comes out. So this is basically it. There's nothing too much to it. It's a pretty quick video. And again, if you're not sure about some stuff, you can always go to the news here and on TradingView, and there are a bunch of there's soybeans rally extending ahead of the USDA the data release. So you can just click on it and you go, okay, well, there's a USDA data release. Okay, what is it gonna be? Let me Google it. Let me find it. This is how I found all of the reports over time, right? Via the monthly WSDE, which we just looked at over here. So this is exactly what you will be looking for, and this is how you would know if there's anything coming up for the commodity you want to trade. So hopefully this video was useful, quick and easy, and thank you so much, and I'll catch you in the next one.
Hi everyone, so let's talk about everything you need to know about commodities, supply and demand, and what affects what is more stable. So I'm going to go over each and every product that I trade, and this is all going to be based on how I trade, which is neutrally. I sell strangles, and this is maybe somewhat of a boring video, but extremely important of basically knowing when to be in or out of the market depending on what's going on with the supply and demand, because the price of commodities is basically all about supply and demand. Other than gold, crude oil, they can also just react to geopolitical tensions, regardless of the supply or demand. But other commodities are really stable or really follow the supply and demand chain. So just basically, let's go over the basics. If supply goes up and demand stays the same, the prices will go down because we have the same demand, but we have way more supply in the market. So very simple. Price will go down. If supply goes down, the price will go up because you have demand for the product, but you have less of that product available because the supply went down. And if the demand goes up, the price also goes up. If the supply stays the same, but the demand goes up suddenly, the price will shoot up because, again, there's more demand and there's not enough supply to satisfy the demand. And then if demand goes down, the prices will go down as well, assuming the supply will stay the same. So I think it's all pretty self-explanatory. And I guess the key thing is most volatility in commodities is a result of an issue or a disruption with the supply chain. So mostly there are issues with the supply chain and not with the demand. The demand is usually pretty stable. However, sometimes demand is definitely the main factor, like with natural gas. And again, I'm going to go over each and every product
and explain each and every one of them and how they work. And I promise you, it all just makes sense. It's all pretty simple. It's not like stocks where nothing makes sense, where a company can have a pretty good earnings report and then the price will go down. It makes no sense at all. Here, everything is very logical, and if you follow the logic, you'll be doing really, really well in the commodities market. So the supply and demand of products. So let's go over all the products that we have. So let's begin with gold. So gold, it's a bit of a different commodity. It acts more like a currency rather than an actual commodity. However, China, US, and Australia produce the most gold in the world. So you can imagine gold is pretty regulated. The gold mines are pretty, pretty stable. Not much going on with gold on the supply and demand chain. It's really stable on both sides, on supply and on the demand. Gold is viewed more of a safe haven. So when things are not okay with the stock market or there's some geopolitical tensions, gold tends to react to that. So gold and silver and probably crude oil are somewhat of a mixture of supply and demand and also geopolitical tensions and different situations. However, gold is definitely the heaviest one out of the three. It's really way more reactive to news and stuff like that. Now, silver, it can act as a safe haven. So it's basically like the little brother of gold. So it doesn't really act the same exact way. But silver is way more, like 68% of the use of silver in the world is for industrial use. And then the rest is obviously more of like a precious metal where people just store their value. Where gold, I don't know the exact percentage, but I'm sure gold is mostly used for store value and not for actual application. So, but silver is definitely used for really everything, from cell phones, computers. There's silver in everything. So it can definitely act as a safe haven like gold. But however, Mexico is the single biggest producer and exporter of silver, which is really important to know which country is exporting and producing what. Now, there's a big difference between a country being the biggest producer and exporter, because China, they have a lot of people. They have, over 1 billion people. So they definitely produce the most amount of whatever commodity, right? But it doesn't mean they export. It doesn't mean they're the biggest exporter, because most of what they produce, they use within the country. So this is also pretty important to distinguish. So Mexico is the biggest producer and exporter of silver. So you can imagine whatever happens to Mexico to the silver mines really affects the price of silver, right? So again, silver is definitely more reactive to the supply and demand chain, but again, it's really stable, and usually demand rises slowly for silver year over year, and also the supply is it's pretty heavily regulated, right? Because nobody wants the price of silver to crash if for some reason someone found a bunch of silver, right? Then, like we said, it will be way more supply, the price will go down, and this is not in the interest of the mine companies. So silver and gold will always be pretty stable. Now, copper. So copper is definitely a heavily used metal, and the biggest copper mine in the world is in Chile, and they are definitely one of the biggest producers, I think, exporters, of copper. So it's Chile and Peru, but Chile is definitely the single biggest one. And you can imagine if something happens to the copper mine, which it did happen in 2024 in March. The one of the copper mines collapsed, and you can imagine if we have the same amount of demand, but supply suddenly goes down, the price shot up quite crazy, and this is the reason why. Again, it all makes sense, right? So also it did not happen overnight, right? So there were reports of the mine collapsing. Now nobody really knows right away how bad it is, so the price reacted a little bit, and then you follow the news, see what's happening, and then the news slowly broke that the mine is fully collapsed or whatever it was, and it will take quite a while to get up and going again. And on the other side, the biggest copper consumer is China. So China, they make everything, so they need a lot of copper, and their real estate is massive, which copper is also being used in real estate, in electrical, and in everything really. So it's a pretty solid commodity. So the two things that can affect the price of copper is, if anything happens to one of the mines, which is pretty rare, but it can happen. But mostly if something happens to China. So if something happens to the economy of China, it will heavily influence the price of copper. And more than often, if you follow copper, you'll see sometimes the price goes up because there are fears that the economy of China is slowing down and they might not consume as much copper. So copper is definitely mostly affected by the demand from China, and because the supply is usually pretty stable. But again, things like that happen when a mine can collapse. So natural gas. So US and Russia produce the most natural gas in the world, and they also export most of it. Now, the biggest demand is from Europe and North America at winter time, as natural gas is used for heating households, right? So, in Europe, in North America, we use natural gas for heating. So there's a lot of demand during the winter, and this is basically what can affect the price. So the demand, the supply is usually pretty stable unless there's like a geopolitical situation, war, whatever it might be. Then the supply might get disrupted. But the most of the demand for natural gas, or for what moves the market, is depending how cold or warm the winter will be. And this is hence why natural gas is usually pretty volatile during the winter, because sometimes it's a really cold winter, sometimes it's a warm one, so the price can really fluctuate based on the demand, because the supply usually sometimes it cannot keep up, sometimes there's oversupply, so there's no really way to know exactly how cold of a winter it will be. So this is for natural gas. I think it's pretty so far it's pretty simple, completely makes sense. So you would know what to look for. And this is also why during summertime, natural gas is pretty much flat. It just goes sideways, like pretty much every year, which is perfect for strangles, for how I trade, which is why I love it, and which is why I stay away from natural gas during the winter time. So it's starting October, I'm not even touching it, right? And this is because natural gas is heavily used for heating for households. Now, crude oil. So the US, Russia, and OPEC, which is not a country, but it's a collection of a few countries that produce a lot of oil. They definitely produce the most oil in the world. And OPEC basically can just control the price of crude oil easily. They can easily announce that they're increasing their production of X amount of barrels per day, and then the price will drop because there's more supply. And I guess the same with the US and Russia. They can also announce this, that they will increase the oil production. They can easily do it. Again, it's all really regulated. Well, not regulated, but controlled. It's really easy to control the price of oil for these super houses, right? But this is usually what controls the price of oil, and oil is also reacting to geopolitical tensions. Usually, it might go up, might go down. It depends on what's going on. But the supply side is what really affects the price of crude oil. And again, usually OPEC, they are probably the more aggressive ones. They are usually trying to keep the price of oil within a certain range where they know they're maximizing their profits, and they're not overcharging or not undercharging people. So basically, for them, it's all about making the most amount of money, where they know, at $45 a barrel, they are likely to make the most amount of money, because this is where people are, feeling that the price is okay, and they will buy more, oil, or purchase more, crude oil, or use more gas for that price. Now, US and China are the top oil consumers. So obviously China is one of the biggest countries in the world. They, again, make everything basically. So they use a lot of oil, and the US as well. They also use a lot of oil. So this is on the demand side. But again, the demand is usually not that important for crude oil. It's mostly the supply stuff, and the geopolitical tensions, if there are any. So let's go ahead and take a look at the other products. So this will be all grains. So ZW wheat is Russia is the single biggest exporter of wheat in the world. So with wheat, the demand is pretty stable. We need wheat for everything basically, and we can make a lot of things out of wheat. And if something happens to Russia, you can imagine the price of wheat will react accordingly. So this is for the supply and demand of specifically of wheat. Demand is pretty stable, and wheat pretty much reacts to disruptions to the supply chain. Corn, U.S. and Brazil combined export 50% of the corn in the world, so quite a bit. And Ukraine is a big exporter of corn to Europe, right? So which also matters because Europe is a pretty big player, a pretty big consumer. Even though Ukraine is not one of the biggest exporters, they are, I think, the biggest or one of the biggest exporters of corn to Europe, which is important, right? So corn again, grains are all influenced by the supply and not by the demand. The demand is always stable, unless something crazy happens, some kind of regulations pass through. But usually it's only because of the supply. If there's some kind of disruptions to the supply, if there's a drought in Brazil, or if something happens to the crop, then it will it will influence the supply, which in turn will affect the price. So soybeans, soybean meal, and soybean oil are kind of the same thing. U.S. and Brazil, they export the most soybean in the world. Soybean meal, Brazil and Argentina, they're the biggest exporters for soybean meal and soybean oil. So these are essentially, if there's too much rain or there's floods in right around the crop of soybean meal and soybean oil in Brazil or Argentina, this is usually what you would read about when you see the price of either one going crazy. This is we'll have probably to do something with Brazil and Argentina most likely. And this is about it. I mean, this is pretty simple, and like I mentioned, demand for grains is very, very stable. So the only issues arise from the supply side, which is bad weather, like we said, if something happens. Now tariffs can also definitely affect the supply, and geopolitical tensions, of course. But again, the grains, they are pretty much only affected by the supply, or the price is only pretty much affected by the supply. Demand is pretty stable, and there's no surprises in the demand for the most part. So hopefully this video was pretty useful to you. I mean, I think it's really, really important to understand what affects each commodity, and what are the biggest exporters of each commodity and producers, and so on and so forth. And this can definitely only enhance the trading, and especially you'll be able to make, I'm able to make much better decisions because I just have those, this basic knowledge, and then that's pretty basic in my opinion. It's not advanced in any way. Anyways, thank you so much for watching, and I will catch you in the next one. Hi everyone. So let's talk about what products you should not trade together in the commodities market, and let's talk about all the correlations we might have and how they change based on the season and based on the winter or the summer or any kind of geopolitical situations. And also talk about specifically the volatility correlations, which is also a pretty important thing, in my opinion, which is definitely overlooked. So this is somewhat of a, I guess, boring video, but really important. It can really make a huge difference for your trading. Now, this is my strategy. So this is exactly what I do. I'll go over it very quickly, and if you watch any of my other videos, you can just kind of skip it with the markings below for the player on YouTube. So it's basically, I usually trade 90% of the time, or probably 95%, just a short strangle, but I can definitely sell some calls and sell puts, but it's always going to be short. I'm always going to be selling options and getting the premium. So I usually look for 45 days or less, but lately I've opened a position with 105 days because this is where the best deal was at that moment. So I'm always looking for the best opportunity where the risk is worth the reward, and I will definitely try and stay at 45 days or below. But this is just kind of a rule of thumb, but obviously it depends on the situation, and in some situations more days to expiration will make way more sense. Now these are the products that I trade. So these are basically all the futures options that are liquid enough, I guess, to trade with bigger amounts. So these are the ones that I stick to, and these are the ones that I have the most experience with. And short strikes are always delta 20 for short strangles, and about delta 35 for calls and puts. Now, profit target is always at 50% of credit. Loss target is 50% of credit as well. So I risk one to make one. My win rate is about 93%, but I'm very, very picky because I used CVOL for good entry, and this is just the commodity volatility index. And I'll link the video for it below. It's a really important, really useful tool. It's basically the Bible for option sellers in the commodities market. Without this, you cannot make any informed decisions. Now, my exit rules is I exit when either of one of my targets are hit, profit target or loss target, and I forgot to mention my loss target is dynamic. Basically, when the profit is about 25% of credit, I move my stop loss to a loss of 25% of credit. Then when I'm about 40% of credit, I move my stop loss to 10% of profit of credit. So just kind of lowering my risk as the position is getting better and better and more profitable. I can exit the position in 21 days to expiration. Now, usually we never get to that point, but if we do, I definitely don't want to stay in a position. But again, I might stay another day or two. It really depends. But these are kind of things to kind of keep in mind when you open a position and when you want to exit a position, or when you get, if the position is barely profitable 21 days, then, there's no point keeping the position open. You can just close the position. But if you're like almost at full profit target, maybe it makes sense to wait maybe another day or two. So it depends. But overall, 21 days to expiration is a good number to be out of a position by. Now, I might adjust the position if needed. Basically, never do it. I might do it, but if it makes sense. But usually, I never ever do it, and I can exit early if it's at the end of the year or something unexpected has happened that can affect my position. Like some kind of geopolitical tensions or some kind of policy changes in different countries that can affect the commodities. And again, very important, I always just look for the best possible deal or a good opportunity, or the risk is worth the reward. So this is what it's all about. Now let's talk about the correlations and what are futures correlations. So basically, it's two or more different commodities that have a similar price movement normally and during news and reports events. So basically, it's really simple. So let's say you have a position open on corn and on wheat. So this is basically two products that have a lot of correlation. Now, not always, the correlations always change. They can increase, they can decrease, they can stay the same for a while. But as a rule of thumb, and I'll go over exactly what products to trade together or not to trade, or at least what I'm doing, and that has been working for me for the past 9 years. But basically, you want to avoid just being over leveraged by having two positions that are affected by the same underlying supply and demand chain or supply and demand issues. So this is exactly why it's important, right? Because corn and ZW, they're both are likely to do the same thing or move in the same direction, and we just don't want to be over leveraged, and we want to have some diversity in our position, right? So it will be much better off to have a corn position and maybe a gold position. If something happened to corn, for example, and or something happened to the corn supply and demand chain, or there's less demand, or whatever it might be, gold is likely not to be affected because there's barely or any correlation in between them, right? So one position might be losing and the gold position might be winning, right? So it will overall increase your account stability, which is really, really, really important for your Sharpe ratio. And overall, I guess, just you want to be able to keep your account as stable as possible and grow it slowly but surely. And correlations is just a huge thing for me, because you can make a lot of money if you completely avoid correlations, but you can also lose a lot of it very quickly. Now, like I said, correlations, they change over time, and it's based on seasonality, and I'll talk about it again in just a few slides. And again, correlations are the key for account stability and help massively to decrease risk and leverage. So let's talk about all the commodity correlations, and this is basically the way I trade them. So we have gold and silver; they're both pretty highly correlated. So I will never ever trade gold and silver together. I will trade one or the other, probably gold, because this is the one that I have most experience with. Now we have corn and wheat, we just talked about it. So I would only ever have a position on one or the other. We'll never have positions on both of them. We have soybean meal, and soybean oil. So I will only, again, ever have a position on only one of them. Now, sometimes the correlation in between these is not big, and you can get away of opening a position on soybean and then soybean oil. But again, as a rule of thumb, I will probably never ever do it, because you don't know when correlations will become higher, and if you're mid position, it can really hurt you, and this is just not a smart kind of like gamble or smart risk to take. Same with corn and wheat. Sometimes they go in a completely different directions, but it doesn't matter at the end of the day, because you don't know what's going to happen. But historically they have a pretty good correlation. Now, let's talk about corn, wheat, soybean meal, and soybean oil. They have a high correlation around April to July, and so during these months, I probably won't trade any of them regardless. But this is my explanation on why they have a pretty good correlation during April to July every year, because this is when the crop harvesting and planting takes place. So this is where essentially things become really volatile. And next slide will be exactly about that topic, about volatility correlations. But this is also tied to seasonality, which is another video I made, which is really important, because seasonality is a big thing for grains. And we want to avoid just low probability trades. So from April to July, I don't trade any of them. But especially if you have some kind of insight or whatever it might be, trading two or more products from the grains during April to July might not be a good idea, because you'll be over leveraging and you might just get yourself into a bad situation. Now, we have natural gas and crude oil. Generally, they have a little correlation, because this is the energy sector. So as far as you can see, it's based on the sector. So we have metals, we have the grains, we have more grains, the soy grains. Then we have, this is based a little bit on seasonality, about April to July. Then we have energy. And energy products, they have little to no correlation, but during extreme cold weather, they can definitely have much higher correlation, which is just kind of my point. Is some certain events in the world, it can be really cold weather or something really crazy. It can really affect the correlation across multiple products. And usually when something bad happens in the world, correlations tend to rise. Now we have, so just to be clear, I will definitely trade natural gas and crude oil together at the same time, because they have little correlation. Unless it's winter time, and in winter time I don't trade natural gas regardless, and usually there are no good opportunities on crude oil either. So winter time is definitely is not the best time, I guess, for the energy sector, because it's more volatile and correlations can really rise up. So now we have LE and HE. So these are the meats, lean hogs, live cattle and lean hogs, and generally they have high correlation to each other. But again, sometimes they just go in completely opposite directions, and this is not something that can signal me, hey, I can open a position on that and on that, because again, this is all livestock, right? They like a lot of times they are being like grown together, right? So if something happens, if it's really cold, both LE and HE will be affected, even though their prices might be going in a different way. And when something happens, correlation will rise, especially for the meats as well. And again, it's usually weather is a big thing for meats as well. Same with energy sectors and with the grains. Now we have the currency futures, and they have really high correlations to one another, because they're all measured against the US dollar. But there's way more factors at play. And these are not really commodities, I guess. Commodities are more, I guess, like actual food and stuff, and energy. But this is also something that I can definitely trade, but I will never ever have a position on, let's say, the US or the Canadian dollar and the euro at the same time. It's only going to be one or the other, regardless of the time of the year or the season. I will probably never ever ever open two positions at once from the currency futures. And as I mentioned, during major events, correlations rise extremely quickly. Prices might or might not go up or down. I'm not sure, but volatility will definitely increase across all products. So let me give you an example. So when the conflict between Russia and Ukraine began, corn and wheat they had a significant increase in price and in volatility, and basically they were moving the exact same way, right? Because Russia and Ukraine, they export over 25% of I think the wheat in the world, and over 30% of corn to the world, right? So there were major concerns of the supply chain being disrupted, therefore the the price went up, and of course when commodities crash upwards, volatility goes up quickly. So these are the kind of major events you can kind of be thinking about for specifically, I guess, for corn and wheat. And this is not something that I just basically I always run in my head and try to figure out what's going to happen if one country does this to another country. When that happens, you just react to what the market happens or to what the market does based on what happens, based on the news, and you're just gonna pick your spots and do the best you can do, right? So there's no way to predict what's going to happen, and it's not our job as traders to do it. But using correlations, you can dramatically decrease your risk. If, for example, you have a position on, in your portfolio on gold, where at the same time you might have one on wheat, on soybean, on natural gas, and maybe one of the meats, right? This is a really, really well diversified portfolio, and where you have little risk, basically. So if one position goes really bad, you have the other ones that are profiting, right? And this is really, really key. It helped me out so much, and definitely changed my perspective on trading, because a lot of people are really, really heavily dependent on only gold, or maybe they only trade like the SPX or DS, and they're extremely leveraged without even understanding that all they have in the position is the S&P, or things that are correlated to the S&P, right? So something happens to the S&P, or something global happens, the S&P reacts, and all of their other positions react at the same time, and this is just not a good thing to go through. So last but not least, let's talk about volatility correlations, which is really important. Now it spills over a little bit to like reporting and reports on different commodities, and obviously on the economics of the US and other countries. But I think it also has a place in this video. So let's talk about it and see what how this can also help us potentially make some good decisions. So volatility correlations is basically when a known or surprising event causes volatility to increase across different products at the same time. So if we have the CPI, the GDP, or the Feds, they're lowering rates, so on and so forth, or something major, something that is not scheduled, like the CPI or the GDP, something like the Japanese stock market crash, right? These events will cause increase in volatility for gold, silver, all the currency futures, and sometimes even crude oil, because crude oil sometimes acts more of a currency other than a commodity. It really depends. Gold definitely acts completely as a currency and not as a commodity. Silver is so and so because it is pretty useful in many applications. Gold is just more of a store value at I guess at this point when I'm making this video, and these are the things that can affect those few products. Right now we have, like I talk about, the seasonality for the seasonality volatility for corn, wheat, soybean meal, and soybean oil. And volatility will increase during the harvesting season, which is usually from April to July. And it's different. It's every year is different. Sometimes it affects it more. Sometimes the volatility goes up not as much. But you can definitely bank on it that the volatility will increase during these months, and it will increase across all of them. So again, I don't know where the price will go. The price of each and one can go in different ways. It can go up, down, it can stay the same, but volatility will uniformly increase across all of them most of the time during these months because of the harvesting season. So this is what I mean when I talk about volatility correlations, and not just price correlations for the commodities themselves. And I know it's a bit confusing, but it's really essential. And once you get it, it's gonna be much easier to kind of navigate around. Now, LE and HA, obviously they're correlated by price, but they're also correlated by volatility. And things like Thanksgiving, Christmas, where people when there's way more demand, I guess, for livestock, for meat, people just buy more meat, I guess, at a store for the meals and so on and so forth. So the demand increases. Usually price increases as well, not always, but volatility definitely increases every single time up until after Thanksgiving and then after Christmas. So this is about the meats. Now, major events that affect the US dollar will cause volatility increase across all products. It's really rare. So a good example will be, if the Fed is gonna just print an unimaginable amount of money and inflation will be crazy, because basically everything is measured against the US dollar, it will get affected one way or another. Or if it's not affected by price too much, it will get affected by volatility. But again, this is very rare. Rarely happens. It happened in COVID to an extent. wasn't too bad at all for me specifically, I guess. I was well diversified, and some positions took hit, but some other positions just didn't really flinch. But volatility did go up, so it kind of hurt the position, even though the price of the underlying did not move. So this is it. Let me know if you obviously have any questions. This is a boring topic, I guess, in a way, but really important. Will definitely help you make some good decisions and put you on your path to profitability much sooner than if you would have avoided the correlations and the volatility correlations, and what products to trade and not to trade together. Hi everyone, so let's talk about the commodity volatility index, and in this video I'll explain exactly what it is. Now this is only specifically for futures options and for option sellers specifically, but this is basically the Bible for option sellers, especially if you trade neutrally like I do. It can be extremely helpful. So let's get into it. And first of all, let's talk about my strategy, and I'll be putting it at the beginning of every video from now on. I guess a few people just gonna ask me for that, and I think it's a good refresher. And just so you know exactly why am I making the statements that I'm making, it's all based on my experience and how I trade. So it might be right or wrong for someone else, but it's working for me. So I basically trade like mostly short strangles, and I can definitely sell some calls and some puts. It really depends on what I'm getting. So I'm just looking for a good deal, basically, for a good opportunity and to take advantage of it. It can be in a downtrend and an uptrend, or it can be a sideways movement. Now, generally, I'm looking for 45 days to expiration or less. This is where theta is the biggest. But here and there, I can definitely go above it and go like up to even 100 days to expiration, maybe even 105, 110 days to expiration. It's just because sometimes you can really get a really good deal there, and those longer expirations, they are not as affected by volatility. Basically, it's more of a slower paced trading. It can be 30 to 40 days in a position, so it's a bit long, but at the same time, it depends on the opportunity, right? So I'm just kind of looking to see what the market gives me, and I'm trying to use all the tools at my disposal, which is my strategy and or strangles or calls and puts, and I'm making my trades. Now these are the only products that I trade for futures options. So basically all of these are the most liquid. These are the ones that I have the most experiences in, and these ones are the one that just worked pretty good for me. Now my short strikes are always going to be anywhere between delta 20 and 35. So delta 20 is usually for the short strangles, and for the calls and puts it will be about delta 30, 35, because you just need to collect more premium there to have somewhat of a good stop. My profit target is always 50% of credit, and my loss target is also 50% of credit. So I'm risking one to make one, and my stop loss is dynamic, which means as soon as I'm up about 25% on my position, I will move my stop loss to a 25% loss. And I'll make a specific video about my strategy because I think it's really important. Basically, it's just the mechanics of how I manage, I guess, my position. And I'll always use CVOL for good entry, which is exactly what we are going to talk about today. The commodity volatility index. It's a game changer. It changed my trading forever. I think I discovered it, right after COVID in 2020. So it's been incredible. I trade way less, and I profit way more. Like my win rate it's over 93%, which is really amazing, obviously. And I barely lose trades because I'm only going for really good opportunities, and I'm patient enough to wait for them to show themselves. So the exit rules is either the targets will hit, so either the profit or the stop loss. I will exit at 21 days to expiration, because if at that point we don't have the full profit, or we didn't exit the position on the targets, then we should probably exit the position. We have a lot of gamma after 21 days, so I don't want to be in a position. Now I can adjust the position if needed. Really rare. I usually never adjust the position. I'll just take the loss or the win or whatever it might be. Really rare for me to adjust the position, and I can definitely exit early. So even like before the 21 days to expiration hit, due to certain reasons. There might be a report, maybe the Fed's decision to lower rates or whatever. And again, I'm just looking for a good opportunity, and I want to take advantage of it. Basically, where the risk is worth the reward. So that's my approach. I'm not looking to have a position open all the time. I don't want to sell puts. I don't want to do the 112 or whatever it is. In my opinion, this is just complete ignorance, because there's no such thing as doing the same thing over and over again and just continuously profiting in the market. The market exists to the ones that really survive and the ones that really thrive in the market, I believe, are the ones that can recognize a good opportunity and take advantage of it based on using their experience and the tool bag that they have. So strangles, calls, puts, whatever, managing stop loss, it's all just tools and different ways to manage a position, right? It doesn't really tell you when to enter and when not to. But the commodity volatility index, it will definitely tell you exactly when to enter and when not to enter. Well, at least for me it does, and hopefully after this video it will help you a lot, same way it helps me. So the CVOL is just the commodity volatility index, the Bible, and it's just a volatility measure of for the CME commodities, and we'll go over them in a second. So it's basically all the commodities that I listed that I'm trading. And you can also think about it as the VIX for futures, for each individual future or commodity more specifically, because it doesn't include the ES or the RTY. Now let's talk about how it actually helps in trading. So based on the CVOL, we can deduct if the price of options is relatively high or low. And because we sell options, we want to sell when CVOL is relatively high to collect more credit, and obviously possibly we can profit from the CVOL going down while in a position. So basically we want to sell our options for as expensive as possible relatively, and once they go down in value due to theta or due to CVOL going down, we can really close them out for some profit. So this is the basic idea, and obviously I don't think it's anything new, but I think it's worth repeating because as basic as it is, this is really the whole premise of selling options, of selling premium. You want to sell really expensive, you want to sell overpriced options. This is exactly the only thing that you want to do. And then obviously you have a way higher chance of profit. So when you sell with a high CVOL, your probability of profit shoots up significantly. From my experience, it shoots up. Specifically based on how I trade, my profit probability should be around, I would say, 70% win rate, 70 maybe 75% win rate based on how I trade, because my stop loss is pretty tight, it's 1-to-1. But because I use CVOL and I enter when the options are really overpriced, my 50% or 50% loss on credit is actually give me a really wide range for my stop loss, or for my stop loss to get hit. So this is how I use the CVOL, and it brings my probability from about 70 to 75%, which what I'm supposed to have. So actually about 93%. So I rarely lose trades. It's really tough to lose a trade when you sell overpriced options. Something really crazy has to happen with the commodity for it to kind of keep going crazy on you, and for the options to become more and more expensive after you're already in a position and get to a point where you're down 50% of credit. So basically it has to overcome CVOL and has to overcome the theta, which is obviously really unlikely, and the odds are really in your favor in this case. Another way the CVOL can help us is basically it can help us with seasonality detection. So CVOL can clearly show us if there are specific periods every year where volatility is much higher, and it's pretty clear. And I'll show you an example with corn, and I've made a video about seasonality, and it's super clear there, and CVOL can definitely show you exactly what's going on. Or if we're heading into the winter with natural gas, demand tends to increase or sometimes doesn't, but volatility will definitely tell you, hey, something's going on. The price is more volatile, like way more volatile, like relatively to the summer or relatively to the previous winter, so on and so forth. And you can get so much information from it, and it can, really. If you think about it, you can enter bad positions when CVOL is really high, and you will be extremely profitable, way more profitable than the trader that does not use CVOL to enter the position. It's crazy. You can be really wrong and still profit significantly if you just use CVOL and enter when volatility is relatively high. And for me, I always I always look at CVOL first and then at the graphs. So I don't really care what's going on in the graphs. I will always look at CVOL, and then from there I will kind of make the decision. Okay, it might be a good opportunity. Let's see what's going on in the graph, and then let's see what kind of position we can open up. So CVOL basically tells you if there's a sale in the store. But for us, I guess for option sellers, we need the prices to be higher to benefit. So it's kind of the other way around. But you get the idea. CVOL just tells you, hey, there might be an opportunity here. So let's take a look, and let's actually look at what the CVOL looks like. So it's just the CME website. So you can Google CME CVOL. You'll find the website right away. I'll link it in the description as well, just in case. But basically, it's free. Now the data is delayed by about 15 minutes or 10 to 15 minutes, I believe. And after I believe 6 p.m., I think it's not displaying any more data. Or after 4 or 5 p.m., it doesn't display any more data, and it will display data starting midnight, basically. So let's take a look. For example, see what is a good example right now. So let's go to soybean meal. You know what? Soybean oil. Soybean oil should be a good example. So when you open up the tab here, so this is how you would basically go and click to see what's going on. So you see a dotted line and you see a smooth line. So the dotted line is just the price of the underlying or soybean oil. So I usually just shut it off, and I usually put it on the 1 year just to kind of see what's going on. Shut it off, and then we can go and see, where is the CVOL currently relative to the past 3 months and then 6 months, and kind of take a look. So if we take a look relatively at the last 3 months, CVOL is right around over here, which is 39.71. The number is right over here, so 39.71, and relatively it's pretty high. So it's definitely in the upper 75% or the upper 70% of the range for the past 3 months. So this would have been the highest point the past 3 months, and currently we are here. So it's a pretty high CVOL, which is exactly what we want. So at this point, for me, it will be definitely no no hesitation. I would go and look to see if I can open a position on soybean oil, and I actually have an open position on soybean oil. It's a strangle, and I'll show you exactly what it looks like in a second. But basically, after I look at the 3 months, and I just gonna make sure it's relatively high. So if CVOL would have been, for example, at 38, I would have not want to open a position. I would have probably waited. And if CVOL obviously anywhere underneath it, I would have also not opened it up. So basically, you want it to be on the upper 65-70% of the highest point before. This one is pretty clear. It's relatively high. I mean, it can go higher, obviously. Yeah. Anything can go always higher. And from my experience, I've learned that waiting for it to be absolutely the highest is definitely not the best thing, because sometimes it means that something really major has happened. And for us, again, we're just looking to get the best possible deal. And from here, we just go on and take a look at the 6 months, and I see, okay, well, relatively to the 6 months, it's really high. Like it's up there. It's up. So this is the lowest point. This is the high. This is the where we at right now. This is the highest point. Really good. Really good. And you can take a look at the 1 year as well. We are really high. So CVOL is really good. What I really care about is the past 3 months, give or take, and maybe 6 months, depending on the season and on the commodity. But for the most part, 3 months and 6 months is what I look at, and this one looks perfectly fine for me. So from here, for example, I'll just go, and we have this position open. So we just opened the position. Just see, watching this video, what is it? Just a few days ago, basically. I didn't even write down all the numbers for it yet. But basically, our stop losses are at 39.09 or 39.08 and 51.2. So this is a skewed strangle, and it was done on purpose because I wanted essentially to have a range where the price was moving within it for, well, over a year, so since October 2023. And yes, it did exit the range here a little bit, but still overall this is a massive range. Yes, I opened the position with 105 days to or 102 days to expiration, I believe. But this was the best deal at right now at this moment. So I follow the news closely and see what's going on. You also want to kind of know why the price went up. So the price went up here basically on Friday. So on this day, the monthly USDA report or the WSDE report came out. So it's basically just shows the exports sales for 2024, and I think there's some data for 2025 as well. It just basically gives you an idea of supply and demand for the soybean oil. So what I look for in this report is to see if there's anything fundamental wrong with the supply and demand. So basically, let's say we have 20% of the crop just died due to some kind of parasite, right? So this is really serious. So here, the price jumped up and volatility jumped up just based on the exports are being way smaller and sales being way smaller than expected by analysts. That's about it. So nothing fundamentally is wrong with the supply and demand chain or with anything with soybean oil, right? So you also gotta understand the news, and I'll make a separate video and section for the news because it's also a big thing about trading the commodities, understanding the supply and demand. But these are my stop losses. These are not the strikes. And you can see the price has been moving within this range for quite a while, so over a year. And I made the decision to open this trade. Also, actually, I think when we opened the position, volatility, the CVOL was a bit lower, just a tiny bit lower. I think it was a bit lower, and it went up today. And even though the position currently is about plus 44% actually. So this also tells you a few things about the expiration. It's not as sensitive to volatility change, which is good and bad, but at the same time, I feel like we got a really good sale or a really good deal, I guess, because we used the commodity volatility index. and you can imagine just just simply looking at this, people that don't really look at it can enter a position, when they're here or anywhere along that line or anywhere along this line, right? So if you open a position here, the price might not move, but volatility keeps going up. You're screwed basically, right? Because your position is going to get more expensive and you'll be losing on it. Plus the price moves like crazy, right? So this is why you need to be opportunistic when you trade, specifically futures options. And this is how I trade again. So I only speak from my own experience, right? There's probably many other ways to be really good at this, but this is what has worked for me for the past 9 years or 8-9 years. And I've been doing quite well for myself. And so basically we look for something to happen. Which is I don't look at news first, right? This is what I do all day, or at the end of every day. I just go through every commodity. I see what happened. I see, okay, which one has increased the most? What happened? Is there anything fundamental wrong? Yes or no? So this is basically corn. So this is a good example for seasonality. So for corn, we know we have a seasonality where usually closer to April and May, volatility really increases because of the crop harvesting, and then it goes down around July usually and keeps going down up until we get to so same over here. Since July, this is 2023. It went all the way up actually since April. And then all the way down, and it just kept going down up until February, March, and then obviously we have the same cycle all around. Now it's not exactly the same as the previous year, but volatility was way higher in 2023. Now 2022 we had this conflict between Russia and Ukraine began, right? This is also something really interesting, and I'll talk about it. So you can see volatility really going up as the conflict essentially unfolds. And then it goes down, and then also went up over here because of some agreements and some lease agreements about the exports of wheat and corn. But it just shows you the picture way clearer. So you know if you're getting a good deal or not. And if you're not getting a good deal, you just gonna sit and wait because opportunities will come. They always come. Volatility will always appear in the market, and especially when we have so many products. So this is basically it for the CVOL. Hopefully it makes some sense to you. I know it's not as intuitive to read the graph for CVOL, but you definitely will get used to it. And again, you just look at the relatively, is it high or low? So here clearly, relatively, if you look at, let's say 6 months, it's pretty high. It's not the highest, and it will never be the highest, right? So it's all about being relatively high or relatively low. And let's go over every single commodity and just clearly say, is it high or low relatively? So you can see here gold it's a decline, so it's relatively low, right? This is the highest point for the past 3 months. This is the lowest, so you can tell this is the bottom 50%. Past 6 months, even worse. So you can clearly tell this is pretty low volatility. So a good volatility here will be for me probably somewhere around here. Probably I will be somewhere around this range. I will be really comfortable getting into a trade, given that we have a good trade. Let's go next. Let's look at copper. So for copper, if you look at the 6 months, or the 3 months, it's relatively high. Yeah, it's pretty high. Now, if you look at the 6 months, it's kind of in the middle, right? Kind of in the middle, but some of those spikes are events that happen. So August 5th is the Japanese stock market crash, right? And I don't remember what happened on August 26th or 27th, but these are outlier moves, right? So you can't really count them in your relative volatility kind of calculations, right? So this is why I like to look at the previous 6 months, 3 months mostly. This is pretty high, so I would definitely consider to open a position here, and actually did. And the ranges to the stop loss were not good enough for me, so I decided not to open any position for now. We'll see if CVOL will increase even more. Might open a position, we'll see. But this is a good CVOL. This is a good CVOL, and also another big giveaway that you have a good CVOL is basically you will have a very good range. So because if CVOL is high, you get a lot of credit, means your distance to the stop losses will be extremely wide, right? So here you can see, I was able to get a distance where the price has been moving within this range for over a year, right? So it's a really good sign, right? If you're not sure if the CVOL is high enough or low enough, right? So for copper, let's see, is this copper? Let me actually show you with copper. So with copper, I just did it today. So this is the range for copper with 102 days to expiration, delta 25 strangle. So it's definitely a higher delta. So the delta 20 strangle was about this wide, right? So you can see how it's cutting in multiple in multiple spots, and this is not what I'm looking at, right? Or not what I'm looking for. If CVOL is high and everything is good, my range ideally would look something like this, right? For 105 days to expiration, but obviously it's not. And if you go for less days to expiration, I don't remember exactly the range for it, but it was also not as good as what we need, right? So this is something that I look at. Now, if we take a look at crude oil, you can clearly see it's on the really low end. So right, it's really low. There's no point in looking at any positions there. With natural gas, it's the winter, so in winter time you don't touch natural gas, or I don't at least. So 3 months is relatively high, so theoretically you can open a position, but at the same time it's really unpredictable in the winter, so I don't really touch natural gas. It's really volatile and can really it will make more harm than good. Now corn we looked at, but we can look at corn again. It's relatively high, give or take. See here, or sorry, well I guess it's relatively somewhat high, but the volatility is going down, so you don't expect it to kind of spike up. If it spikes up, something has happened, right? This is also something to note, that sometimes the volatility is just trending down with some spikes, right? So this is why you don't look for volatility to go up all the way here, right? For example, if you're at this point, you might want to take the trade. Because volatility is trending down and it's not flat, it's not going sideways, so it might be a good trade, right? So you would go from that point and look at the graph and make your decision. So wheat, I think we already looked at wheat. For wheat, if we take a look, it's on the edge. I mean, if it would have been a bit higher, it would have been really good, right? You can see at 6 months, so on the 3 months, if it would have been around here, give or take, I would have considered it like a really good CVOL. So just a bit more. If it goes up, we might end up opening a position there. We'll see. And see what we have. So lean hogs. So it's pretty high relatively, and I'll look to see if we can open a position there. We have soybean meal, which is also relatively high. But we already have a position on soybean oil, and they are correlated, so I'm not going to open a position on soybean meal. Same with soybeans, but I think volatility is much lower there. So it's a bit too low for me here. I would like volatility to be closer to the 20th here. We have live cattle, which is also relatively high, which is like the other meats. Feeder cattle don't trade too much, and we have soybean oil, which we already touched upon. And that's about it for the commodities, which is volatility is relatively high. I'm not gonna go through the currencies; it's kind of the same thing. So hopefully this video was helpful and kind of opened your eyes, and hopefully will help you out. Thank you so much for watching, and I hope you'll have a good one. I'll see you in the next one.
Hi everyone, so let's talk about skewed short strangles and how I use them to profit. I think it's really important because specifically for me, I sell neutral positions, so basically just strangles for the most part, and things are not always aligning the exact same we want to. So using skewed strangles is definitely a pretty easy and cool way to get things exactly the way you want it to. So let me tell you exactly how a skewed strangle might be helping us, and also I will go through the actual interactive brokers here, and I'll show you exactly what I mean by skewed strangle. So just bear with me here. So for me to open a position, and let's say I'm just taking as an example crude oil, I would want to see what is the range to my stop losses. So I would go, let's say I'm going to sell the delta 21.9 on the put side, and then the delta 21.8 on the call side. And I just want to see what is my range to the stop losses. So currently we can get about 24.50. So let's round it up, $2,500 in credit. My stop loss will be about half of this, which is 12.50. So let's see at what price of crude oil I'm going to be down about 12.50. So it's 61.31 on the downside. So let's go and put it on the graph here. 61.31. So 61. There we go. And then I want to see my upper range, and I want to see exactly where is my stop loss, where approximated stop loss, I guess. It's never obviously exact science, but it's very good. And this is exactly what I would do. And here, if we put in the line, will be 74.22. So 74.22. So this is the range that we would have to the stop losses on the bottom and on the top. Now, as you can see, it's actually a pretty good range, pretty good. So this is actually a really classic situation on how I would use it. And you can see what I don't like is the price is cutting into here, and I would like maybe to move my put side a bit up, or the stop loss, to move the stop loss on my put side a bit up, and on the call side also a bit up, to have a better range for my stop losses. Ideally, so this will be ideally, I would look for a stop loss something like this. This will be definitely an ideal stop loss, even though it's much closer on the put side, because the price of crude oil have been in this range basically since, what is it, June of 2023, right? I mean, this is what I would do specifically. Even in this case, I don't think we can really get it to that point, but we can definitely do something like this, where we raise the stop here and also raise it up on the put side as well, just enough for us to really have a nice range. And even this is a pretty good range. The price have been moving in this range since July of 2024. So we are 7-8 months of price range, of price movement within our stop losses, which is really good. Now, how would I do it? So usually, if you want to move everything from the bottom to the top, you would want to push your put side closer. So, or basically your put strike closer. So what we are going to do is, our put side is at 61. Let's try and move it from 61 to maybe 62.5. And maybe 76, because you do need to move the call side as well, just by one strike to 76.5. So let's go and see. So we have way more credit right now, obviously. So it's 2720. Let's call it just 2700. So it will be 1350 for the stop loss, and I'll just go and do the exact same thing. So 62.12, 62.12. So we already went up from 61.33 to 62.12. For the stop on the put side, and then over here it will be, again, I'm looking for a loss of $1,350 because our max return right now is 2,700. So again, just half of this is my stop loss. So 1350 will be right over here. So 75.35. So 75.35. Oh, that's a bit too much. But basically, you got a point here. 75.30 was good enough. But you got a point here, so right? So right now we just moved it just enough to give us a bit more room at the top, because again, the price have been moving in the range, and I care about in what range the price have been moving within. This is really, really important, because if the price have been moving within this range for 8 months, it's likely to continue to be in this range for the next whatever 30 to 35 days, or even like 20 to 30 days, which is ideally all you need to be in a really good position to profit. And from there, it doesn't really matter if it kind of goes up or down, because your range is actually your stop losses are expanded so much just because time decay and your position is profiting. And also, we have a bit of a delta profit here. So if the price goes up, you will be profiting just purely on delta, because this is kind of a directional position, because this is a skewed strangle. So this is how I would go about using a skewed strangle to make sure that my stops are where I want them to be. So in this case, this will be plenty good for me, to be quite honest. And obviously anything can happen, but I do it pretty much regularly, and it's been pretty good. And again, we're not trying to do something very, very, very extreme, where let's say if the price would have been over here. So let's see if we can replay and put the price like over here, and then we're trying to get this kind of stop, because now we have a really close proximity to the stop here on the bottom side, and on the top side we have quite a lot. So it becomes a pretty big directional position where you really need the price to move up, basically. But here, right now, it's not as aggressive to the bottom side. So we have some room on the bottom, and we have way more room on the top, just in case the price decides to explode up. And in my experience, usually if you have a range like this, the price tends to bounce always up and down. So we just tested the bottom side of the range, which is right here, and the price bounced back up. It might stay, it might go sideways, it might go a bit down. It doesn't matter. At the end of the day, it's all just neutral trading, and we were just trying to bet on the idea that the price would stay within a certain range for a certain amount of time, and that range is the stop losses for myself. And this is exactly how I would go to do it for myself. And it's been working and doing pretty much wonders, because sometimes you have all the good conditions to enter a position, but your stop losses are not equidistant, or they are equidistant, but they don't cover the correct range for the product that you want to trade. And then you can just kind of play with the strikes a little bit, and then you can get the exact range that you want without too much complications. And yeah, that's about it. I think this video is probably one of the shortest ones I've made, but really good, useful information. It's a really good, useful technique. I use it all the time, and yeah, I'm sure some people can find it pretty useful. Some people actually even use it, if they really want to place a directional trade instead of just going a short call or short put. They will just enter a really skewed strangle, and what that does is actually gives them a lot of protection on one of the sides. And then obviously if the price doesn't go anywhere, they can still profit from both sides and time decay, which is a huge plus. But that's about it. Again, thank you so much for watching, and I will catch you in the next one. Hi everyone. So I'm always getting asked what DT cycle I trade, or what expiration do I trade and sell options on. And the answer is, it just depends really. Ideally, I want to stay at 45 days and less, but it depends on what's going on with the price of the underlying of the commodity. And I'll show you exactly what I do to figure out what cycle I'm supposed to trade in this specific, in every specific case. So this will be the why, the how, and you'll see it's pretty easy to figure out. So let's begin by, and we'll do a few examples. So we'll do crude oil, we'll do soybean oil, I believe, and we'll look at natural gas. So right now I'm looking at crude oil, and you can see the price is kind of moving sideways. So this is something that I would want to potentially look at. For example, if we have something like gold, which is really directional, so there's no way for me to, to be able to trade it neutrally, which again, I only trade neutral. Well, for the most part, yeah, but yeah. This is specifically for a neutral trading approach. So crude oil, you can see is going pretty sideways. So let's see what would have been the ideal, I guess, range for us. So something like this probably would have been, or even like this. This would have been an ideal range for our stop losses. Now, based on what's going on in the graph, I marked what I think is the ideal stop losses. Or at least cover this over here. So if we can do this, it means the price, if we can get this kind of stop losses, it means the price have been moving within this range since beginning of September. Right now it's almost April, so it's quite a few months. I'm looking for at least about 3 months, well, 2 to 3 months. 3 months is definitely ideal, but again, it depends on the situation, but usually 3 months is pretty good. If the price have been moving for about 3 months in the range that you selected, then that's really good for neutral trading. From here, so we're looking at the well, this is the June 2025 contract. So let's see what we have. So we have 49 days to expiration. So let's take a look and see what kind of range do we get to our stop loss when we look at this DT at 49, which is for me probably the ideal days to expiration. And again, I'm just selling a normal strangle here. Our stop loss is at 50%, so we have about $1,700 in credit. So our stop loss will be $850. So let's zoom in a little bit. So let's see what are theoretical stop losses at $850. So it's 64.74. So 64.74, which is not too bad. And on the call side, 850 will be 73.66. So 73.66. So obviously, on the downside, it's kind of okay. The top side, not good at all. It's cutting through. So this is not gonna be the cycle for me to trade. And from this point on, I will just go on and I'll go to the next cycle, which is 81 days to expiration. Now this is the July contract. So I need to make sure that we are going to crude oil and to the July contract. And we'll put this right here. So let's see what kind of range we get for 81 days to expiration. So I'll go ahead and do about the same thing. Sell about delta. I sell anywhere from delta 20 to 22. Doesn't really matter too much. So let's go ahead and do it. And we have about, 2250 in credit. Let's round it up to 2300. So we're looking at a stop loss when the position is down about $1,150. So it's a stop loss of 50% of credit. So 1126. So it will be at 62.68 on the bottom. So 62.68 on the bottom, and on the top side it will be, let's see here, 74.58. So 74.58. So that's perfect for us, right? So this is pretty good stop loss. Now ideally I would maybe want to push the put side a bit up and have a bit more room on the top, but overall, this is the cycle that I'm going to trade. This is the lowest DTE cycle that gives me approximately the range that I want, where the price have been moving within this range for at least 3 months, which is the ideal number for me. All right, so this is how I figured out what cycle to trade in crude oil. Now let's take a look at soybean oil. So ideally, the range that for us to be able to open a position safely will be something like that, give or take, or maybe something like this. What is it, November? So beginning of November. So we have quite a few months. So this will be perfectly fine with me in this case. So let's see what can we get for the or what expiration cycle can we go for. And again, this is exactly what I do myself. I'm usually I can eyeball it pretty easily and kind of know what DT we need based on the price movements. But if you're not sure, this is exactly how I would go and do it. So I know for a fact 57 days to expiration is it's not going to be enough. But any case, let's just go over it. But 57 days will definitely not give us the needed amount of credit to be able to have a good enough stop loss. So I'm going delta 22 here, give or take. We have a credit of about 650, so 325 will be the stop loss. So 325 will be at 0.42. Now this is a bit tricky because it changes. So this is 0.425, give or take. And this is the July contract. Let's see, are we the July? Perfect. So So 0.425, yeah. So you can see, I already know that the stop loss at the bottom is not going to be good. The top side will be about the same thing. So we can already rule it out because the bottom is not where it's supposed to be. So let's go ahead and take a look at the 85 days to expiration, which is still it's the same futures expiration in July. Let's go ahead and sell here delta 21.6 and delta, what is it? Delta 20.4 should be okay. So right now we have $850 in credit, so we're looking at 425 for the stop loss. So let's look at 425. 425 will be right here, so 0.41. So it's actually 0.41, almost 0.415. 0.41 and almost 5. So right here. So this is a pretty good stop loss here. Let's see what can we get on the upper side. So 425 and will be 0.48. So 48 begins here. This is 48 and a half, and this is almost 49. So it will be almost at 0.49. So we have 48 and almost at 0.49. Perfect. This is a cycle to trade here because it covers exactly the range that we're looking for. I'm pretty happy with it, and this cycle is the one with 85 days to expiration. Now, sometimes 57 days to expiration will do the trick. Right now in the market, there's no good example for that, but I can go back in time and show you approximately, let's say somewhere like here. This is natural gas, and here the ideal range will be probably, this range. And I can tell you right now, especially because this is this is at the end of summer, it's in October, but I can tell you right now that this range would have been pretty good. And we have July, August, September, and October. We have 4 months of range here, and this is a pretty tight range for natural gas. So I know for a fact the days to expiration here would have been 50 or under, and it would have provided the range that we need. Now we can always be, go a bit safer if you want and trade like 80 days, 90 days to expiration all the time, but it's all about being as efficient as possible, obviously, and kind of see what's going on in the market. So this is how I know what days to expiration for me to choose to trade. Usually I want to stay at 45 days and less because theta is the biggest there, but again, you need to take whatever the market is giving you, right? So this is basically the most important thing, and be flexible because all those days to expiration, different deltas, this is just, tools in your toolbox, and you need to see, look at the patient, which is the graph, and see what do we need to do to, to be able to profit from it. From the price movement, right? So this is as simple as that. Hopefully it made a lot of sense to you. I think this is as simplified as can be. I'm always the most important thing for me is always my range to the stop losses, and this will always be the number one thing. And if it works, then if the DT the expiration cycle you're looking at is giving you the right amount of range based on what you see on the graph, then you just go for it. Then this is a pretty good trade which has a pretty high chance of succeeding. So that's it about this video. Pretty quick video, and thank you so much for watching, and I will catch you in the next one. Hi everyone, so let's talk how to deal with losses, and most importantly how to possibly avoid them. And you will see it will make a lot of sense. Nothing here is any kind of voodoo science. It's all just really logical and just a really good risk management. And of course, I'm going to have some live examples from my actual trading. I'll show you exactly what I did in 2 different situations. So let's begin. So this is everything you need to know about losses. Again, the way I trade, which is neutrally most of the time. So this is specifically for short strangles. So in 2023 and 2024, I had a total of 45 trades and total of 3 losses. Now, losses occur only because of extreme and unexpected events. So basically, things that you don't expect, well, obviously, but I guess things that you these are not reports that they just happen to came out pretty badly. It's things that are completely out of the ordinary.
and things like a mine collapsing, or something happens with the wheat supply, or like a big wheat storage place is being blown out to pieces, which is exactly the two things I'm going to talk about with the live examples. But this is what I mean by unexpected events. Now, it is possible to avoid pretty much most losses, or most full losses, with commodities, because commodities react much slower to bad news as opposed to the SPX, which gives us time to reanalyze the risk and the reward of the position, and then make a decision. So the SPX, and obviously something bad happens, that thing just drops overnight pretty badly, and you have no way to control, especially, and no way to deal with it, especially if it's over the weekend. No, you just wait for Monday or Sunday if you trade the futures for the market to open up, and just deal with whatever happened. Commodities are way slower to react, because usually the news are not that clear, and I'll get to it again in a second. And obviously, after taking a loss, it is important to understand why the price moved sharply, and stay away from the product or the sector until it becomes way more stable and calmer. So let's go ahead and take a look at two actual examples, and it will all make sense now. So this is a position that I took on copper. It was in February of 2024. And these lines are my stop losses. These are not the strikes. And this is where when I opened the position, so the price was not all the way up. It was actually somewhere in the middle here. And this is the position that I opened. Now, there was no news, nothing special about copper. Then if we keep going day by day, the price went up, went down. The position was profitable at that point. And then here on that massive, well, it's not a massive day up, but it is a day up. What happened is the news broke out that there's a possible mine that collapsed in Chile. So it was the biggest, or one of the biggest copper mines in the world in Chile, and there were reports of it being of it collapsing. Now, this is also when I exited the position. Because when you have reports like this, now this is, first of all, this is something unexpected, like we talked about, something that you cannot foresee, obviously, and things like that, they just happen from time to time, right? And this is what I mean by the price did not just react like crazy, because the reports just came in. Nobody really knows the extent of the damage, because at the end of the day, the price of commodities is being influenced by supply and demand. So here we clearly might have an issue with the supply if one of the biggest copper mines collapses, right? Now, we don't know exactly, maybe some of the mine collapsed, maybe they can really quickly get it up and running. Nobody really knows what's going to happen, but one thing I do know is these are not normal events, and at this point you want to recalculate your risk and reward. And for me, it's always, I'm going to get out of the position. In this case, I got out of the position for like a really, really small loss. It was 5 to 10% of credit. So nothing, basically break even, right? But obviously I was not trying to be hopeful and thinking, it's going to be okay. Things will get better. Well, I don't really think at all when it comes to, if it's going to get better or not. I don't know. All I know is currently this position kind of moved from a really good position to pretty much a pretty risky position where my time and my risk is not worth it, or the risk that I'm taking is not worth it anymore, right? And obviously I kind of kept looking at the graph and at the news for copper, and the mine actually did collapse pretty badly. And as you can expect, because the supply went down, the demand is pretty much the same. The price kind of kept on climbing up and up and up, and it would have been really easily a full loss for me. And obviously, it was pretty easy to avoid, because at that point, you don't know what's going to happen, and your best course of action will always be to kind of keep your capital safe and make sure you're not taking any unnecessary risk that you're not supposed to. And obviously, the next time that I traded copper was, don't remember actually, It was, I believe, in January of this year or November, December of last year. I don't remember exactly, but it was quite a while for the price to go up and then for the supply chain to stabilize. So it took quite a while. Now copper is obviously also going up pretty sharply. Now let's take a look at another example. And this is also a pretty good and simple example. Well, I guess simple relatively, because what I care about is, you know, what happened with the news basically, right? Because the graph tells you one thing, and then if you really look at the not the fundamental, but the actual, I guess the fundamental analysis, and to see what's going on, why the price moved that much. So this is a position I had on wheat. It was a really long position, and what happened is, you know, the price moved up sharply, which was in my favor. It brought the position back to pretty much delta neutral, and at that point I was up about 10% of credit on the position. Now what happened that moved the price up that sharply? So it's 3.66%. It's a pretty sharp move upwards. What happened is Russia, they destroyed, or they bombed major wheat storage facilities in Ukraine. Now the reports just came out, market is reacting, and nobody really knows to what extent, you know, or what happened with the wheat storage. Is it actually pretty damaged, or is it not, or is all of it gone? Nobody really knows. I don't know either. But again, at this point, I'm going to measure my risk and reward, and it's it's not worth it. I've been in a position for quite a long time at that point, and I was only up by 10% of credit. And to add on this, we were getting towards May at this point, where the harvest and planting season is beginning. Sometimes it begins in April. This year it was beginning on closer to May actually. So at that point I told myself, hey, I'll just take the small profit. I don't know what's going to happen. There's a possibility the price will just go crazy because a lot of wheat that was supposed to be exported somewhere in the world just got completely destroyed, and it's going to really impact the supply short term, which, in turn the price might go up sharply. It might not. I don't know. I'm not trying to predict if the price will go up or down. And just to be clear, there are some times where something like this happens. I exit a position, and then nothing really happens, or the price moves against me, up or down, doesn't matter, and then it kind of recovers back. You just never know what's going to happen, and I found for myself the best course of action will be always to be safe than sorry, and know how to pick my fights. And this is definitely not a fight or a trade I want to pick up. And as you can see, obviously, there was quite a bit of damage to the wheat facilities in Ukraine. Price kind of went up, would have easily hit my full stop loss. And then we got into the planting season, so on and so forth. So these are just two pretty recent examples, or I guess pretty easy examples to explain. And you can see there's really nothing much to it. And obviously, I haven't traded wheat up until I think it was the end of the year again. But overall, this is pretty much the explanation. There's really not much to it. It's really all logical. Everything is just made to make sense. And this is how you basically can avoid most losses, or take small losses here and there. So the 3 losses that I took for the entire 2023-2024, all 3 losses were pretty much 2 of them I can easily call break evens, and then one of them was I think down 15 or 17% of credit, which is also a pretty small loss because my take profit is 50% of credit. So I think that this should be really, really helpful. And along with my other videos that explain, what to look for, what can happen for the supply and the demand, what really affects the price of the commodity, and again, this is my entire channel is all based on neutral trading. So it's a very specific niche. This is what I know and I do best. This is what I've been doing for 9 years. So this is all specifically tailored to neutral trading and selling triangles specifically.
So keep that in mind, please, when you gonna go and make your own decisions based on what I'm talking in this video and in my other videos. And overall, this is about it. Thank you so much for watching, and I will catch you in the next one. So this is how the market is taking back all your profits. I want to talk about it all in this video, and also what are the best and the worst conditions for specifically for selling strangles on futures and on commodities. And I will go over pretty much every single month from the beginning of January, because I think it will be pretty perfect to illustrate how we go from pretty good conditions to pretty bad conditions. And it will be very clear, and I will explain every single decision that I made, basically, why I opened certain product, why I didn't open certain position, so on and so forth. So I think it will make a lot of sense. So this is the best and the worst market conditions, and why, and with live examples, of course. So what are the best conditions? Well, it's pretty simple. The price needs to be moving somewhat sideways in a range for at least 2-3 months, and for the range, it's relatively speaking, and you'll see exactly what I mean with the examples we're gonna go over. Now, there's no upcoming seasonality volatility that is expected. So you'll see with natural gas, for example, I don't trade it during the winter because it's known to be pretty volatile. So don't really want to risk it in the winter time. And there's the current supply and demand balance is very good, and there are no geopolitical tensions that can disrupt the balance. So this goes, for example, if we are looking at the potential gold position, but we know that at the end of the month there's something big coming that might affect gold, then obviously you don't want to enter a position on gold if that's the case. And this is an exact example actually that we will go over right away. And there's no upcoming major news events that might create volatility. So like reports, like seasonality reports. And again, we'll go over each and every one of these. This is just to kind of give you an idea. But these are my pretty much key conditions that I'm looking at. And only when all conditions are, being satisfied to an extreme certainty, this is when I will open a position. So let's begin with gold. So this is gold. This is the beginning of this year. So January in 2025. So this is the first day basically of the year, and this is the ideal range that I would want to get for my stop losses. Now at this point, it's actually pretty easy to open a strangle. It will have to be a bit of a skewed strangle, but we can definitely get this kind of range for our stop losses. And I know because I already checked it, we have a pretty good sideways movement within this range. So it would have been. The price would have been within this range for close to 4 months. So that's perfect for us. Anything over 2.5, 3 months is perfect. So it will be a pretty good position. Gold is kind of moving sideways, but at the same time, at that point we know that on on January 20th, Trump will officially step into into his new role as the president. And we know that I think it was January 29th, we have the Fed's rate decision that everyone is really, really expecting to see. What are they going to say? What is their outlook for the year? So, and I know that potentially there might be a lot of volatility depending on what the Fed say or what Trump might do, because gold is more of a currency. It reacts more to the market than rather than being a commodity that is reliant on supply and demand. So basically, at that point, I tell myself, if I open a position, I'm probably going to be in the position for, at least, until the end of the month, because I'm getting this kind of range, which is a pretty big range. So I'm not going to risk it. The 29th might be crazy. 20th also might be crazy. Gold might react. So I did not enter this position, and if we go day by day, we can see that gold would have eventually hit our stop loss on the call side. And actually, I did open this position on a demo account. Now, so this is what happened basically with gold, right? So then, if you continue on, and we can see what kept on happening. So up until now. basically we have a lot of volatility. Nothing for me to trade on gold because the price doesn't go sideways in any way. If it maybe would have continued going sideways at this point here for another like a month and a half maybe, but gold kind of kept going up. Now it's crashing. So this is why I don't have any positions on gold, and this is why the market conditions for gold were somewhat okay when we look at the technical side. So everything was within a range, but if you look at the fundamental side, we know there's a major upcoming news event, which is the Fed's the decision rating, or the rate decision, and their outlook for the entire year, which is known to be pretty can definitely move the market. Is I guess what I'm saying. So let's go back to what is it? I already forgot how to select bar. So let's go to January, to the beginning of the year again, and let's go and look at copper for now. So copper, this will be my ideal range, and obviously copper is on the low side. So if the price would go and be somewhere in the middle, I would definitely want to open a strangle on the position. And now all of these positions, I either open them on demo or on a real account, so I know exactly how they worked out. But at the time, I'm not looking for anything. I want to see if copper can go to the middle, and then it will kind of bounce within this range. It'll be pretty good for me. So it kind of kept going up. So at this point was, even the day before or whatever, or even here, doesn't matter, was a pretty good entry for the position. Again, you would have to skew the strangle just a little bit just to get this kind of range, but you can get this range with about probably 90 to 100 days to expiration. And again, this is the range of the stop losses. These are not the strikes, and this is what I would ideally look for, because you can see the price of copper have been moving within this range. What is it? Since June of 2024. So it's been basically, 7 months or 6.5 months. So it's quite a bit. So I would happily open a position here. And obviously we don't have any major news on copper. We don't have anything that's coming up. But at the same time, we know that Trump might impose some tariffs, because he said he will do so starting February 2nd. So I told myself, hey, I'll get into the position, and we'll see, if he's gonna follow through with his decision. And at that point, obviously, he did not get into office yet, so I didn't know. I didn't even know that at that point, actually. So I can open a position. Position is doing really good, and then I think when towards the last day, which was a Friday, so right over here, this is where I decided to close the position, right? Because he said that he will for sure put the tariffs on the following Monday after the Friday, but the position was closed for a profit here. It's been open for 15-16 days. It was actually a pretty nice profit, right? But for me, I'd want to be safe than sorry. So I don't want to be caught in a shifting market while I'm in a position, right? So I just want to exit the position, right? So as we all know, he put some tariffs on, and on Canada and Mexico. And at that point, obviously, I don't know what's going on. I just kind of want to see what's going on. And we also know that very, very quickly he took the tariffs back off. Now, the tariffs on Mexico and Canada don't really affect copper. Copper is a commodity that is being produced by Chile and Peru. It's being mined in Chile and Peru, and China is the biggest single consumer of copper. So at that point, obviously, I don't know what's going to happen. I want to see what the price is going to do. But again, at this point, he postponed the tariffs until March, right? So, and at that point, the price kind of shot up. So, nothing that I can do at this point, right? I had my trade over here, and because I was safe than sorry, it worked out pretty good. And the price of copper actually went up quite crazy because of the fears of tariffs on China and how it will impact the price of copper. So as you can see, it just kind of went up, and then copper up until now, it's pretty similar to gold. It's kind of pretty crazy. not tradable neutrally, right? But this is how you can easily spot a potential change in market, in market conditions, right? So you just got to follow, because he announced he will do the tariffs. Okay, I'm already in a position. That's okay. So let's see up until the last day. So he said he might most likely do it in the beginning of February. And then on Friday I took the decision. Okay, we need to take off the position, and you'll see it actually happens quite often with some of the other positions as well. So this is from good market conditions to bad market conditions. Obviously, right now with copper, tariffs and all this kind of stuff, pretty crazy stuff going on. You can see on the graph. So even on the technical side, there's nothing to look at. And if there's nothing to look on the technical side, there's definitely nothing for me to kind of consider. So if we go to silver for me, this would have been a pretty good range for silver. But the price is too low. So again, if in terms of my technical side, or in terms of my technical analysis, there's nothing to be looking at. I don't really go into the fundamental, because there's no point. But if you kind of keep looking, and we can see that silver actually is going up, and we might be able to open a position a bit later, I think I ended up opening a position. I was able to get this kind of range, and I opened the position somewhere around the 9th. This is actually when I opened the position. And at that point, it was, I think, the 4th, 3rd Friday, January 3rd. I think it was the same. I think it was the 9th, the same day that Trump announced he will postpone the tariffs on Canada and Mexico. And what happened is, because Mexico is the single largest producer and exporter of silver in the world, right? So tariffs in Mexico are not a good thing. But when he announced he will postpone the tariffs, there was a good opportunity right the same day, which I don't remember what day it was. I can definitely check. I think it was the Monday. I don't remember 100%. Or no, sorry. This is January. Sorry, yeah, it was in February when I ended up opening a position on silver. But here was also a pretty good opportunity, because again, Trump was not in office at that point. And now I remember. And you could have easily profited on this position. Now the actual position that I opened, now I remember, it was right on Monday, February 3rd. And again, this is the day that Trump announced, hey, we're not gonna have or we will postpone the tariffs on Mexico and Canada. And this is the range that I actually got, right? And it was with 102 or 103 days to expiration. And then again, because he said he postponed the tariffs until March, I said, well, okay, let's close the position right before the beginning of March. So it was right here. Position was closed for like 45% of credit. So it was almost full profit at that point. It was a pretty good position. And again, I want to see, what's going to happen. Is he going to hold the tariffs, and how the price will react to the tariffs, right? It's all about going from good market conditions to bad market conditions, and the other way around, and just being, not being in a position while the shift is happening, especially when we know some certain events are going to happen, like Trump is imposing the tariffs, right? So he's saying exactly when and sometimes even what. So the tariffs are on. Because the tariffs are on, I don't want to open any positions, and I just kind of, I want to see if maybe they get the some deal settled or whatever it might be, and then I can go ahead and kind of open a position. But there's no deal, and this is where we are right now, obviously. So again, there are still tariffs on Mexico and on many more other countries. On the technical side of things, there's nothing for me to look at. So these are basically bad market conditions currently. And someone that is trying to trade this market which is going to give all his profits back, all her profits back to the market, or trying to trade like not be saved in sorry. I guess this is the mentality that everyone should be looking for. And this is basically it was a pretty good trade. And then in March, I didn't have any trades actually because of all the tariffs. And then April so far, no trades as well. Now let's go into crude oil. So crude oil is select the bar here. So what did we have in crude oil? So crude oil, it was a pretty good range. The range was actually so big. It was since, what was it? I think it was since June of, oh no, actually the range was a bit smaller. It was this one. So the range that I could get selling approximately 100 days to expiration was since June 2023. So this is a massive range of prices have been moving within this range over a year and a half. Pretty crazy. The price was exactly in the middle. So honestly, pretty good time to open a position. No tariffs, no nothing. We still don't know anything. And this position would have profited beautifully, and then would have been closed obviously before the beginning of February because of the tariffs. Because Canada is a big producer and exporter of oil to the US specifically, right? So I don't know what's going to happen, how it's going to happen. And then we go again, and then we go to Monday the 3rd, where I opened a position on crude oil because again, Trump postponed the tariffs on Canada and on Mexico, and then obviously there's no other tariffs on any other countries at that point. I open a position, and I ended up closing the position right at the last day of February 28th for about 27% of credit for the profit. And then obviously I wanted to see, okay, what's going to happen. And you can imagine what happened. The price kind of went crazy down, and then this is where we are right now. So it's kind of similar, but my point here is you do want to understand what's going on, what commodities made where, and kind of pay attention to geopolitical situations. Now, natural gas, let me just move here. Natural gas, like I said, is a commodity that I don't trade in the wintertime. It's just too crazy. Things are just nuts all over the place, so I don't really trade it. So up until now, it's still wintertime basically, so I'm not really trading anything related to natural gas. So now, let's look at the grains. So the grains, the year begins. Now for the grains, I know that the big monthly report for the grains, and the first one of the years is always the biggest one. It's on January 10th. So I'm not going to do anything until January 10th. So, and it means all the grains. So there's 5 of them. So up until January 10th, I'm doing basically nothing, or I actually went one day over. There we go. And at this point, I'm looking at wheat. Well, there's really nothing. This is a pretty good range for myself, but at the same time, there's no the price is not somewhere in the middle of the range. It's actually all the way down, and then the price actually did end up going up and up and up. And I ended up actually opening. I didn't want to open a position anywhere here because again of the tariffs. But again, as soon as the deal or the agreement kind of went through, a few days later I opened a position on wheat. So I think it was right over here, the 4th or maybe the 9th. I don't remember exactly, but it was somewhere in the beginning of the month. And you can see we're in the middle of the range. Range is pretty good. And again, I closed this position right before the end of the month, which is I think the 28th, and I closed this position for a really small profit, maybe 8 or 9%, maybe 10% of credit. It was up, but not a lot. And obviously the price kind of kept going crazy because Canada is also a big producer and exporter of wheat, right? So here we have 2 things. We have the report on the 10th, which we kind of knew about, which is the upcoming major news event that we know about, and then we have like something that can disrupt the supply and demand, which is geopolitical tensions, which is in this case the tariffs. And up until now, I haven't traded wheat just because in like starting April, I'm not trading any of the grains products, just because this is the harvest and planting season, which is also really volatile. So I'm not really touching the grains during that time. Now, if you go to corn, well, corn and wheat are pretty similar, but I've waited here for January 10th. That was the first thing, and you can see we have a huge spike, but at the same time, I don't have any kind of range here that I can work with, right? So this is not good market condition for me for corn. Nothing really going on here, and the price of corn just kind of kept, being really directional, and I don't really do much directional, and there's really nothing for me to trade, and up until now, it's pretty nuts, and there's no good range for me to be looking at. So let's continue on to, and I'll just move it to the 10th already, so we don't have to move it to soybeans. Now, soybeans, the 10th, you can see pretty good range, but I would like the price to be a bit higher actually. And here I actually had a selection. So from the soybean meal, and soybean oil, they're pretty similar in how the price moves. They're, obviously they're all soybeans, so I would only really trade one of them at the same time. So I wouldn't have two of them open at the same time. There's no point. So here I would look at ZM, which is not ideal. I looked at just soybean, which was not ideal, and then I looked at ZL, which was actually pretty good. Like, it was pretty good. The credit here was pretty high, and then the range was insane. It was the best of them all in terms of how long the price have been moving within this range. So I decided on the 10th. There we go. So I decided to open the position right on, well, it was a Sunday because this was a Friday, so it was a Sunday that I opened the position, and I opened it a bit skewed, so basically, or quite a bit skewed, just because I really like the range. The range was a bit higher on the top, a bit lower on the bottom, and then it was just better overall than the other ones. I think with ZM, I couldn't get such a good range. The range was actually, to the stop loss, was actually cutting into it, and then with soybean as well, the range was not that good, so it doesn't really fit my criteria. But I know then there's nothing else that can affect this commodity for now. So pretty good market conditions, and then I settled on going with soybean oil, and then I opened the position here, and it was this was a pretty good position. It was also closed for pretty much almost full profit. And I closed this position before the beginning of February, again because of the tariffs. Now soybean and all the soybean products, they're mostly affected by, or they're produced and exported mostly in Brazil and Argentina, so they had nothing to do with the tariffs on Canada and Mexico. At the same time, I really didn't know what's going to happen. I didn't know how things will react, and the position was pretty much almost at full profit. So I just decided to close it. No point in just holding the position. It's almost at full profit anyways. I don't want to figure out what's going to happen after I keep holding the position. And not much happened in the beginning, but eventually I'm pretty sure the price ended up taking quite a turn to the downside, or to the upside, sorry. And then I haven't traded the commodity just because I didn't get a good range, and then we had March coming in, and just the market conditions that I'm looking at or looking for were not present. So this is hopefully kind of gives you a good explanation as for what I'm looking at. So I'm looking at technical, the technical aspect first. Can I get a good range? If I skew the strangle maybe a little bit. How many DT do I have to go to for how long the price have been moving within this range. And again, this is the range to the stop losses. These are not the strikes. This is really important. Strikes are, I think, maybe a little bit wider. Now, the strategy that I use, I think I explained it in many other videos. I'm also going to make a dedicated video on the strategy itself. But this is
what I look for in the technical side, and then fundamental, I want to see, okay, do we have any reports that are coming out? Do we have any news events that are supposed to move the price or that can create some kind of shift in the market? And last of all, do we have any geopolitical tensions? It might be conflicts like Russia and Ukraine, or it might be tariffs. So anything geopolitical and that you think, or that I think that might really create a lot of volatility and change my market conditions for the specific commodity, then I'm just going to exit the position or just not enter the position to begin with. So I think this kind of tells you a lot on when I'm potentially entering a position. And obviously if the price is going crazy and nuts, and right now as I'm making the video, things are just completely crazy. The price is going up and down for all commodities, and copper is crashing. Crude oil is crashing, even silver is crashing. So definitely not a good time for me to enter any position up until things settle down, up until all the tariffs are being settled in one way or another, and I know basically what to expect to a certain degree. Right now I just don't know. I think nobody knows what to expect. Things are crazy. So I'm out of the market, been out of the market since the beginning of March, and I'm still out of the market. The market itself is down like 15-16% from the beginning of the year. At this point right now, I'm up about 10%, which is really good, obviously, comparing to what the market is doing, and I don't have any exposure to the market currently. So hopefully this was a helpful video, and this is how you can potentially avoid giving your money back to the markets by really understanding what market conditions you need specifically for strangles, and I think I provided a pretty good explanation. So again, thank you so much for watching, and I will catch you in the next one.
Hi everyone, so I want to talk about the biggest mistakes that people make when selling strangles on commodities, and basically how to avoid them, and also why some of the things are not as they seem. So sometimes you might think some sort of like strategy or a way you put on a trade is safer, but it's actually not at all. So I want to break down everything and show you exactly what I mean, and I promise it's all gonna make sense. So let's begin. So the biggest mistakes is first the first one will be selling low delta strangles. Basically the risk reward is pretty bad. I mean, people think low delta strangles are much safer. They do have a higher win rate, which is pretty much the only pro that I can think about, but they're way less safe, and they have a much bigger vega, which means they're much more susceptible to volatility changes, which is not really good for us as option sellers. And I'm also gonna go ahead and show you exactly what I mean by the risk reward is not as good as selling a bit of a higher delta strangle in just a second. But this is point number one, and it will make a lot more sense in a second. But basically you have a high win rate, but you have to risk way more than you're making, basically, and it flips the script on you, basically, even though you think you have a pretty high win rate, which again actually depends on a lot of things and not only the delta itself. So second thing is selling low DTEs, so low days to expiration. This is a pretty terrible thing, and I'm also going to demonstrate why. So first we'll just go through all of these, and then I'll show you each and every one, because some of them are intertwined basically. But if you sell low DTEs or expirations with low days to the last trading day, you have gamma risk, which is gamma is the rate of change of delta, and the bigger the gamma, the easier for the position to get into major trouble, basically. So you definitely want to avoid that, and which is for me this is a no-brainer. And there is actually a much lower win rate when you sell lower DTE, and by lower I mean DTEs with like anything under 20 DTE is generally pretty dangerous, and you'll have a much lower win rate and a much bigger risk of waking up and the position is being blown out, and you're losing way more than you thought you would. So this is another thing. Now the third thing is, I guess, pretty self-explanatory. I guess not setting a stop loss.
which is obviously, this is 101. You definitely should have a stop loss. But more than that, not knowing how to check where the stop loss is on the graph is a big one. People just don't know where, they say, hey, my stop loss is 100% of credit. Yeah, cool, but where is it on the graph? Approximately, obviously. You cannot know for 100% certainty, but you can estimate pretty well, and it's going to be pretty accurate from my experience. So people don't know how to do it, and I'll show you exactly how to do it in a second. And also not taking into account the range of the stop loss. So you might know how to do that, the step, but you're not looking at the graph, in a logical kind of perspective, because basically I only sell strangle, so I'm neutral. So I always want to make sure that my stop losses are wide enough to cover the price movement of the underlying, if it decides to go up or down. to a certain extent, of course. So I'm going to go over this point exactly through interactive brokers and the actual graph, so you'll see exactly what I mean. Now the next thing is not following seasonality patterns, which is you'll have guaranteed losses. So let's say you're good at everything else, but you're not following like seasonality patterns, and you, for example, open a strangle on wheat during the harvest season, which is usually between April and July, right? And you open a strangle, you're almost guaranteed to have a pretty bad win rate, and or just lose every single trade. It's very possible, and I've seen it happen. It's just you need to know seasonality, and I have a video actually. Let me show you. The video is actually, so the video is actually right over here. So this is all about seasonality for commodities. So I'll link it below in the description. It's definitely going to tell you exactly when is the ideal time to trade neutrally, what commodity and why, and the data to back it up, because this is all data driven. So this is a pretty simple thing. You can just kind of look through this video. Explains everything, shows everything for each and every sector, for each and every product, and it's going to be pretty self-explanatory. Now, the last thing is not reacting to unexpected events and not staying safe than sorry. So this is probably the biggest thing. So again, if you follow everything else, but you hear that right now as I'm making this video, Trump is announcing tariffs on Mexico, right? And you have a silver position. Now, Mexico is the biggest producer and exporter of silver in the world, or the biggest single producer and exporter. So of course it's going to affect the price of silver, right? Or it might not, I don't know, but most likely it will affect it one way or another. Price might go up or down. The point is we don't know, but this is an unexpected event, like a geopolitical, I guess, kind of conflict, in a way, I guess. So if that happens, and that happened to me, and I had a silver position, I just took it off. I just it was up significantly, obviously, but even if it would have been down a little bit or up a little bit, I would have just closed it, because you always want to be safe than sorry in the market, especially if it's an unexpected event, like tariffs, geopolitical tensions, wars, really anything unexpected that happened. Maybe a mine is collapsing, which is actually really what happened. The biggest copper mine in the world in Chile collapsed, right? So it will, this is unexpected. It definitely has a high chance of affecting the price of copper, which it did. The price of copper went up like crazy because there's less supply now, same kind of demand, right? So things like that happen. You really need to be able to kind of figure it out where it's really not worth taking the risk at this point, because things have changed and something unexpected happened. And this is key thing. This is probably the number one reason why I'm still in the game. It's been almost 9 years or 9 years. I don't know exactly. And I've been doing pretty well for myself. Okay, so let's go and break each and every one of them. So selling null delta strangles, right? So let's start with this point over here of not knowing how to check where the stop loss is on the graph. And is it good enough or is it not good enough? And then we'll compare it to selling a low delta strangle, and you'll see exactly what I mean. And then from there we'll go to the selling low DTE, and again you'll see exactly what I mean when you plot in the stop losses. So let's begin with this. Let's see how we set up the stop loss. So first of all, what will be an ideal range for our stops here. So for me, ideally, if the stop will be somewhere here, and the other one will be somewhere maybe here. So the price have been moving within this range since July 2024. So it's at this point it's like 8-9 months, which is really good. Now let's go ahead and see what kind of position I would open now and see if it's any close to these stop losses, and maybe we can make it work for ourselves. But basically, we always want to see what's happening in a graph. And if the graph goes sideways, then it's a great trade. But if we have something like this, for example, right, it's been really directional. So there's no way for me to make any kind of reasonable like range here, because it's just been really directional. But if you look over here, for example, the price will be moving sideways, and you could have easily say, okay, well, this is the range I want, and then look to see if you can get this. You can actually get this range, but clearly the price have been going sharply here. So this is not it won't be a good example. And I actually don't trade things that look like this. I trade commodities that kind of move sideways, or in that period of time move sideways. So this is crude oil. So if we are gonna go ahead and look at crude oil, so for me, I just know from experience, about 83 days to expiration will probably do the trick. But usually this is a higher DTE, and I will make I think I'm gonna be making a video about what DTE to choose. And again, it's all tied up to what range you get, how the price is moving. If the price is way tighter, then you don't need as much range, and you can go to a bit of a lower DTE, maybe 51 for now. Let's stick to 83. So I'm gonna go ahead and sell a delta 21 strangle, 2021 doesn't matter. 21 will give us a bit more. 21.8 here, and 21 here should be okay. So let's go ahead and look at the profile. Now, let's say we are collecting about 20 to 40 or 2300, let's call it. Then our stop loss at 50% of credit will be 1,150. So let's check and see where is the stop loss approximately. So it's 62.58 on the put side, 62.58. And again, this is approximations, but from my experience, it's so accurate and shockingly accurate. And it's been working really well for me. So 1,150, and see here, 74.54, 74.54, right? So this is not a good enough of a range. We definitely want the range to go at least maybe cover this much here, and we have some space on the bottom here. So in this case, and I made a video about it, you can just use a skewed strangle. So by skewed, I mean you can just go, in this case we will push the put side up a little bit just by 2 strikes. Now we have about 2,500 in credit. The stop loss will be 12.50. So let's see, where is our new stops here now. So 62.89. So 62 will be 89, give or take, 87, and then 1,250 here. Let's see here, 75.25, give or take, 75.25. So this is a bit better. You know what? For the sake of the example, this is a good enough range for us. So we can push the put side a bit more up, and then it will be good enough for us to cover at least this price movement over here, which is exactly what we wanted initially. But let's say for the sake of the example, this is good enough for us. Now this is a delta. I think the average delta will be about 22 on this trade, on this triangle. So one side is delta, 24.9, the other one is delta 21. If you average them out, 21 and 20, it will be delta 23 basically, which is totally fine. Now, this is a pretty good range for us, right, to work with. It's plenty. The price have been moving within this range. If we discount this little price movement here, 8-9 months, now we know where our stop loss is. We know that it looks good based on the graph. So this is this point over here, point number 3, and we took into account the range of the stop loss and how it looks like what it looks like on a graph, and we know how to check it. So we know our stop loss is perfectly fine for us for this position. Now, second thing is, why don't we sell a low delta strangle, right? It must be much better risk reward ratio, right? So here, for example, we're risking about 50% of credit, and the take profit will also be 50%. So it's 1-to-1 risk to reward ratio. And from my experience, I guess my winner is about 93%, a bit over 93%, doing exactly this, what I'm doing right now, what I just did with crude oil. Following a few more rules, obviously, but risking one to make one with a 93% win rate is pretty good, but you got to be very selective with your trades. But let's go ahead and try and sell a low delta strangle and see what a 50% stop loss looks like on the graph. So by low delta, usually low delta is pretty much delta 7, delta 6. Let's go delta 7. This is what people usually even go lower, like delta 5, delta 4, delta 3. But for the sake of this example, let's go to just delta 7. So let's go ahead and look and see what's happening on the graph. So we're getting about $650 in credit, right? So it will be $325 for the stop loss for at 50%. So 325 will put us at 63 and 68. So let's duplicate this, make it a different color. So 63, 68, so right about here. And then the other stop loss will probably be somewhere here, which is 325. It will be 73.12. So 73.12. So so you can see our range is actually way smaller, especially on the call side, but it's way smaller. But we can just skew it a little bit and it will look much better. But point is, it's way smaller, right? So, and we only want to risk 50% of credit. So it's this position is actually less safe because the range of the movement is way smaller, and because this is a low delta position, they, after a certain point, they really quickly, these positions go really badly and really against you. So it's really not worth it because it's just pretty terrible. You have a pretty small theta as well, and then if the price moves, or if Vega is massive here, this is also an issue with low deltas, like we discussed. The Vega is pretty big. The only potential pro is you want to have a high win rate, but in this case, you'll have to probably risk at least 100% of credit, maybe even 150% of credit to be able to get the same range that we want to get, ideally, because we are looking at the graph. And at that point, you're risking $1 to make $3, which is obviously not ideal, right? So this is one reason why lower deltas are definitely not safer. It's I believe lower deltas are for people who are a bit more ignorant. Not everyone, of course, but people who are a bit more ignorant and they don't want to try and understand the market and make better decisions. Because I can guarantee that my win rate, the way I trade, is with delta 20 will be much better than the win rate, or it will be pretty much identical to the win rate of people who trade those low deltas and have big stop losses. The difference is I'm going to risk 1 to make 1. And they're risking 1 to make 3 potentially. Or risking 3 to make 1. Sorry, the other way around. So they will risk $3 to make $1. I got it the other way around, so which is not good at all, right? We risk $1 to make $1, and then with the lower deltas, you will risk $3 to make $1. So not very good. Now let's go and take a look at what it looks like when you sell lower DT, right? So if we go to a lower DT, so lower, I classified lower as anything less than 20 days. Let's go to 22 days. So 22 days, it's the May contract. So let's go to crude oil and let's go to the May contract here. Now it's a bit different than the other one, but it's totally fine. And let's see what kind of range we get. Even if you follow my rules for the delta 20 and not for the lower delta. So let's see. So our ideal, I guess, range would be something like this, or this is basically approximately what we got beforehand for the delta 20 and 83 days to expiration. I'll go delta 21 here, and here we'll do the same thing, delta 25.4, because we're doing a bit of a skew. So let's see. So our credit, and let's moving closer. Our credit is about 1200. So 600 will be our stop loss. So on the put side, we're looking at 66.67. So it'll be 66.67. And on the call side, 600 will be 72.57. 72.57. So you can see how narrow this stop loss is, and you can see how within like 3-4 days and not major, like not crazy days, you can easily get your stop loss. Now the only plus sign is you have a pretty big theta. Again, Vega is also pretty big here, and the biggest thing is gamma. So this is the rate of change of delta, and gamma is your biggest enemy basically when you sell neutrally. So definitely want to avoid that. But overall, even if you don't care about gamma and you don't care about theta, and theta is good enough for you, the range is just so small. You can see how that the price been out of this range pretty recently, and it can easily get to one of the sides very quickly, and it will just be a really bad scenario. Now this is how I trade. I'm looking for the best opportunities, of course, this I think in the past 2 years, or almost 2 years at this point, I've only had two or three losses, two for sure. I think let's call it three losses in the past almost 2 years, right? And I've traded quite a bit. Like I've traded at least I think 40 or 50 times, at least, if not more. Right, so this is a pretty good win rate, and I keep my losses as small as I can. And obviously, this is just a few reasons, right, why you wouldn't sell low DTE and low deltas. And I'm not just saying it just because this is what it looks like on the graph. I tried selling low deltas. I tried selling low DTEs. I tried a combination of the two. I tried selling low DTEs on high days to expirations. It just doesn't work. It works obviously, but it's far from being the most efficient way to trade. So what I'm showing you is basically what I found to be the best for my style of trading, so which is pretty much only neutral for the most part. And this is everything that I've kind of accumulated over the years, and I found to be kind of the best bang for a buck when selling strangles on commodities, what deltas work, what DTE works. And obviously the DTE kind of depends, if you can go to 50 days to expiration. It depends on how the graph looks. If it's more tight, then you can definitely get away with a smaller range and go with less days to expiration where the theta is bigger. But I would never ever go for anything under like 20 days to expiration or like 20, 21, 22. It's just not enough not enough of a range. Vega is usually pretty high, and gamma is also pretty bad. So this is it for this video. Hopefully this was pretty helpful. I feel like it was. I feel like this is the biggest few reasons that I get messages about. Usually when people say sell low deltas, they have a really good 6, 7, 8 months, and then one trade just completely hammers them and they lose everything. Same with low DTE. Low DTE is even way more volatile, so people have pitfalls within 2-3 months usually. And then obviously the whole problem with setting the stop losses and not following seasonality and not reacting to unexpected events, which I have to emphasize is the biggest thing out of everything. People, everyone needs to understand that the market is dynamic. You have to react to what's happening, and you have to understand that sometimes it's just bad conditions to trade strangles specifically. right? It's not always favorable for short options or for short strangles. So this is about it. Thank you so much for watching. If you have any questions, let me know, and I will catch you in the next one. Hi everyone, I want to talk about the right mentality and the mindset to sell options successfully, and this will be strictly from the perspective of a neutral option seller. So I only ever sell strangles on commodities, and I'll go over my strategy at the end of the video if some people are new to this channel. But overall, I just sell options on or strangles on futures, specifically commodities. I don't really trade the ES or the Nasdaq or anything of that sort. So this is really an overlooked topic, but I think it's really important, and I think this is part of why I'm able to still be in the game. And as of right now, for the year, we're up about I'm up about 10% on my portfolio. When the S&P is down, I think 5 or 6%. And as of right now, I don't have any positions on, and I think this is part of why I'm still in the game. So let's talk about it. So what is the right mentality? Well, the Vikings were very, very successful in battle, and this is mainly because they followed a core principle, one core principle. They fought only if they knew the odds were clearly in their favor. Right, so what is your main job as a trader, which is pretty much the same thing as the Vikings, is to trade only when you know the odds are clearly in your favor. Now, obviously, this is way easier said than done, but again, from my perspective, I'm a neutral trader, so for me, it's really simple. I need a somewhat of a certain market, somewhat of some kind of certainty, where we don't have any crazy events, anything crazy going on with the commodities, no tariffs, which we will get to in a second. And if I want to elaborate more, basically my job as a neutral options trader is to enter the market when it's relatively calm and stay away from the market if I anticipate the odds might not be in my favor in the near future. And an example of something that can worsen my odds is geopolitical tensions, tariffs, and market uncertainty. So this is, I think, somewhat basic, and maybe other people maybe sell calls and sell puts and might be a bit more directional than I am. But for me, I'm only neutral. Really, it's the only thing that kind of makes sense to me. And the only thing that I've had success with over the past 8.5, almost 9 years. And this is also a big reason why I don't sell courses or anything. Actually, I'm making a course for this channel for free, obviously on YouTube. But this is really, I think, one of the main points, which I knew when not to trade or when to stay away from the market. And as a neutral trader, it's pretty somewhat simple. So this is the academy where basically people, for the most part, just mirror my trades, but at the same time, this is how they learn, because there's no better way to learn than doing this, and there's no upfront cost for the academy. So feel free to email me in my email address below if you want to join. But basically, I've done this here so far 1, 2, 3, 4, 5, only 5 trades, and this is March right now, March 2025, and I don't have any trades open. And if you followed what's going on right now, it's basically we have a bunch of tariffs from the US and then counter tariffs on the US and back and forth, so on and so forth. So things are crazy. So the precious metals, which is basically gold and silver, gold is definitely very directional. So basically from the end of January, the price just kind of became very directional. It's all-time high right now, and I knew that obviously when Trump will get into office, and then with the rate cuts, and people expect some rate cuts, gold will probably be very volatile. So I knew, I'm not going to touch gold because this is really an unstable time, and obviously Trump is going to get into office and do a bunch of crazy stuff, which obviously he's doing right now. All right, so this is kind of my thought process for gold, and I want to go over each and every commodity because I think it's really important to understand why I trade or not trade that specific commodity. So this is pretty simple for gold. At that point, so over here, so these lines are the stop losses. Over here, this is where I check to open a potential position. Now, the range is really good for the stop losses. These are not the strikes. These are the stop losses. and the range was pretty good. But at the same time, I knew it. It's 10 days away at that point from Trump getting into office, and there is a possibility that things will go crazy. I don't know for sure, but I'm always I better be safe than sorry with the market. This is something I've learned a long time ago. So if there's something that might create uncertainty, I'm gonna be out, especially with gold. Sometimes some years gold is really nice and in direction and neutral. For now, that's not the case. Now for copper, it's also a trade that I didn't want to open for the most part, because China, they are the biggest copper consumer in the world, and the biggest single copper consumer in the world. And obviously, again, Trump put some tariffs on them, on China, and I don't really know how it's going to affect the metals or China's ability to buy copper. Is the demand going to go down? Supply will go up. I'm not sure exactly. All I know is it's probably going to create some volatility short term. So, which is exactly what happened. So for January it was pretty good, but then February, once we got some tariffs, the price reacted to the tariffs, and since February I haven't traded copper. Actually, even in January I haven't traded copper, even though there was a good trade there. I didn't take it. I should have taken it. Regardless, this is why I'm not touching copper right now, because there's still basically a tariff war going on between the US and China, and because China is the biggest single consumer of copper in the world, then I expect some volatility, right? Or there's a possibility of some volatility. I don't know how much. All I know is, obviously, this is not the ideal market conditions for me as a neutral seller. Let's go to silver. So silver has been actually pretty good. I traded it all the way up until the end of March. And then, again, I decided to close the position. The main reason is because the tariffs from the US on Mexico. And Mexico is the single biggest producer and exporter of silver in the world. So you can imagine it's going to be a pretty big deal for the commodity price. Now, overall, it's been pretty stable, I want to say, but I don't know what's going to happen. Maybe in a few days, it's going to, the price will keep exploding up and up. I have a position open on demo, which is down like 20% right now, I think. But this is why I did not want to open a position at the beginning of this month of March, just because I don't know what's going to happen. Now, I had a position in February. I opened it on February 3rd, and this is when Trump postponed the tariffs on Mexico up until March. So I felt okay to open a position because as of that moment, we had no tariffs on silver. And the position went perfectly fine, almost a full profit target. Actually, no, I closed it before the profit target because Trump announced that he will, in fact, put the tariffs back on Mexico in March. So for now, no trade from either. Now, crude oil. I was in a position on crude oil, actually, and I also closed it right at the end of February. Main reason is, again, crude oil is, even though it is a commodity, it also somewhat of like it reacts to geopolitical tension, so on and so forth. And also in April, OPEC, they announced that in April they will probably increase the supply of oil, which will obviously cause the price to go down. If the supply goes up and the demand stays the same, then the price of oil will sharply go down. And again, this is not only like what I suspect. This is literally what I just read in the news here. So if you go to the news tab for crude oil, I just go over every single thing, and you're just gonna see what's going on. So there's a bunch of stuff also with the sanctions on Russia, and the peace between Russia and Ukraine, so on and so forth. But overall, Trump is in office. The bottom line. And things are happening. Things are happening for the commodities. Prices for now are going up and down. I suspect things will stabilize pretty quickly because nobody likes when commodities are too volatile. It's really not good for anyone. Really, nobody benefits from it for the most part. And this is why I don't want to trade crude oil for now, at least up until April, because like I said, in April,
OPEC, they announced that they will increase their production of oil, but we don't really know that, up until like their actual confirmation. They might actually not do it, but for now, there's a possibility of things going crazy. And also, I'm sure you've seen that the stock market is just plummeting down, really starting at the end of February, right? So it's plummeting down. It went down by quite a bit, I think, from the peak, and up until now, 8.5%. That's quite a bit. And whether you like it or not, if such a sharp decline can definitely create some tension for commodities like crude oil, gold, and silver. Copper, not as much, because gold and silver are more of like precious metals, and crude oil, even though it's a very useful commodity, not exactly like gold is, but I guess gold is not as useful. Sorry, it's still a measure of how the economy is doing for crude oil. So this is why I don't want to trade the crude oil at the moment. Now, natural gas. I never ever traded during winter time, and winter is just about to be over with, but I never really touch it because natural gas is used in heating in Europe and North America, and the price is it's always going crazy during winter time, because the demand usually goes up, or depending if it's a cold winter. This winter was really cold, so the price really went up quite a bit. Previous winter, price I believe so went down quite a bit, from here. So from November, it just went down all the way to February. So we'll see what's going to happen. Usually summertime is really a good time for natural gas. You can see the price just kind of goes sideways for the most part. But again, for now, we have a pretty cold winter, and we are still in winter technically. So I don't want to trade natural gas. Now the grains are overall okay. Now there are some sanctions some tariffs on Canada and Mexico, obviously, and they both export grains into the U.S. And the U.S. farmers also announced that they will plant more corn and wheat. And actually, I'm not sure about the soybeans products, but corn and wheat will be more planting in the U.S. just because of the tariffs. So the supply within the US will go up, and this is really why the price went down here. And again, this is not me speculating. This is literally following the news, following everything that's going on. So I also exited this position at the end of the month for a bit of profit, and for now I really don't want to touch it. And for all the grains, it's starting April, usually April, May, depending on the year. This is the harvesting and planting season, which there's always volatility during the season. So you can see the previous year started exactly at the middle, towards the end of April. Actually, I don't remember if this was something else. I don't remember if something happened here between Russia and Ukraine. But overall, there's always volatility. If you look at the volatility for it, there's always volatility for the grains between April and June, July-ish. So I never really trade them during this time of the year, and just wait for more favorable conditions. So this is why I'm not trading anything right now, because we don't have any favorable conditions in terms of, we do expect things to just kind of move around up and down and be more volatile than usual just because of what's going on. But things tend to calm down pretty quickly and usually stay pretty calm for quite some time. So for now, this is what it is. Gotta take whatever you can as a trader, and this is basically what I think is really important for people to understand, that you don't really need to trade every month and all the time. It's you trade whenever you have a good opportunity and the market conditions are in your favor, or the odds are really in your favor. Now, this is my strategy for those who were not following the video. So I basically 95 or even 99% of the time I sell short strangles. I try to stay at 45 days or less, but it depends on the position and the time. Sometimes I can go to 100 days to 60 days to expiration. Depends. These are technically all the products that I trade. For now, I'm really not trading any of the currency futures and none of the meats. They're just too crazy. For the short strikes, I stayed around delta 20, 21, 22 for the short strangles. And for the calls and puts, delta 35-ish. But again, I usually only do short strangles. Profit target is 50% of credit. Loss target is, a max of 50% of credit. So I risk one to make one at worst. And so my stop loss is dynamic. So as the position is getting better and better, I'm obviously going to lower and lower my stop loss. I think it's really important, and I have a video on that in my channel if you want to go take a look at that. And I always use CVOL for good entry. So this is the commodity volatility index. Basically tells us if the options are overpriced or not. If they are overpriced, obviously I'm trying to open a position, or relatively overpriced, because I can sell the options for more expensive. And then when the volatility goes down, I will be making money along with theta decay. Now, I only exit positions if my targets are hit at 21 days to expiration. If we get to that point, we usually never get to the point, but just to avoid gamma risk, I can adjust the position if needed. Pretty much never happens. Sometimes it does, like really rarely it does. Maybe happen twice, 3 times in many years. And I can exit early if there's something, like some unexpected event, like geopolitical tensions, tariffs, for example, I would exit early. And the most important thing is I'm always looking for a good opportunity where the risk is worth the reward. So this is kind of summarizes the video where, I always want to look for positions where the risk is worth the reward, or in other words, where the odds are clearly in my favor. So again, thank you so much for watching, and I hope you guys are having a pretty good month, and sure we're going to have a pretty good year. Thank you again, and I'll catch you in the next one. So hopefully this course was pretty educational. Hopefully you got some value out of it. And as I said, at the beginning of the course and the intro, you can definitely message me if you have any questions, or email me if you want to join the academy here and trade with me. I think this is the best way to gain experience, especially in different kind of markets, crazy markets, pretty calm markets, and kind of like be able to pick the brain of someone that has been doing it for quite a while, and I guess the mentality and all the little things, even though I try to really put really everything in the course, but again, some things are pretty rare, but some are more common, and only experience can really help you, I think, to get to the really next level. So I think it's really important to be able to do that, where someone can tell you, okay, this is the right way, this is the wrong way to think about it, and this is maybe the right way to act in this case or not. So again, thank you so much for watching. Hopefully it was pretty good, pretty educational. And message me, email me, and I will catch you in the next one.